Innovative trading platform full of customizable trade desk pros and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network. Welcome back to Morning Trade Live. Trading has begun. Here's a look at where the markets are opening up. You can see here NASDAQ clearly looking to be the worst performer of the day, at least in the first minute of trading, down 1.5% today, followed by the S&P down just under 1%. Meanwhile, the Dow down about 0.7%, and the Russell down about 0.8%. Red arrows across the board extending yesterday's slide. Now let's check out some stock movers with Jeff Pierce, contributor on the TD Ameritrade Network. Good morning, Jeff. Thanks for being here.
Hey, good morning. Thanks for having me.
So the airlines are movers today. Taking a look, JetBlue down about 5%. Spirit down even more than that. We're hearing about JetBlue's bid to buy Spirit Airlines, sort of throwing a wrench in the plans with the Frontier merger. Fill us in.
Sure, yeah, Spirit down today, but of course up yesterday after the news. They rose almost 22% and saw a halt. JetBlue made an all-cash offer of $3.6 billion for Spirit Airlines, about $33 a share. Of course, this is kind of a big deal as we come in the face of a bid for Spirit and Frontier. They announced plans to merge back in February, where the deal was around $27 a share. Spirit and Frontier deal would have formed the 5th largest airline in the country. JetBlue has come out and said that their bid is clearly a superior proposal as compared to the ultra low-cost carrier merger agreement. They said that we can all agree that Spirit is a very different brand than JetBlue, but they talked a lot about kind of what their priorities are in terms of customers, in terms of experience, and in terms of cost. In a statement yesterday, Frontier said they stood by their bid. They said the proposal is in the best interest of consumers. That it would offer even more ultra-low fares to places nationwide. JetBlue and Spirit deal would be the opposite, according to Frontier. In particular, their significant East Coast overlap between JetBlue and Spirit would reduce competition and limit option for consumers. And I think that's really what we're seeing here in some of the price action. Certainly, some cooling off period from the news yesterday for Spirit. But the question right now for Spirit is whether or not they want to take the larger offer or really have to deal with those kind of regulatory hurdles. No matter who they merge with, they would certainly have some hurdles. I think indications are the hurdles might be a little bit higher trying to merge with JetBlue because of so much of their overlap.
Yeah, it's interesting. It's not just which offer will they take, but will that merger or acquisition even be allowed, right? Because regulators didn't like JetBlue's partnership with American Airlines. They kind of put the kibosh on that. So will they even allow for this?
Yeah, that is the big question. And I think part of what analysts and even some investors are pointing to there is not just are the hurdles there, but the fact that JetBlue has already kind of attempted this, and the Justice Department really pushed back on it when we talked about their move with American. This consolidation that we've seen among the airlines out there, 4 major carriers really control about 70% of the U.S. market: Delta, American, United, Southwest. That I think is something that creates a large hurdle for any of these companies that are wanting to start to combine out there. And when you have overlap, that might start raising prices or decreasing competition out there. That's something that the Justice Department is definitely going to be very wary of. And I think we've seen that in the past. And I think investors are kind of showing that in the price movement today.
What do you think JetBlue's ultimate goal is? I mean, $3.6 billion. Does that offer make sense given the $2.9 billion merger deal that with Frontier? Or do you think they're maybe just trying to push up the price or just kind of throw a wrench? What is their ultimate goal, do you think?
Yeah, it is an interesting offer to your point. I don't know why they would just want to throw a wrench into the deal. I think the offer is possible that we could see some price movement come out of Frontier, although they've said that they stand strong in their proposal. And I think investors, yesterday, certainly the jump was in part because of the size of the offer, but also some investors out there might be wondering now, is this going to move the price on the Frontier side of the deal and make the choice a little bit easier out there for Spirit? It'll be interesting to see kind of how this plays out because from all indications, JetBlue is very serious about the offer. They seem to think that this will really work well for them. They'll be able to offer, more to their customers out there. And we know right now it's a very difficult time for airlines to get employees. It's been very difficult to continue to run on their schedule. So I'm certain that this offer is in part because of that, be able to combine these two firms that are already existing. But the question of whether or not it's actually going to be the choice that Spirit makes, I think that's going to remain to be seen here over the next week or so.
Well, anecdotally, I can say that I have had a few emails from JetBlue saying flights that I have booked for the future completely canceled, not even changed. So just a little anecdote, but I will say that Frontier is down about 10% in the early going at this point. JetBlue down about 6%, Spirit down about 3%, but as you said, saw a huge run up yesterday. All right, let's move on. Occidental Petroleum, we know a Warren Buffett pick. It's on the move this morning after a buy rating from Stifel. It's up just under 1% today. Fill us in there.
Yeah, more good news for Occidental. Stifel initiated coverage with a buy rating, set the price target $84. That target implied a more than 45% upside from Tuesday's closing price. Saying in a note on Tuesday, the energy company offers investors attractive valuations and an emerging direct air capture business that will make the firm a low carbon leader. Despite the strong year-to-date performance, supported by purchases of top shareholders like Berkshire Hathaway, as you mentioned, they believe Oxy remains attractive valued stock with good free cash flow yielding of 26%. They looked at the EBITDA more than half a turn below our peer group average. The analyst also said they believe the firm's low carbon business is largely underappreciated with a 13-year plan to build 70 direct air capture facilities. Occidental Petroleum could emerge as a low carbon leader that will attract customers with hard to abate emissions. I think as we look at this, obviously the stock has done very well, up 119% coming into today over the last 12 months, up 79% year to date. They've got that proposal out for the world's largest direct air capture project. They've certainly planned to spend quite a bit of money on it, $800 million to $1 billion on the facility. But we've seen Berkshire, Warren Buffett more specifically, come in buy about $1 billion worth of shares. Just people seem very convinced about kind of the long-term plan with Oxy and these facilities.
It's interesting. I'm looking at the median price target at $63.50, and for year to date, I have up 93% at this point. So it's interesting that Stifel's calling it an attractive value, given the fact that other analysts maybe not quite so bullish. It's trading at 56 right now.
Yeah, it is interesting to watch it happen. I mean, in the short term, we've certainly seen the company, we've seen a lot of growth out of the stock year to date and over the last 12 months. I think that they're for some investors and for some analysts out there, they're making a compelling long-term growth story that's different from some of the competition. And we're seeing that play out as investors try to weigh kind of these short-term gains against their long-term story. It's going to be a very interesting company, I think, to watch, especially over the next few years as these plans start to really get into motion for these direct air capture projects.
Well, I'm pretty sure that Warren Buffett bought in on an average price around 55, 56, where it's currently trading. So I don't know. You don't want to bet against Buffett. But let's move on. In the pharma world, Eli Lilly was named a top pick at Morgan Stanley. It's up about 1.8% today, despite the overall weakness that we're seeing in the market. What's behind that call?
Yeah, Morgan Stanley came in, set the price target to $364, overweight rating, called it a top pick as it took over coverage of U.S. pharmaceuticals at the firm. Despite the generally constructive backdrop for U.S. pharma industries coming, patent cliffs require selectivity, and he thinks companies that can deliver growth in the second half of the decade are best positioned. Lilly has the most robust new product cycle outlook in pharma over the next 2 years, as the company could launch 5 new drugs. If you look across what they're working on, they've got insulin products for type 2 diabetes, potential treatments for type 2 diabetes, Alzheimer therapies, ulcerative colitis treatments. These are all in the pipeline from the company. We know that they've seen revenue growth of about 15% year over year in 2021, coming in a little over $28 billion. You exclude the COVID-19 products, it still saw top line growth of about 10%. Certainly, the concern is some of these generic versions of the drugs coming to market that hurting the pipeline are some of the older medications they have out there. But their pipeline, at least from this analyst perspective, makes them an attractive company. I think the question for a lot of investors right now is how hot the stock is ran. I mean, their PE sits at about 47 times versus the 28 times industry average. That could give some investors pause as they kind of try to evaluate the pipeline here.
Yeah, we know those multiples are under scrutiny with the Fed being as aggressive as they say they're going to be. Just looking, though, in terms of median price target, it's interesting. The majority of analysts, Jeff, have a buy rating on the stock, but the median price target is $293, which is below, as you can see here, where it's currently trading around $299. So I think we'll have to see some adjustments there or re-ratings or what?
Yeah, I think you're, well, I don't know how many adjustments we'll see. It may depend really over what we see in the next quarter or so before we start seeing any sort of adjustments on the upside. I think what investors are looking at right now is a stock that they believe in. From a price perspective, they're a little bit concerned that it is very high. We've seen this stock run up over 60% over the last 12 months coming into today. So certainly, there is some concern of some pullback there as in the pharma industry, especially as we watch some of the generic version of these drugs hit the market, how that's going to affect their quarterly earnings over the next few quarters. So I think that's what analysts are waiting for. Potentially, we see them upgrade the price targets a little bit, but that remains to be seen.
All right, on the other side of the spectrum, we have CarMax falling 3.6% today, down over 25% year to date. That's because of a downgrade. Tell us about that call.
Sure. B of A analyst John Murphy downgraded CarMax to neutral from buy with a price target of $165. That's down from $195. The analyst states that the 2022 is not proving to be a year, of stabilization and inflection, but rather looks worse amid the ongoing supply chain issues and production constraints that are being exacerbated by the war in Ukraine and the new COVID restrictions in Asia. They added that the underlying backdrop suggests that it'll be very challenging for the industry to drive volume growth this year, further noting that his downgrades are based on valuation. This isn't something too uncommon from what we've heard in the past few weeks. Wedbush said that they see a downside risk to comp sales forecast. They talked about Q4 comp sales are likely to miss consensus estimates as the company faces growing pressures in its near-term outlook. We know, used car sales have been facing certainly issues with affordability, cost out there, increased interest rates, rising inflation. All of that has kind of been going in the face of some of these car sales. So this is not uncommon or a news story, but certainly not something that investors are excited about.
I will say, in terms of the majority of analysts still have a buy rating on that stock, 13 buys, 5 holds now with B of A's, and no sells, median price target of 138. Finally, Rivian, one that had actually what looked to be some positive headlines, Jeff, but still trading lower today, down about 1.8%. Talk about a stock with a huge year-to-date decline, so even some good news can't help turn this stock around, huh?
No, it's not budging the price at all today, but the company did announce they produced about 2,000 553 vehicles at their manufacturing plant in Illinois, and they delivered about 1,227 vehicles in the same period. This, of course, is up from the 1,015 we saw in Q4 of 2021. It also fell in line with expectations. On the good news side, the company said they believe they're still well positioned to meet their annual production guidance of 25,000 vehicles. You know, currently the plant has an annual capacity of about 150,000 vehicles. They're set to increase that to 200,000 in 2023. They're opening new plants as well, but we've watched these companies struggle. They're having to raise prices, which in some cases investors are happy about. Rivian certainly had a bit of an issue when they raised their price. They ended up having to retract the fact that they were going to raise it for orders that were already out there. But the cost out there for these electric vehicles and vehicles in general have been really rising, and they're trying to keep up with those costs. We know that these stocks are definitely growth stocks, which also can run into issues as we watch these interest rates rise.
Although it's interesting because although Tesla is down today about 3.6%, but has raised prices on multiple occasions and is just, doesn't seem to hold back that stock price. We have to leave it there, but thanks so much, Jeff Pierce. We appreciate your insights.
Thank you.
Up next, we'll go inside out. Our next guest has some picks he's looking at, including Starbucks and NVIDIA. Let's break them down next and trade them with Tom White. That and more ahead on the TD Ameritrade Network. Stay tuned.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our Active Trading Webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Let's walk through charts, one of the most commonly used features on Thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select Time Frame to adjust the time intervals or to favorite a time frame. Select Style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Here's a few of this morning's movers to kick off the trading day. Piper Sandler reiterated Apple is overweight, highlighting that its latest survey on teens shows Apple ownership remains high among that age group. The firm said overall, this is a strong sign Apple has positioned itself as the dominant brand among teens. Apple shares are over 1% lower this morning. UBS reiterated Caterpillar as a buy, saying in a note to clients it sees further margin growth as costs moderate. The analyst did note, however, with steel and other commodity prices jumping in the wake of the ongoing tensions in Ukraine, they expect this lift to be temporarily flatter than previously expected before Caterpillar reaches its full inflection. And Tilray is jumping this morning after swinging to a profit on a boost from its non-operating income. The Canadian cannabis producer reported third quarter sales increased 23% from the previous quarter and rose nearly $30 million from a year ago. Tilray also provided updated targeted cost synergies from its Afria deal and reaffirmed its view for $4 billion in revenue by fiscal 2024. This has been your TD Ameritrade Network Market Update. Now back to Morning Trade Live with Caroline Woods hosting today.
Welcome back to Morning Trade Live. Let's bring in Ivan Feinseth, Senior Partner, Chief Investment Officer, and Director of Research at Tigris Financial Partners. Ivan, thanks for being here. Good morning.
Morning. Thanks for having me on.
So, Ivan, you have a couple stock picks for us today. Let's start with Starbucks. It's a loser today, down about 1.7%. But tell us why you like this one. And I'm assuming this is despite Howard Schultz coming in and suspending that share buyback program.
Well, he's making bold moves from day one, and he's switching or shifting to investing in the growth of the company and employees and store expansion and upgrade. And I think long-term investments like this usually pay off. They committed last year to significantly increasing employee compensation and making it the number one choice for people who want to work in that industry, and as well as having career paths to management. And at the same time, they are trying to push back against a union push by offering higher wages and better benefits as well. So the company stock has done okay. The business has done okay, considering what we went through in the pandemic. But I think he's taking control to shift the company back to a significant growth position.
Has done okay, but when you look year to date, Starbucks is down about 30%. So obviously, if you think this is a buy, it might be a good entry point, being down 30%. Yes. But Starbucks has its fair share of headwinds, right? You mentioned unionization. There's, of course, cost pressures, wage pressures. There's slowdown in China on top of COVID lockdown. So I guess, what is it that's going to drive the stock higher from here?
Well, I think you want to buy good companies when they're going through a difficult time, and that's definitely the case here. And the ongoing global growth, and eventually the situation in China will turn, and China has been and will continue to be a big growth engine for Starbucks, and they have really done very well in converting a tea-drinking society to coffee. So
you want to buy it now, or do you wait to see what happens in China plays out?
Well, sometimes when you wait to see, it could be too late. So, I mean, you buy it here, if it goes a little lower, you buy more. If it goes higher, you can always average up. But I think that this is a good entry point if you don't own it, or a good time to add to it if you do.
All right, down 1.7% today. And yes, obviously impossible to time the market. In terms of another one of your calls, NVIDIA, it's down 4% today, about 15% year to date. What sticks out about that chip maker?
Everything. Pretty much they are on the forefront of driving AI through their graphic processing units, driving AI integration into everything, into healthcare, into autonomous vehicle technology, into all kinds of data management. I mean, and originally CEO Jensen Huang called it the Omniverse, but the Omniverse/Metaverse. I mean, you need these types of chips to create these immersive 3D environments. So I think there's just so many growth engines in NVIDIA, and it leads in so many areas that, it was up to over 280 a few days ago. It's down again here. I think this is a tremendous buying opportunity. I think you always buy NVIDIA on the dips, because this company continues to lead the semiconductor industry on almost every front.
How does the chip shortage play into your forecast? Is that, in terms of looking at it from a company perspective like NVIDIA, is it purely positive because of pricing power?
Well, yes. I mean, the shortage, we have a shortage on something because there's such significant demand that processors at all levels are in everything possible, from, light bulbs and bathroom scales to obviously cars, computers, and all kinds of connected devices. So the fact that there's a shortage is only because there's huge demand, and I think you will see production ramp up. I mean, Intel is investing significantly in building production capacity here in the U.S., and there's just everything runs on semiconductors, so they're that important, and that's why I think the leading companies like Intel and NVIDIA are must-own stocks.
All right, we have to leave it there. I do want to mention, though, Ivan, that another one of your picks, Hertz, down 5.7% today. Didn't get a chance to get to it, but thank you so much. Ivan Feinseth, Senior Partner, Chief Investment Officer, and Director of Research at Tigris Financial Partners. Have a good one.
Thank you.
All right, now let's trade those picks with Tom White, the co-host of Fast Market. Hey there, Tom. Good morning. Let's start with Starbucks. How do you trade that one?
Well, I think this is one of those, names that you have to be careful about, right? The old CEO is back, right? They pulled back on any of their stock buybacks. They still pay a hefty dividend, which is about 2.3% dividend yield. But this one's been under pressure off from those highs that we saw in mid-2021. Costs are rising. Their China business is struggling at this point. So I looked at an option strategy where I'm still going to be able to own the shares and collect that dividend, creating some yield there. It's almost a waiting type of strategy, pay to wait on this name, Starbucks, where for every 100 shares of stock that I buy, I'm going to sell an upside call that's out of the money for a credit to offset some of my costs on buying the shares while I can still collect that dividend. So my example is for every 100 shares of stock in Starbucks that you buy, you sell a May 90 strike call against it, creating this covered call position or buy right type of position. It's one of the basics in the option world as far as trading goes. And if you pay roughly about a debit of 81.70, that's going to be your risk. That's going to be your break-even point. So you're buying the shares lower because you're selling that out-of-the-money call to the upside. You see there from the risk profile, your break-even is 81.70 over the next 44 days. And you get to sell calls against your long stock repeatedly, right? So it's a neutral to bullish strategy, but you can offset your costs, lower your break-even point, increasing your yield on a week-to-week or month-to-month basis, depending on where you sell that upside out-of-the-money call against your long stock position. And as long as you keep holding that stock position and you don't get assigned on your short calls, you adjust them or close them ahead of time, you'll be able to sell more calls against that, increasing potential profitability on this. So this covered call strategy, basically a buy to wait type of strategy where you get paid out to hold the shares.
And still get to take advantage of that dividend. All right, thanks for that one. How about NVIDIA? How do you trade that one, Tom?
Yeah, a little bit more aggressive here. The implied volatility is pretty elevated in here, but you can buy like an at-the-money call or slightly in-the-money call as opposed to buying the shares, right? This is a $250 stock. It's relatively expensive. So you get that leverage by buying options or call options as opposed to buying the shares, right? It's not as capital intensive as buying the shares. So I went a little bit more aggressive, a little bit further in duration also, going out to that June monthly cycle, which is about 72 days until expiration. So you're giving yourself over 2 months in this position where I'm going to buy an at-the-money call spread, where I'm going to buy the June 250 strike calls, and then against it, I'll sell the 280 strike calls, because maybe I want NVIDIA to go higher over the next 2.5 months, but I don't need it to go that much higher. I only need it to go up to 280 to get full profit potential on this particular trade. If you're paying roughly a debit of about $12 on that, that's going to be your risk on this spread, $1,200 per spread, with the expectation if it gets above 280 at expiration over the next 72 days, it's going to expand to $30. So pretty good risk reward setup here, and you don't need that big of a move to get above that break even, which is about 262 to the upside. You see that break even there. So you only need about a few percent to get above that level, and then another few percent to get above that 280 strike at expiration in June. You'll also capture an earnings event in there too, which might add to the upside if it's a positive report.
All right, we'll leave it there. NVIDIA down 4.4% right now, right around 248 a share. Tom White, appreciate those trades. Thanks so much.
Thanks.
Coming up, we'll keep the trading going when we look into Levi Strauss, which is set to report earnings after the close today. Stick around on the TD Ameritrade Network. Morning Trade Live. We'll be right back.
Let's walk through charts, one of the most commonly used features on Thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
It's a 13-hour flight. That's not a weekend trip.
15 minutes to wait.
Wow, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. Ah, they're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make Thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Welcome back to Morning Trade Live. I'm Caroline Woods, filling in for Oliver Rennick. Here's what we have for you in hour 2 of the show. We'll look at the latest developments with Elon Musk's Twitter involvement. We'll preview and trade Levi Strauss ahead of earnings this afternoon. And the Chartmaster will look at analyst moves in Upstart, Alibaba, and Constellation Brands. Now let's take a quick check at the markets, where we are trading 30 minutes into the session, about 33 minutes into the trading session. NASDAQ actually picking up some, adding to those losses, down 2.4%. Russell following suit, down 1.7%. S&P not far behind, 1.3%. Dow Jones Industrial Average, the outperformer of the day, but still down about 0.75%. Now let's bring in Alex Coffey, host of Next Gen Investing. Good morning, Alex. Want to start with That Elon Musk news, Twitter breaking its 3-day winning streak. It's down about 2.3% today, but given the run-up that we've seen, still up about, 30% or something because of that news. No big surprise, though. Elon Musk is no longer a passive shareholder. He's active.
Yeah, and this is one of those headlines that it reads nice coming across the news wire, but it's sort of a foregone conclusion at this point. I mean, being added to the board kind of tells you that he's going to play a role. It's not just a passive investment. Accumulated these shares early in Q1, and of course disclosing that this week, sends the shares higher, gets a lot of buzz. He's then added to the board. And of course, we see that shift now in the filing from passive to active. You did mention the stock down just a little bit here today, a little bit over $1 lower, below 50. But this is a 2.25% move lower. But when you look at it in the grand scheme of this week's trading action in Twitter in particular, I would say that it's almost a drop in the bucket given its rally. Also, I would note that the equity market as a whole is trading on its morning's lows, with the NASDAQ down almost 2.5%. So on a relative basis next to its peers, one could argue that it's actually outperforming on this session. And then I would also note, Caroline, I'm not attributing this move to this shift in this filing.
You know it's a down day when I call the Dow the outperformer, and it's still down almost 1%, and you're calling Twitter the outperformer when it's down 2.4%. But let's talk about that negative sentiment that we're seeing. What do you attribute it to? Is it just a pullback, or was it the run-up that we saw recently just a bear market rally after all?
Well, I think the jury's still out on the latter part of that question in terms of, is this something greater than just, sort of a hiccup to start out the year? Is this more of a bear market rally? Are we going to see, prolonged equity underperformance, or just asset classes in general underperformance relative to the past, let's say, decade or so, which has really been a nice bull run? I think it's too early to say there. However, what I will say is, Caroline, I think it is attributed to a couple things. First off, we had a very, very sharp rally off the yearly lows. And some may say that on a short-term basis that at the very least could have been a little bit overdone. So maybe there was room for a sell-off, but I think things have been accelerated from the selling that we've seen, particularly on the long end of the curve in U.S. Treasuries. And so we've seen obviously a spike up in yields. You see as sort of a catalyst from some of the Fed speakers yesterday, particularly those who are historically seen as more dovish amongst their peers, such as Lael Brainerd, talking about significant reductions in the balance sheet in terms of the pace. You also look at possibly other foreign governments who are liquidating potential positions in long-dated treasuries as they move out of dollar reserves going forward. I think both of these stories are longer-term stories, but we certainly see a lot of pressure on treasuries, and the debt market oftentimes does kind of prelude anything that we see in terms of equities. So I think the sharp contrast in terms of the sharp downwards move we've seen in U.S. Treasuries is putting a little bit of pressure here on equities that had just had a tremendous rally.
Alex, we also got the first call from a big Wall Street bank, Deutsche Bank, for a recession because of the war in Ukraine and the spike that we've seen in inflation. They say we're now projecting a recession in the U.S. and a growth recession in the euro area within the next 2 years. Do you think this is the first of many, or do you think, how market moving do you think this actually is? Because we've been talking about the possibility of a recession, more recently.
Yeah, I think obviously they don't want to scare the children, if you will, Caroline. So I think they're going to be hesitant to really make those kind of very, very stark calls that do have real impact in terms of, in some ways, becoming a self-fulfilling prophecy. If you tell the public or you tell everyone, on the news channels that a recession's coming, we're going to make different decisions in terms of how we spend. So I think they're hesitant to make those calls, but I think the signs have been pointing that we're going this way, at least in terms of a growth slowdown for several months now. You combine that with the inflationary pressures that don't seem to be subsiding. It's not necessarily a constructive recipe for economic growth. So in many ways, Caroline, I think some of this is a foregone conclusion in terms of a slowdown in the economy, a possible recessionary situation. It's just a matter of how long is it going to be prolonged and to what extent.
Well, we'll get the Fed minutes later this afternoon, so we'll see the Fed's plan to hopefully achieve that soft landing. We'll leave it there. Alex, thanks so much. Now let's look ahead to some earnings coming your way after the close today with Michael Keeley, contributor on the TD Ameritrade Network. Good morning, Michael. We're looking at Levi this morning, ticker symbol LEVI, hence Levi, down 5.5% ahead of that report. What are you expecting?
Well, we can see the real kind of weakness in the shares that has been evident over this last year. It hit its high April of last year, and it's been on a pretty consistent downtrend since that point in time. Here we have that chart showing the shares trading right around 1863. And when we take a look at the price targets, Caroline, they are universally bullish, with all 7 of the sell-side analysts that I tracked at a buy profile on this, and an average price target of 30. Investors may wonder, is the firm actually growing at this point? The answer is absolutely yes. So should they hit their target on the top line revenues of 1.56 billion, then that would represent growth of 19+% year over year. And the earnings is even more impressive at a growth pace of 23%. Should they hit that target of 42 cents. And they've had a history of beating the earnings estimate over each of the last 4 quarters, but we do see that hasn't translated into upside momentum on the shares. And investors might wonder things like, well, how sensitive is this company to the sales that would be made in Eastern Europe, for instance? And, to give some context there, they temporarily suspended their commercial operations in the country of Russia, and about 4% of the company's total revenues last year were from Eastern Europe, half of which were related to Russia. So there will be some impact. Of course, the analysts have mapped that out. And we still see the growth, like I've mentioned. And this firm's done a lot, Caroline. They've spent money, which has proven a fruitful thing to do in really advancing their omni-channel presence, their advertising, SG&A expense has helped the margins improve, and they've got a new line of other brands, as they're calling this other segment, which consists of Beyond Yoga and Dockers, and that's a division that's really growing impressively, with revenues most recently of 99 million, increasing 60% year over year. So, the picture that I'm painting here is that the technical perspective is absolutely weak. But when we take a look at the earnings estimates, they really haven't veered away from where they've been over the last 60 days. It's been very steady. So the conflict, the war in Ukraine, not really impacting the firm on a negative, level for the analysts to reduce their estimates at this.
So you talked about the war in Ukraine as a clear headwind, although we'll see actually the impact of it. But what about other headwinds like supply chain issues, like cost pressures? Is Levi's more or less sensitive to those as some of its competitors? I just happened to look at Gap. I immediately thought, okay, Gap jeans, when I'm thinking Levi, also has yoga pants. They're down almost about the same percentage today and year to date, both down a little bit more than 25%.
Yeah, that's a great question, is the impact of the supply chain issues. And, we'll see what they have to say about that. To this stage, that has not been a huge hindrance to them being able to hit the targets, and then some on the past couple of quarters. So that, not seen as a real, enormous obstacle right now, but that could be certainly deteriorating with what we know is happening with supply chains worldwide, really exacerbated pressures there. The other thing, Caroline, that I thought was of interest, in light of your conversation with Alex about Elon Musk, being on the board at Twitter, a lot of speculation that, well, it's to protect or hedge his ability to really, make the pushes that he does in the public domain that feed into, the advance of the things that he wants to do with the firm Tesla. And in that light, when we look at Levi's, it's been interesting to me that the individual that was really geared toward the next CEO, Jennifer Say, she wound up leaving the firm recently because, and this is pretty, it looks pretty tangible in terms of the reasoning here. She was, really vocal on Twitter on her personal account about COVID-19 restrictions, and she was told in various emails that you've got to pipe this down. And your representative of the firm, she had a very different view of that, and so Levi's ousted her, and she turned down the $1 million severance package, stating that would have been nice, but that would have required me to not say anything for the next year in order for me to fulfill that, kind of that agreement. And so she did not take the money and run and said, it's more imperative for me to be able to voice what I'd like. And I just think this is very representative of what a lot of firms are going to be contending with as it relates to social media's presence and the importance therein of, making sure that folks aren't doing things that are adverse to the business operational objectives, I suppose.
Yeah, we'll see how that plays out, possibly on Twitter. Michael Keeley, thanks so much for breaking it all down for us. Appreciate it. All right, let's do some trading and welcome in Joe Teague, portfolio manager of the Rational Equity Armor Fund. Good morning, Joe. We were just talking about Levi Strauss. Michael did a great job of breaking it down for us fundamentally, but how would you trade Levi's ahead of earnings?
Yeah, thanks for that, and nice to meet you, a new face around here. I would just be looking at this horrible trend it's had this year, this horrible downtrend. I don't think anything is going to change. And we talked about a lot of the headwinds out there, but just for me, looking at the economy right now, looking at the consumer, the whole climate around stocks the past couple of days have been negative. It's a bad time for it, and it'll be an interesting report for me to take a look and see what is the consumer's appetite right out there. What is Levi going to say about their sales for the next quarter? Of course, Levi, it's not exactly an elite name or a luxury type brand, but it is something that people can decide, do I need a new pair of jeans right now or can I wait? So if they're saying the economy looks a little soft, it'll show up in their projections. So I'm looking for downside on this report.
Although downside, it's already down 26% year to date, yet analysts are overwhelmingly bullish. Obviously, they have a longer time horizon, but I'm looking at the Refinitiv data here, 13 buys, 0 sells, 0 holds, median price target of $30. So they look at it a little bit differently, but when it comes to the actual trade, what would you do?
Yeah, just the chart looks ugly. The low on the year right now is a little over 17. That'd be about where I'd want to get out of the name. We're trading right at 19, a little under right now. Just looking at to get into it for a short term after this report, looking at the May 19-17 put spread. Can buy the 19 put for $1.30, sell the 17 put for 60 cents. So that'll get me in for 70 cents. I can turn that into $2 or $1.30 profit on that trade. That's a nice risk reward for me, a defined risk. And again, I just think it'll trade toward the lower end of the range, given the environment, given everything going, given how bad the chart looks to me. I think that's a reasonable bet.
All right, well, it's down 5.4% right now, trading at about 18.65. We'll leave it there. Joe Teague, portfolio manager of the Rational Equity Armor Fund. Thank you so much, and very nice to meet you as well.
Yeah, thanks for having me.
Coming up, we'll dive into volatility and different ways investors can position their portfolios around it. Morning Trade Live. We'll be right back. Stay with us.
Let's walk through how to analyze a company's financials on Thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to Thinkorswim, Head to the Education Center on tdameritrade.com.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade network.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads, like counters and diagonals, are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Welcome back to Morning Trade Live. I'm Caroline Woods in for Oliver Rennick. Let's bring in Jem Carson now. He's Senior Managing Partner at Kai Volatility Advisors. Good morning, Jem. With that title, it only makes sense that we talk about volatility here. We're seeing the VIX moving big time today. It's about at 25 right now. What's driving this move, and is this volatility that we've been seeing really throughout 2022 here to stay?
Yeah, so it's the reality is that vol has actually been quite compressed on a fixed strike basis. Most traders have been well hedged throughout this period. The inflationary effects and the geopolitical issues are well known at this point. And the hedging that has broadly happened across the market for the last 6 months has really served to dampen what otherwise, have been really negative macro flows. So we really have this push and pull right now between reflexive positioning in the vol markets and the VANA and charm flows that creates, and the geopolitical kind of Fed inflationary flows that are coming more from the bond market. And I think that understanding that dynamic is very important. That can best be illustrated by, in a microcosm by what happened here recently in the March quarterly expiration. We had a massive backwardation in the vol curve, massive hedging that was happening in the March expiration, which led dealers to be short put dramatically in March. This is not too dissimilar from an event vol like we had during the election in 2020 or in Brexit. It was particularly exacerbated not only because it was a quarterly expiration, but because it was the big March Fed meeting that everybody had been kind of waiting for. When that event passes, much like a lot of other event vols, that leads to people getting longer vol post it. When I say people, I mean dealers primarily, getting longer vol post that March expiration and shorter delta. Those effects we referred to in the vol space, again, not to get all technical, is our VOMA and VETA effects in terms of vol, and VANA and charm effects in terms of the Delta 1 buyback. So there was a massive influx of Delta buying into that meeting and that March expiration, which is why we saw this massive 10% plus rally in the S&P over that period. That said, from a macro perspective, most of us know this at this point, but the Fed is writing calls, essentially. We talk about the Fed put a lot. The Fed is essentially, there's now a Fed call on the market. The more the market runs, the stronger the economy is here. The more we're going to get vol selling from the Fed, more interest rate rises and quantitative tightening, which is something which is pressuring the market down from a more midterm, perspective. So I think those are the kind of the main things to be thinking about right now. And in a microcosm, what we're seeing, it's also why we saw, really a market down, vol down dynamic there in January and February for quite some time, because vol is ultimately quite well supplied at this juncture. That said, and I think this is important, we're heading into a 5-week expiration cycle, something that most people don't think about. April into May is a 1 week longer expiration cycle than most. Given that and given the fading seasonality as we head to May, I think it's likely that we'll see a fade in some of the support that we've been seeing in the market, and I think that's important to watch going forward here.
Well, speaking of seasonality, April typically is a positive month when we look at seasonality. Obviously not the case yesterday or today, but then there's that old adage of sell in May and go away. So for those people who don't feel like they're hedged properly against inflation, or maybe aren't as familiar with all of the technicals, what is the best strategy to hedge yourself against what could be increased volatility throughout the year, given all of the risks that we're facing?
Yeah, vol broadly is quite cheap at this juncture, and skew surprisingly has started to dampen, has started to come down considerably as well. So particularly when you start looking at May and June, expirations a little further out, there are some interesting opportunities to hedge in this market right now. It is not too late by far, by any means. This week in particular tends to be a supportive week. So even though we're getting a bit of a decline here, heading into Monday, there should be support. That doesn't mean the market's going up, but that means that there are opportunities to monetize short-dated puts to own longer-dated puts right now. And I think that is really the best way to kind of hedge in the current week as we approach, like I said, April. Post-April expiration, especially the next couple of weeks after April expiration, post-Good Friday, that is a time for caution. But broadly, writing calls with the Fed to in the short term to own longer-dated puts and sell shorter-dated puts seems to be the best structure currently in order to hedge.
All right, let's stick with shorter term. We have the Fed minutes coming up later this afternoon. Major averages really holding firm with their losses. NASDAQ is losing the most, down 2.4% ahead of that. But we already know what the Fed decided from that meeting. Kevin Hinks was on earlier this morning and said shouldn't move the markets, but a lot of times it does. How market moving do you expect the Fed minutes to be this afternoon?
I think the reality is, I think the minutes themselves are largely priced in. What is not, people think of interest rate rises and the quantitative tightening almost as one and the same. They really are different mechanisms that have very different time lags and affect markets in different ways. Interest rates really flow through directly to the economy more than anything. And so they have a much longer lag. Their effect on markets are historically a bit longer. Quantitative tightening is a direct flow of capital to capital markets or flow out of, and that's the piece to watch here. If the Fed is going to accelerate the quantitative tightening, I think that is an area of concern that people aren't as closely watching. We expect balance sheet contraction as early as next Fed meeting. The question is how fast are they going to try and accelerate that? And based on Brainard's speeches in the last 24 hours, there's reason for concern there. And I think that's really what you're seeing in markets right now is the reaction to that. That's a place to watch. I don't think they're, the minutes, which are a little bit delayed, are not going to be as aggressive as whatever Brainerd said. So I don't think that's going to be the surprise, but I do think that people are on edge, understandably, and they will be, here going into the next Fed meeting.
In terms of what's been moving the markets this year, it's certainly been the war in Ukraine, obviously with Russia and the Fed, inflation, possible recession forecasts. What else do you think could move the markets this year?
Yeah, I think the big one, some people have talked about it, but I don't think it's talked about enough. We believe the odds of an invasion of Taiwan by China in the next year, we're not talking next several years, is close to 50%. Even if it's 30%, right? Even if we're looking at those types of probabilities, we're talking about potential global bifurcation based on that if we think inflationary effects are strong from commodity push because of Russia, we ain't seen nothing yet. I mean, China, is obviously, the biggest trade partner we have in a major, input to costs across businesses. So I think that's a major concern. That's far from a foregone conclusion, but it is something that I don't think markets are nearly pricing in enough given the risks at hand.
30 to 50%. You don't think the way we've sanctioned Russia, we just added or we're adding more sanctions there would make China think a little bit less in terms of, just the reaction that we've seen on a global scale would prevent them from entering Taiwan?
No, I think to be clear, we don't have a lot of cost burden to putting sanctions on Russia. Europe does have a bit, obviously, because of their gas supply, but Europe hasn't sanctioned the gas from Europe. So if you're China and you're looking at the costs of the U.S. are tremendous, especially going into an election cycle. China's calculus is what is the U.S. going to do in that situation, and we haven't done anything militarily really in Russia. Europe hasn't had the gumption to do anything as it relates to hurting its own economy in this process, and that's what China is watching, if you ask me. So I don't think they've if you're sitting in China's seat, again, who knows, right? We're talking about major economic geopolitical moves that it's hard to say for sure, but obviously this is something that clearly China knew about going into. This was part of their calculus, watching and seeing what the reaction is, and the reality is the reaction, particularly during a midterm election cycle where it's going to be hard for to take the economic pain, does not look like it will be what China would think of as a worst case scenario.
All right, we have to leave it there, but maybe next time we can talk about where Jam Croissant, your Twitter handle, comes from. Jem Carson, Senior Managing Partner of Kai Volatility Advisors. Thanks so much.
Thanks so much for having me. Take care. You
too. Coming up, we'll hit the charts with the Chartmaster, looking at analyst moves in Upstart, Alibaba, and Constellation Brands. Morning Trade Live. We'll be right back, so stay tuned.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Back on Morning Trade Live, and it's time for the Chart Master, and for that we welcome in Ben Watson. Hey there, Ben, good morning. We're looking at some analyst moves this morning. Let's start with Upstart. Loop Capital initiated the stock with a buy rating and $140 price target. Not doing much for the stock this morning. It's seeing a lot of weakness.
You're absolutely right. It is, and I think that's a little bit more of what has been going on with Upstart recently. You know, after reaching those highs above the 400 level in October, November, that time frame, it's been roughly downside only here. A little bit of sideways oscillation, though, between this 83 and 166 mark, which is a fairly large range. It gets kind of compressed on the chart just because of that upside move that took it up into that 400 level. But now starting to see a little bit of this squeeze over on the right-hand side, into a little bit of a deep, perhaps descending triangle kind of in the middle of this area. And you're right, today with this move, we get a gap down into what was a little bit of a hammer, now turning into a little bit more of a sell-off, somewhat counterintuitively to the positive nature of this rating initiation. But that potential is there for this to bounce back up to that diagonal and then maybe back up to that 130 mark. Perhaps not enough upward momentum here yet to perhaps break up to that 166 horizontal resistance. But you've got that downside support around the 83 mark that could be a stopping point. Of course, no guarantees the price will stop if it does decide to continue to turn to the downside, although it's tested that 83 level 3 times now. But long-term sentiment rising below that mid-range, it's coming up out of the oversold area. Intermediate-term sentiment falling and crossing over that longer-term sentiment. So you've got kind of a mixed message here, and I think that's consistent with this price kind of waffling in between this this range at 83 and that resistance area, wherever that resistance might be, perhaps at that declining resistance line, Caroline.
Yeah, it's interesting. It's trading around $96 right now, but analysts have a median price target of 230, so they see it breaking to the upside at some point in the longer term. Let's move on to Alibaba. It's next. Price target cut at Citi to 177. Shares down 4% today, but still a bullish call overall.
It is, and again, once you start to see some of these counterintuitive moves in the very near term, although Alibaba has had really, again, this downward pressure, longer-term downtrend, at least over the course of this yearly chart, but it's been relatively orderly to the downside. It's moved within some measured ranges, now seeming to kind of squeeze below that level. And in fact, we saw earlier, a month or so ago, that big move to the downside following the earnings announcement. It pushed down as far as that 75 level. Then we get this kind of volatile gap up rally up into this diagonal downtrend line, and seeing a little bit of a push today, gap down sell-off on this price target cut, the price target cut coming to the 177 level. The bounce is potential there, back up to the diagonal, beyond the diagonal at about the 116, 128, a horizontal resistance level. But if it does continue to move to the downside, you've got some clear or relatively clear support levels, one perhaps at that 99.5 mark, But long-term sentiment, and this is where you kind of see that maybe a little bit of a sentiment divergence. Long-term sentiment, the dashed line in the lower panel, is moving strongly up into overbought, suggesting that there was a lot of upside momentum in that rally off the 75 level. But long-term sentiment, again, working against that. So we may see this kind of middle around underneath that diagonal downtrend line.
It's interesting. I should say that, I had said that the city cut its price target from 200 to 177, but kept a buy rating on the shares. Lastly, Constellation Brands, which we know reports earnings later this week. Goldman keeps a conviction buy rating on the stock ahead of that report with a $275 price target. Shares only down about 0.3%, but not enough to move this stock higher today.
Yeah, and this is a stock that Oliver and I have talked about a couple of times in terms of the resurgence of restaurant demand in the beverage space, as well as their ties to some of the pot stock activities. But this kind of long sideways trend giving way to this intermediate upward movement, we could almost look at this as if this were the kind of failed right-hand shoulder of a Head and Shoulders reversal. But it does seem to be finding a little bit of a support here in this right-hand area off of that 228 support. Get a little bit of a gap down sell-off today that tested a little bit lower, but it's coming up off the lows. So the potential is there for a bounce back to 233. That's that previous high. And then 241, which is out a little bit. The breakdown to the 223, testing that level again, which has been tested multiple times. Once again, mixed message as far as sentiment is concerned. Long-term reversing higher, intermediate-term sentiment falling, and an earnings announcement imminent here for Constellation Brands. Caroline?
So I'm looking at the peak of that chart there, and it's around 260. So even that is lower than Goldman's price target of 275.
Right. Yeah, it's got a ways to go, and it's got a difficult bottling proposition here to get to that point, right? So even if you pop the cap on some upside movement, it's got a big fizz that it's got to make in order to get back up to those previous highs and to the price target.
Loving those puns, fizz, bottling, and we're talking about recession forecasts. I think beer, Modelo, Corona, that's recession-proof, I think, right? We'll have to wait and see. Ben Watson, thanks so much for all of your chart mastery.
You bet.
When we return, it's market meetup time. We'll dive more into the rise in interest rates and what you should watch or what you should be watching for the rest of the day. Stick around on the TD Ameritrade Network. Morning Trade Live will be right back.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our Income Investing course. In the Income Investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the Income Investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
Let's walk through charts, one of the most commonly used features on Thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Ben Lichtenstein here with your TD Ameritrade Network Futures Market Update. Elevated energy prices remain at the root of inflation concerns investors have been expressing, and they're a reflection of the geopolitical tensions brought on by the prolonged war on Ukraine, with the WTI crude holding above 100 this week, supported by expectations the EU, the U.S. will impose further sanctions on Russia. Natural gas to just shy of $6.40 this week, near double the Jan lows we saw in the $3 range. We just heard from the EIA. They said weekly crude oil inventories increased for the first time in 3 weeks by 2.4 million barrels. Expectations were for a draw of about as much. Gasoline inventories declined as production increased. WTI futures holding just below 102, slightly lower on the day. Keep an eye on the U.S. dollar into the Fed minutes this afternoon. The greenback to 99.74 overnight, back to May of 2020 levels, with Federal Reserve Governor Lael Brainerd suggesting the Fed plans to shrink the balance sheet rapidly and will begin the process as soon as May. Esther George, president of the Federal Reserve Bank of Kansas City, said 50 basis points will be an option to consider at the upcoming meeting. The TNX spiked to 2.64 overnight, the FBX to 2.76, combined with a big move up in the longer dated 30-year, the TYX to 2.67%. This has been your TD Ameritrade Network Futures Market Update. Now back to Morning Trade Live.
Welcome back to Morning Trade Live. I'm Caroline Woods in for Oliver Rennick. It's time to bring in our market meetup panel. Joining me is Michael McCurr, Director of the Trading Services Offer for Charles Schwab's Advisor Services, and Scott Connor, Director of Trader Education at TD Ameritrade. Michael and Scott, thanks so much for joining us. Michael, let's start with you. I know you brought a chart of the 10-year yields or the 10-year Treasury with you. What are you seeing in the technicals?
Well, the technicals, at least from a longer-term perspective, continue to march toward this measured move potential from a technical pattern that we've been looking at on the TDA network for about 6+ months. It's been a technical triangle that formed over the course of 2 years between 2020 and 2022, had a substantial, powerful breakout at the beginning of the year, setting the stage for a potential rally up to 3% in the U.S. 10-year. And at the time that this broke out, I don't think many thought that this was something that was on the table or in the cards. And the fundamentals continue really to march higher towards this right tail. And the market, at least in the belly of the curve, continues to march towards this 3% level. One thing I'll note is that momentum on a weekly basis is not as strong as we saw a few months ago. So we're not seeing higher highs in momentum right now, but as the old adage goes, price is king and we're moving higher.
Scott, I want to get your thoughts on rising rates, and also obviously the 10-year yield is a key component of that 2 and 10 yield curve, which has been flashing recession warnings or potential recession warnings. How seriously do you consider those?
Well, I think the market is definitely taking it serious. Seeing the 10-year yield jump up to 2.64, now that's like a 3-year high. But it's not just the 10-year number itself. I think the market's focusing on just rates in general. We saw news this morning from the mortgage applications that the 30-year fixed mortgage now is up to almost 5%. I think 4.9 is where it came in. Now that's the average. But if you just go back a year, that was 3.3%. So you can just get an idea how much interest rates have moved up in the past year. And of course, 10-year yield is a focal point, but when it really trickles down to consumers like ourselves, I think it's the fallout throughout the economy, and it's particularly in housing, that I think people are concerned. Now, a lot of this, I think, is focusing on the minutes that are coming out this afternoon. Europe was down this morning before we even opened. Caroline down like 2.5%. So Asia was down about 1.5 to 1.75%. So I think there's some anticipation going into this meeting. But overall rates definitely have the market on their heels, I would say, Caroline.
Michael, investors clearly jittery. Taking a look at the S&P 500 down 1.2% ahead of those Fed minutes. In terms of the S&P, though, you say bulls are still in control in the near and intermediate term. Tell us what you're looking at and how you're drawing that conclusion.
Yeah, so I generally take a more technical outlook to the markets rather than a purely fundamental. I think price action really drives a lot of the conversations that we're having, at least on the network and with clients. But from a technical perspective, the S&P, we did have an 11+% rally from the low to the high over the course of almost 2 trading weeks. So from a near-term breadth momentum standpoint, that's the lower panel indicator there. That got to a hot level, like a Death Valley type hot level, where the temperature was just so hot that it was expected that we would see some air at least come out of the tires, come out of the rally, retesting some level of support. So from a technical perspective, we're still holding above the near and intermediate term moving average in the S&P. That puts that 21 and 50-day moving average basically between 44.50 and 44.20. So I would look for those levels to hold on this retracement, ultimately setting the stage for a move higher. But I do think that this uncertainty with the entrenched inflation, the Fed likely to take front rates above neutral within a year's time, that's going to make the road to this recovery a little rockier. But I still see the bulls back in control. But in the NASDAQ, this is the one. So the NASDAQ broke significantly more so than the S&P throughout the entire decline in January and February. And it has not recovered to the extent that the S&P has. So it has not gotten back above that 200-day moving average. In fact, it failed right there. So that's the one I think we do need to watch. But from the more broad composite for the market, the S&P, I think the bulls are still in control there right now, at least on the near and intermediate term.
Yeah, NASDAQ worst performer today, down 2.2%. But Scott, I do want to ask you about not necessarily the NASDAQ, but higher quality growth stocks in general, because obviously we saw that rotation out of growth ahead of the Fed interest rate hikes. And then we've started seeing more interest in them. They're all down significantly, or 2-3% today. Apple down 2%, Google, Alphabet down 2%, Amazon down 3% today. So was that just some dip buying and then the rotation continues out? Or knowing that a recession, stagflation, economic a slowdown could be in the cards, is there reason for renewed interest in those companies because of steadier earnings?
Yeah, I think it's a little bit early to say, because I think with so much attention focused on the Fed minutes coming out today, I think that might clear up, what's happening going forward. But it's interesting because on Monday on this show, we were talking about how impressed we were with the fact that these growth stocks, the FANG names, really took control. It looked like they were back in the driver's seat on Monday. We did say, let's watch and see how the week plays out. And then, of course, Tuesday, they turned around. Those 3 sectors, communication services, consumer discretionary, and IT, fell. They were the worst sectors on Tuesday. Now, again, that was a repeat today. So it looks as though maybe Monday was just a blip. But they've reassumed, if you will, sort of that fading sector role that they had that we've seen, in the recent past. But again, let's see what happens after these minutes come out and see if that group can't sort of recharge on Thursday and Friday, because that's the big question right now. We're watching closely what's happening with these FANG names. And without them, it's going to be very difficult, obviously, for the market to sustain any kind of momentum or rally. We'll keep an eye on that group going forward. We are seeing some strength today with, the traditionals that you would expect to see. Some of the consumer staples, utilities are showing some strength, and of course, energy kind of in that group as well. But we need a balanced rally here for the market, because even the other day when we had a rally, the breadth wasn't that good, and I know Mike probably follows that pretty closely, but I think even on Monday when we saw that big up day, we had just as many stocks down as that were up that day. So that might have been a little bit of a yellow flag, if you will, Caroline.
It was a true testament to just how powerful those large cap tech stocks are in the NASDAQ and S&P. I think, Michael, I do want to point out, though, that oil has dipped lower. It's down about 0.4%, so still above $100 a barrel at 101.53, but we are seeing weakness there. How should we think about oil prices as we start to predict? Because you're saying bulls are back in control. Is that despite what oil does?
Well, I think oil is going to be more affected price-wise from the geopolitical news than anything from OPEC. I think the oil market and energy markets are pricing in the probability that you're going to see some unclenching from the geopolitical situation that should ultimately pressure oil. If we got into a really risk-off scenario, potentially with risk parity involved there, where bonds and stocks went down at the same time, kind of which is happening right now, you could see oil continue to move lower on a capital flight outwards. But one thing that I do want to circle back to, if we can, just talking about the FOMC minutes today, I really don't think they're as important as everyone seems to think. The moves that we're seeing happen yesterday with Brainard coming out basically saying that the Fed is willing to hurt growth to bring inflation down. We're not going to get this immaculate tightening where they raise rates and earnings stay up and growth stays up. They're willing to take growth down to get inflation down. They think it's a paramount objective right now. And I believe that the Fed speakers are going to continue to prep the market for a 50 basis point hike in May. You've seen 2 or 3 already come out and do it. I would expect that to continue. They're going to likely take rates above neutral within a year's time. And, looking at Fed funds next year in March, they're at 2.85%. The Fed in March of this year on their projections said by the end of the year, they only expect rates to be at 1.9%. So the Fed is still behind the curve from what the bond market is pricing, and the Fed speakers are coming around to this idea now.
All right, we have to leave it there. Michael, Scott, thank you both so much, and thank you for joining us. I'm Caroline Woods. I'll see you this afternoon on Market on Close. But first, Trading 360 with Nicole Petalides is up next, live from the New York Stock Exchange. Stay tuned and see you later.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it could potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Good morning. We are 90 minutes into the trading day. Welcome to Trading 360. I'm Nicole Petalides, live in New York City, live from the floor of the New York Stock Exchange. Let's take a quick look at the markets now. We shouldn't be smiling when we take a look at the markets because it's been a tough week for stocks. You can see here that the Dow is down 0.84%, down 290 points, 34,351. The S&P 500 down 59 at 4465. The Nasdaq losing 2.33%, so accelerated to the downside throughout this day, 14,476, and the Russell is down 1.3%. Now to some of the biggest movers of the morning. How about Twitter? Twitter is higher again. In fact, it's up over 32% this week. Elon Musk refiled the disclosure of his stake in the company from passive investor to active after he was named to the board yesterday. Also, a 13B filing from this morning shows Musk sold almost 300,000 shares of Twitter, reducing his stake from 9.2% to 9.1%. Spirit Airlines says it will consider a $3.6 billion all-cash takeover from JetBlue. Spirit has agreed to be bought by Frontier for $2.9 billion back in February. You remember that? Now, Spirit's board saying it will pursue the course of action that is in the best interest of the company. Evercore ISI also downgrading Spirit to in line from outperform this morning. Stifel initiating coverage from Occidental Petroleum with a buy rating and an $84 price target. The analyst said that the stock remains attractively priced despite doubling due to its largely low-carbon business. And Bank of America downgrading CarMax to neutral from buy, cutting the price target to 165 down from 195. The analyst saying that 2022 looks to be worse than expected due to the ongoing supply chain issues, production constraints in the automobile industry. Now let's take a look at the major products here as we do every single day. And you can see, oil is pulling back 0.5%, 101.47. Bitcoin down 4%, 44,165. US dollar, a little strength there, 99.45. And gold futures are up about $3, 19.30 a troy ounce, and the VIX at 25.35. Let's get some insights in the news shaping the markets, and for that we welcome in David Sherman, founder, portfolio manager of Crossing Bridge Advisors. David, good morning to you. I was just looking at the week to date, and it's just tough. It is tough to be an investor, particularly when you see, for example, the Nasdaq down 2.3% just today alone. And you got excited, right? Over the last 1 month, people were saying, whoa, this looks great. What are your thoughts on the market action we've been seeing and going forward?
So I'm not really surprised by the market action. I don't know why anyone should be. We have multiple events going on at the same time. The Fed has been messaging for quite some time now that they were going to raise rates, and more importantly, they were going to reduce the balance sheet, which would increase spreads among all asset classes. I like to take the Fed at their word, so we've been positioning appropriately in that regard. On top of it, you've had geopolitical risks that have been festering for some time, and with the Ukraine war, obviously that creates uncertainty, and the question is, where will that end up? And then lastly, we have continued supply shocks that are occurring both from COVID as well as now the war. But on top of that, we also have this huge amount of demand as a result of opening up, and we have less employees, less workers. So you have this, these multiple events that are creating a great amount of uncertainty, and the market doesn't like uncertainty, and they also are concerned about profit margins.
And, you know, I mean, that's something that we're going to be following on, right? Profit margins and what it really means here is we're starting off earnings season next week with some of the banks. I think it's certainly set to be an exciting one. We're waiting on Fed minutes. Also, I'm not sure that we'll learn anything much new, particularly after we heard Lyle Brainerd yesterday and basically saying that, you know, the Fed's willing to hurt growth a little bit in order to bring inflation down, right? I mean, is that not a surprise to you to hear that kind of language?
I mean, the Fed's been messaging that since the third quarter, and I think they're committed. I think the part that people haven't focused on is the reduction of the balance sheet, and I think that came to light yesterday. You know, as the Fed stops being a buyer of high-quality fixed income assets, the market will clear at a lower, at a higher spread and a higher yield, and that's going to trickle down through all asset classes.
Yeah, absolutely. Let's talk about some of the other things that you have on here. I mean, I thought it was interesting about SPACs and regulation. You know, we work on Wall Street. We've seen there were so many SPACs. There was such a rush to bring these things to market. Then there was a pause, and a lot of the traders have been talking about some of the IPOs and things starting to come back. But you feel like there was a pause. Is there an underlying issue?
So let me backtrack a little bit. First of all, I think SPACs are one of the most attractive investment fixed income alternatives that are out today. They're short duration. The average SPAC market has a maturity of about 11 or 12 months. They're yielding almost twice as much as the equivalent U.S. Treasury. And quite frankly, the SPACs, if you buy them at a discount and you always redeem or sell, right, are effectively a high quality, short duration piece of paper that you can't get in the market in investment grade or government bonds. The fact that we went through what I call the meme period from Labor Day of 2020 into, so call it St. Patrick's Day of 2021 is no different than all the other meme events we've seen. But SPACs have been around for quite some time. We've been investing in SPACs since 2005. As for the current regulation, look, I think that the average investor adopted SPACs as opposed to the institutional investor during that meme period. And I think the SEC is aware and concerned about the disclosure and making sure that investors understand what they're buying.
Okay, and I'm glad you brought that up because, you know, there are a lot of people who are wary of SPACs, particularly because they're not all, you know, coming to market and going straight up. I mean, you could stand to lose some money too, so that we always sort of issue a little bit of a warning. But I like your perspective on that. I would also just like to talk about the big picture and this rally because, you know, a lot of people think it was just sort of bear market rally, certainly didn't have legs or fundamentals. Is this a pause or do you think we're in a downtrend that is likely to continue now?
So I'm not a stock market guy. We're a credit guy. We're primarily focused on fixed income and lower down the capital structure, high yield. And we know high yield is a hybrid between high quality fixed income and equities. But valuations were, in my opinion, very, very high. And more importantly, people were not allocating an appropriate spread to risk and illiquidity. And today, they're still not appropriating enough spread for counterparty risk. I'm not suggesting we'll see 08, but I do think that, you know, there is counterparty risk. And we know that just from the London Metals Exchange issue with what was going on in the short squeeze.
So as someone who's a pro in your field, I mean, are you looking at debt and looking at it in that way? What is your advice to investors who invest the way you do?
So there are two things. One, I think you need to really look at your spread over Treasury and assume that rates are going to go up and you have enough cushion to offset that mark to market. More importantly, you need to take a view of what is your exit on that fixed income security. All fixed income securities have a day of reckoning. And are you prepared to hold it to that day of reckoning? And is that an acceptable return for your money? Whether it's a pre-merger SPAC that you always intend to sell or redeem, or it's an investment grade bond or it's a high yield bond, what is that exit date and are you prepared to hold it? So rather than look at the mark to markets, look at what your yield to exit is. And is that an acceptable return? Because if it's not, you shouldn't be in the game to start with.
Well said. David, it's great to have you on the show. Fascinated by the painting over your shoulder. I mean, I love paintings, and that one really is. Yeah, I mean, can you give me 10 seconds on it?
Yeah, I do. I teach a class at NYU Stern Business School called Global Value Investing. I use this picture, this artwork, as an example of a value trap. It was a surrealist artist from Latin America that's got good pedigree. I bought it at a failed auction at Christie's, and I figured it's kind of spooky and the colors are really not very becoming. So everyone in my office made me move it to my office. And I'm betting that I bought it cheap enough that someday these colors will come back. But if not, it's a value trap.
Okay, I love it. I love it. I love it. I love the backstory. I think that was fascinating. I think this may be the first time I actually really smiled today. So thank you for that. David Sherman, Crossing Bridge Advisors. Thank you for being here. Appreciate it.
Enjoy the day.
Thanks, you too. All right, plenty more to come on Trading 360. Matech Systems is in our 360 spotlight after the digital identity company announced an acquisition. CEO will join us with all the details. And Array Technologies is today's disruptor after earnings and an upgrade over at Guggenheim. Tom White with us, and he'll have all the details for you as well as an example trade. And we will talk all things Microsoft in the 360 round. Looking forward to that discussion. But up next, looking forward to this too, the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein goes through the technicals, and Don Kaufman is standing by. He's going to take a look at the trades for the XLU, Zoom video, and Apple next here on Trading 360.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network. Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management Webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I'm going to take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set.
Choose the app that fits your investing style.
Welcome back to Trading 360. I'm Nicole Petalides, live in New York City. New York Stock Exchange for you. Take a look at the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein will take us through the charts, and here to take us through the trades, Don Kaufman, co-founder of Theo Trade. So we have a great lineup. I think talking about the XLU, when you look at this group of utilities, which was a leader yesterday, people love it for the dividends. Tell me your thoughts on why the utilities, XLU, jumped up for you as a trade, Don.
Yeah, this happens to be everybody just simply piling into to the utilities at this particular point in time. I mean, it's an area of safety, it's an area of value. You know, you mentioned the dividend, but the dividend at this point is what? It's dropping below 2.5% right now, which is nothing in comparison to even the 5-year. So the dividend doesn't even look that good at this point. And I am constructing a rather bearish trade on here, and that bearish trade has a tremendous amount to do with the correlation coefficient in the entire S&P 500. And that basically amounts to this. you look at the S&P 500, even on a day like today, the advanced decline line's not half bad, but the S&P is getting beaten up. I would anticipate that the S&P 500 advanced decline line is going to be hideous to the downside within days to come, that we're going to see a higher correlation coefficient, and products like the XLU are going to take a hit. The position I'm actually going to present here is a much more duration position. So it's the XLU. It's going to be all the way out to the June 17th expiration. I'm just going to buy an in-the-money put. I'm actually going to buy an 85 put for a $10 debit. It's not an inexpensive trade, but it's a synthetic short stock position. So instead of shorting the stock, I'm just buying a deep in the money put as a synthetic replacement for short stock. And I know you're not going to like this one on a technical level because the XLU has been straight up. But again, it's much more about the correlation coefficient of the marketplace.
Look at the advanced decline line right up there on the big board, and the up volume is pretty slim. I'll just put it that way. Ben, your thoughts when you take a look here at this chart?
Nicole, Don, good morning to you. Don, I'd agree with you. It has been trending to the upside, and it has been, strong relative to the broader market. So if the broader market continues to roll over, I can understand the potential to see some downside here. But you know how I feel about it, and you spoke to the point. Again, I like to see some weakness prior to jumping in or picking a top. And in this instance, I think that's just what's happening here in terms of calling this the high or saying that this one's not going to continue to the upside. I wanted to take a look here at some of the bid activity that we've seen. You're looking at the daily time frame here and how we're breaking out of a range to the upside here right now. This market, XLU, has been transitioning to the upside here, trending to the upside, I should say. It's been a safety trade in many ways, while treasuries and the yen not as much so. Recently bottomed out around 64, and much like the broader market, saw a lot of strength throughout the month of March. The move up in the broader market has stalled some, though. It's rolling over, but XLU has yet to. And, well, here you can see on the daily time frame, it continues to hold its upper level. Now, I wanted to point out here something we've seen in terms of the channel to the upside as far as XLU and this move that's been playing out basically, again, since the March lows and, well, now that I look at it, all the way back since the pandemic. And, again, the channel to the upside, we're trying to break out of it right now. I do want to point out here that on the weekly time frame, what I'm noticing here is, again, another breakout type scenario and exactly what the bulls like to see in this type of situation, a higher high, a higher low, directional conviction to the upside. So, again, I think Don's right in terms of potential. There you can see the conviction in terms of that breakout going all the way back to the pandemic lows there as well. And, I agree with Don in terms of at some point this one is going to roll over, especially if the broader market continues to. But at this point, it's really yet to indicate that we've seen a top.
It's interesting, right? Because as you're saying, it's yet to indicate that. And, we always like to follow momentum, and you can't deny when something is just going higher. At the same time, things do roll over, much like what we've seen with the NASDAQ even just now, this week, right, Don? So final thoughts here on XLU.
Yeah, so I step in here, and I am stepping in the way of a freight train, and I completely understand that I am stepping in the way of the freight train, but I love trades like this that afford me this kind of risk reward. That is, if you will, the upside potential of the XLU, okay, for me is limited versus the downside, risk. And that's why I want to be short when, if you look at the upside, all right, there's a couple dollars more to the upside, and I think we can rationalize that, but the downside could and would be absolutely hideous if it's to occur. And that's it's one of the reasons for this trade.
Okay, so thank you for that one. Let's move on to the next one. And it was the ever popular trade of Zoom video. And now you really have protection in this trade, I see, on both sides. Don, what's going on here?
There's times where, as a trader, I'll take a directional bias. I'm bullish, I'm bearish. Then there's other times like this, inside of Zoom. Okay, Zoom happens to have a phenomenal implied volatility skew such that I can build a call ratio back spread for credit. If we go up and up big, this trade could be profitable. But if we go anywhere down, the trade can also be profitable. So let me actually present the trade, and those that are kind of playing the at-home game here can take a look at this because, again, the skew is quite phenomenal. This is out in the May 20th expiration. I'm selling one of the 120 calls. Again, selling one of the 120 calls and buying two of the 135 calls. So it's kind of a bigger, if you will, ratio back spread. The trade is put on for somewhere in the neighborhood of about $1.40 credit. What I liked in the skew is I'm selling big, juicy implied volatility and then buying much cheaper out of the money implied volatility. And again, it's that skew that made this particular trade advantageous. So again, if we rip to the upside above 150, anything is possible and plausible. It is Zoom. This trade would be wildly profitable to the upside. If we break and stay below, anything below 120, we get to keep the $1.40 credit in the trade. So the risk in here is between 120 though and 150. Things can get ugly inside of a call ratio back spread.
Okay, and so with that, what do you think as you take a look at this one? Because he said sometimes you really see some direction and sometimes you got to just play the trade. Ben?
We've got Zoom, which has been and continues to be coming under pressure now. A relatively tame move in terms of what we saw throughout the month of March relative to the broader market. And, you know, I noticed that in the month of February, or in the month of March, I should say, that we were unable to take out that Feb high. Take a look at the 60-minute time frame. You can see what I was just talking about. Again, relatively limited to the upside throughout the month of March relative to what we'd seen in the broader market. We rallied into the end of the first quarter, but nowhere near that Feb high that we saw up around, what was that, 157, I think it was. Yeah, here it comes into play, just shy of 160 now. Take a look at the daily time frame. You can see how Zoom has gone from, well, ZM, that is, Zoom's gone from, well, to gloom and doom in many ways. You can see some of the selling that's come into play, how we're holding below the 50-day moving average basically since August of last year, the summer of last year, retesting it right now, but well below the 200-day moving average. And RSI here is kind of limited in terms of ability to get anything going through the middle of the range. They've been testing this lower extreme multiple times on the way down, so supportive of some of the weakness we've seen. At the very least, not indicating any rejection as of right now. We always talk about acceptance and that sideways consolidation at a lower move here. Taking a quick look at the weekly time frame, I noticed only up 10 weeks since the start of last August. We're going all the way back to, again, these highs up around 400. You can see the trajectory they've been on to the downside. This market has been, it continues to be coming under pressure. And while it's slowed some of the momentum at this point, no real indication that we're rejecting these lower levels or have yet to take out anything significant that was established on the way down. Well-defined trend, a textbook of, again, momentum to the downside in two separate legs. First 588 down to this 300 level, recovered a bit, and then resumed again that trajectory. So another well-defined trend here, another well-defined channel for that matter to the downside.
Look at that. You know, Ben's always really great at charting and looking for rejection on the downside and trying to really see these trends, which way they go. Is there anything that really jumps out at you, Don, when you're doing this trade? The numbers?
Yeah, Ben is finally becoming a little bit of a bear. I'm into it on this one. Yeah, no, this particular trade is definitely more about skew. So I'm less inclined to even look at the bias on here. I happen to look at option change throughout the course of the day, and when the skew is that good, I'll execute a trade on skew and skew alone. If it works out for me, fantastic. But it's constantly about putting probabilities in your favor that works long term in this business.
Okay. And last but not least, you know, as you talk about the bears and the bulls, at the New York Stock Exchange gift shop, which used to exist a long time ago, they had a puppet. One side was a bear, and then you could turn it inside out, and the other side was a bull, right? You like that? That would have been good, especially for weeks like we've been seeing. That being said, last but not least, the darling of Apple that, you know, people still think it has so much upside. What are your thoughts, Don, as you take a look at Apple? Whole ecosystem.
Yeah, I definitely had to throw a marquee underlying into this grouping, and that marquee this week, of course, is Apple. So I am unequivocally bearish inside of Apple. I'm unequivocally bearish inside of the monsters of tech. If we look at the last couple of weeks, just the last 3 weeks, and this, you know, immense rally that has ensued, I mean, ultimately, what has really rallied? I mean, your Tesla, a couple of what I term the monsters of tech, which amount to, you know, Amazon and Facebook and Google and, you know, Microsoft, Apple. It's the usual suspects, right, that have actually brought the market back higher. And it's those usual suspects that are going to get hit. They are mega market cap. They are prime time to take a hit. And once again, like we can look at this right now, and I think today specifically is absolutely critical for this market because this is going to define the previous 3 weeks. Like if this was a bear market rally, you're about to find out here as the FOMC minutes come out in a couple of hours. And if we stay down today, then yeah, I think it's confirming it was a bear market rally. In this particular Apple trade, it's the 22nd of April. Now I picked that particular expiration because I wanted to avoid Apple earnings, which are coming, I believe, the 28th of April. So in this case, I picked the 22nd of April expiration. I'm going to buy the 175 puts, sell the 170 puts. The trade is done for about $1.65 debit. It's probably bid up a little bit in terms of price action because the markets are down right now. Nevertheless, bearish on Apple here in the not too distant future.
I mean, and that's the beauty of options too, is that you're really looking shorter term for some of these trades because, you know, if you look at what Apple provides, it's so hard to say Apple is insignificant, it's a bear, it's overvalued, you know, I want out, it stinks, or things like that, because, you know, Apple has so many things in our ecosystem when we try and shop for the holidays. Now, I don't know, you tell me, Ben, I mean, that is the beauty of options trading, isn't it?
And the risk-defined aspect in terms of futures trader, we always talk about placing stops to kind of minimize that risk, but we all know, many of us experience personally, stops can get blown through, and it really is just a level that you're trying to get out, not necessarily a well-defined area that you'll be able to get out. Options, again, provide that more well-defined backdrop. So that's one of the things I look for. But yes, I completely agree with you in terms of some of the options that options provide, really is one way of thinking about it. In terms of Apple, though, we have seen some strength. I can understand why Don's a little bit bearish and somewhat ho-hum on this rally in terms of the move up. You can see we did, well, recently able to take out the March or Feb highs in the month of March, but limited in terms of follow-through so far throughout the month of April. Here you can see the run-up off the middle of March lows down around 149-ish, and appears to be a bit of a double top forming up around this 179 level. Now, step back from the hourly time frame shows that we're holding above the 50-day, holding above the 200-day moving average. But again, I mentioned here that we were able to take out the February highs in the month of March, but so far, much like the broader market, April has been somewhat limited in terms of directional conviction to the upside. In fact, we've seen some of the downsides we're pulling back. Don mentioned the possibility for a bear market rally, and I think this is kind of stacking up to, well, be potentially just that. We've seen a short-lived move to the upside. RSI unable to really extend in this instance, and it seems like it's starting to roll over here a little bit. Just wanted to take a quick look here in terms of what we've seen as far as the daily. I agree with Don in terms of keeping a close eye on Apple today in reaction to the minutes and the broader market in general, especially if we get another big move up in rates. That's been one of the things that's been kind of telling and somewhat weighing on some of these big tech names. But here you can see, I think this is one thing that's somewhat encouraging, but also sort of favoring Don's trade. You have the trend environment to the upside. I always talk about these areas of consolidation where we're seeing a lot more rotational and overlapping type price activity relative to the strong move we had seen off the pandemic lows and the run up through $100. And then again, it just seems like we're in a bit of a consolidation area, which we always talk about has a lot less directional conviction, a lot less energy one way or the other, and it lends itself to retests of the lower extreme and kind of just chopping around. The middle of this range would be around 165, lower extreme being around 150, the 182 upper level, so some well-defined levels to keep an eye on. But yeah, I can understand why Don's a little bit disappointed in terms of some of these individual names' recent performance and the possibility lending itself to opening up the door for this just being, as he mentioned, a bear market rally.
Yeah, and you know, I think you made a lot of great points there, but you were reading my mind. I think so much of this is headline driven, and so you see this volatility. You mentioned rates going higher, and that always pressures. What will the Fed do? That pressures and causes volatility, and the Fed minutes, which you also mentioned. Don, final thoughts here on what we're seeing. You can, you know, wrap it up on Apple or a big picture thought.
Yeah, big picture is there's tremendous headwinds right now for the overall marketplace. I mean, more so than at any point really in the last decade. And it's difficult for me to get constructively bullish. And that's specifically on a risk reward basis where, you know, I think that there's upside potential in the marketplace, but I think some of the downside risks, some of the headwinds just dramatically outweigh it. And that's exactly why I'm using defined risk option trades to take part in some of those bearish positions.
Yeah, I saw Goldman Sachs Costigan saying there was limited upside for stocks right now. So, you know, we have a lot to take in. Don and Ben, always fantastic. A big three, XLU, Zoom, and Apple. Don Kaufman of TheoTrade and Ben Lichtenstein. Thank you both for being here. Always, we appreciate it. Coming up next, we are going to spotlight Matech Systems after the identity verification company just completed an acquisition. Now, the company's CEO will join us, tell us all about this deal and the role it can play in enforcing sanctions. Next on Trading 360.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Trading 360. I'm Nicole Petalides, live at the New York Stock Exchange. We were talking about market breadth, where we really see down volume, more than twice up volume at this point, and the pressure is on the markets across the board, which are near session lows, not at session lows. You can see that the Dow is down 270 points at 34,370. The S&P is down 55 points at 4469. The Nasdaq down 2.3% at 14,477, and the Russell down 1.5%. Time for our spotlight. We're spotlighting Matech Systems after the digital verification provider announced its acquisition of British customer identity specialist Huya. Now, this is all about this deal. Max Carnecki is with us, the CEO of Matech Systems, to tell us all about it. Welcome back to the show. Max, thanks for being on with us. I look forward to hearing more details on the company, but let's jump right into the deal. Why Huya? Why right now?
Hey, Nicole, good to be with you again. Huya Systems, UK-based orchestration platform for identity verification. I think, we've talked before about, effectively determining identities in a digital world. Not only is it super important, maybe even more important than the last 90 days, but it's really hard, and it's a dynamic space. We've known Huya for a couple of years now. We've worked with them in the past. They've got a fantastic platform that allows you to dynamically orchestrate the different changing identity signals that are used to really figure out who you're doing business with. And that leads into your point about the sanctions and the ever-changing world of trying to figure out who you're doing business with, know your customers.
Right, and that's what's so important about the whole thing. So let's backtrack. For someone who doesn't know all the things that Matech helps when it comes to verification and identity and banking and everything else, tell me more about what Matech does, so people, when they walk away from this, say, hey, wow, I learned all about Matech Systems. It's really cool.
Yeah, so Matech Systems, we're based out here in California. We've been a public company for a number of years. most of your viewers would probably know us as the technology that sits in their phone that allows them to take a picture of a check and deposit that in a bank. And that's a fantastic heritage business that we've had. We're executing our strategy to take that technology around computer vision and advanced machine learning and bring that to the identity verification and authentication markets. And so, as we've talked before, about a year ago, we tilted up $150 million convertible debt offering, and we've been out there not just organically growing and investing in our innovation, but finding things that would be very logical for our customers to consume to be able to prosecute, kind of this war on bad actors, but as importantly, let their good customers through with the minimum amount of friction when they want to onboard a new customer, a new account.
Right, and for younger folks who are getting involved and they click on everything, every QR code, and it's crazy what they are willing to do with their phone and their personal information. And we try and guide our teenagers not to rush to put that identity stuff in so quickly. I mean, you can understand that. So now, what are some of the biggest things that you have to combat on a regular basis? And how do you also use those tools to fend off competition?
Yeah, I think we're probably, of a generation where we understand on the dark web, just about all of your personal information is available out there, whether that's the knowledge-based authentication clues about, mother's maiden name, pets, your first pet, all of that, as well as your social security number, a lot of your credit information, your address, date of birth. These are the data points that bad actors, criminals, organized criminal groups can put to work to basically create new identities, synthetic identities, and really, hurt consumers, but also put a pretty big hurt on the financial institutions that are opening those accounts and letting them have access to things like loans and credit cards. Your point about, the younger generations is interesting. I think for a free t-shirt, you can get just about any piece of relevant current information that you would ever want. And in there lies the challenge, right? For a business, for a bank, how do I onboard new customers? How do I prevent bad actors? And how do I make it not so frictionful that it becomes a real pain in the butt or something that's a hardship to open a new account?
Yeah, and I think you make a great point, right? Anything for a free t-shirt. I've seen people line up here for free stuff all the time, but they don't have to give their mother's maiden name. That being said, tell me about some of the other things. As we talk about online commerce, you mentioned crypto, NFTs. Where does this all fall in there too? Money laundering is also an issue. Tell me a little bit about some of that so we can hear the juicy details too.
Yeah, I think this is a very prevalent and growing problem where you've got these organized criminal rings, some of them state-backed actors that are out there. In essence, they're not just money laundering, but they're really, some of these folks are under sanction. Some of these organizations, some of these individuals are under sanction, and these ill-gotten gains are not only avoiding the taxes, but they're going to some really bad projects that we want to avoid. I think when we poll our customers, not just in the last couple of months, but in the last couple of years, they understand they have a statutory and regulatory compliance requirement that we can help them with. But they also now have a social responsibility. They recognize that when they get beat, when they let these things happen without the right amount of governance and the right amount of oversight, that it's really bad for their reputations, right? So there's reputational risk for the banks and the financial institutions, the fintechs. You mentioned crypto, NFT, now betting and gaming, right? The idea that you can do online gambling. There's an increased pressure from regulators, but there's also an increased pressure from the consumers that are paying the price for this.
Yeah, it's wonderful to see you again, Max. Congratulations on the latest deal and continuing to grow in this important space. Max Carnecchia of MyTech Systems, thank you.
You got it, Nicole. Good to see you. Thanks.
You too. Up next, it's time for the Disruptors. Tom White is here with today's company, Array Technologies, after it reported its earnings with some good sales and raising guidance. We'll have all the details, and Tom will have an example trade for you as well.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy. A measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Welcome back to Trading 360. I'm Nicole Petalides, live at the New York Stock Exchange. It's time for the disruptors now. Tom White is here with today's disruptor company and its Array Technologies. I'm sure you've seen it on the move. Tom has all the details on at least some good sales numbers and raising guidance. Tell us a little bit about the company.
Yeah, Nicole, the stock's basically flat now, but it did pop post earnings. They did beat EPS estimates on adjusted basis of 6 cents, and revenue grew by about 22% year over year for this company that creates a lot of the mechanicals for solar fields, right? They have their Smart Track technology, which is using machine learning to kind of position solar panels based on a lot of the historical weather and energy data as it moves around. Now, the stock did get upgraded today out of Guggenheim. They did state that the pullback that we've seen, it's down 31% so far this year and down over 50% from highs that we saw last year. So maybe a buying opportunity here. JP Morgan also came out with a note saying that acceleration in margins remains on track as they get rid of some of their low margin backlog. Now, they do have some headwinds in this particular space, and that's going to be based on the China solar panel manufacturers getting anti-dumping violations against them. So you see that low margin part of their business that's kind of getting waned off of their balance sheet at this point. So they see a reacceleration of margins heading into the next year. They did see fiscal year adjusted EPS a little bit above expectations, but revenue, I think, is key for this company moving forward. They see fiscal year 22 revenue about 1.5 to 1.7 billion versus about 1.4 billion estimated on this particular company. Also, the company announced that its CEO change takes place on April 18th. They have Kevin Hostetler, somebody from outside of the organization coming in to kind of right the ship. But you see there from the chart, Nicole, this one's been under pressure, but it's in that decarbonization realm that a lot of firms and investors are starting to get into. So not sure if this is going to be the bottom here, but it was a pretty good earnings report out of Array.
Yeah, I think that's a great summation, and what Guggenheim had to say about it, and just being in the right place at the right time for what we need, and revenue probably on the rise going forward, as you noted, with that range being higher than the estimate itself. It's not like it was, the estimate was on the lower end of the new range. In fact, it just was right above it. We saw the whole range higher than the estimate. So that was some good news there. And to your point, never really recovered from that high of last year, but has some good things ahead. So, because it had that big gap down when you took a look at that chart. Tell me a little bit, Tom, about the trade.
Well, you have to look at it. It's a relatively inexpensive trade, so just buying the shares outright, you can hold those. It doesn't pay a dividend, so you don't have to worry about that. You don't create any yield on that type of position. So I looked at something in the option market where I can lower my capital requirements for a bullish type trade in here if you believe maybe JP Morgan and Guggenheim, where this stock's going to rebound in the latter stages of the year. You got the overall market down today. That's putting some pressure on here. So I looked at the July option series. So about 100 days until expiration here, you'll capture another earnings event or right close to another earnings event here, where I'm just going to buy an in-the-money call. We'll call this a stock replacement type strategy because implied volatility is falling after earnings, right? The event risk is gone. So option premium that you pay is going to be less than you would have had you done this before earnings when volatility is high. So looked out at the July monthly series, buying it in the money call that acts like stock, right? So I'll buy the 7.5 strike call that's currently in the money by over $2.50. If I pay roughly about a $4.30 debit, it's probably closer to $3.80 at this point because the stock has continued to fall. But if I paid $4.30 for this, my break even is going to be $11.80 over the next 100 days. Now, if I pay $3.80 for this, it's going to be a little bit lower on that. And that break-even point's only about 7 to 8% above the current share price of Array Technologies. So if you expect the stock to start to rebound, maybe get to those levels that we saw 6 months ago or even a year ago, this might be the less expensive way to get into a bullish trade while giving yourself some duration on that in a lower implied volatility environment.
I like that. I like that a lot because, you know, you have this upside potential that you're talking about, and it's not huge risk, as you're saying. And I think, you know, when you talk about solar and AI and machine learning and all that, I think we talk about how people want to be in those types of companies. So I think putting it all together, an exciting example trade there and company for the disruptor today. Thank you, Tom White. Always appreciate it.
Thanks.
That was Array Technologies that he was looking at there. Coming up, ready to dive into Microsoft? One of our panelists has a strong buy rating on the stock. Let's look at Microsoft and get into it here. Coming up next.
Let's walk through charts, one of the most commonly used features on Thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select Time Frame to adjust time intervals or to favorite a time frame. Select Style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
It's a 13-hour flight. That's not a weekend trip.
15 minutes to wait for it.
I'm gonna take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. Ah, they're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make Thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Lichtenstein here with your TD Ameritrade Network futures market update. The selling we've seen off the highs from Monday in stocks and stocks index futures products continue today with the tech-heavy NASDAQ leading once again down over 2% with Datadog, Zoom Video, and NVIDIA at the top of the list of losers. The ES back below 4,500 this morning and lower by more than 1% with investors expressing concerns. Higher rates, a hawkish Fed, elevated commodity prices, and the ongoing war in Ukraine will weigh on growth here in the U.S. and globally for that matter. Deutsche Bank said that they no longer see the Fed achieving a soft landing. Instead, they anticipate the more aggressive tightening of monetary policy will push the economy into a recession. They're calling for the U.S. economy to shrink during the final quarter of 2023 and in the first quarter of 2024. Keep an eye on Treasuries this afternoon at 1 p.m. Eastern. The Fed will release the minutes from the March meeting in anticipation of I should say, and with expectations for the underlying hawkish tone to remain. The TNX spiked to 2.64% ahead of the cash open. The 30-year, that's the TYX, got up to 2.67, and the FVX, the 5-year, maxed out at 2.76. A slight bid in the Treasury futures off lows is about what you'd expect to see as investors seek safety in the U.S. dollar, bonds, and some of the lesser, riskier assets. The greenback above 99 this morning to near 2-year highs. This has been your TD Ameritrade Network Futures Market Update. Now back to Trading 360 with Nicole Pedalides.
Ben Lichtenstein, thank you for that report. Welcome back to Trading 360. I'm Nicole Pedalides, live on the floor of the New York Stock Exchange. It's time for our 360 round. Let's focus on Microsoft here. I mean, we have so much tech talk, so much that has been going on here. But I do want to bring in John Freeman, Vice President, Equity Research at CFRA, and Max Wasserman, founder and senior portfolio manager at Miramar Capital, to have a little discussion here about Microsoft. You know, when we talk about some of these names like Apple, like Microsoft, like Google, it's undeniable that people love it because they think the big picture is so great, that these companies have moats around them. John, I'll start with you. You have a strong buy rating on Microsoft. As I see it now at 300, where do you think it's going and why? What drives it?
So I think my target price is $397. I do have a strong buy on it. So that's kind of where I see it over the next 12 months. And the reason, frankly, is that I think that the cloud growth, particularly of Office 365, of Dynamics 365, of of course, Azure, which is going to continue to grow at 40% plus. It's not going to decelerate that fast. The demand for cloud, cloud infrastructure services is just massive, with this cloud migration that all these enterprises are moving their apps to the cloud. So I think Microsoft is a real, critical beneficiary there that I think people don't really, I don't think people are giving them enough credit for how the duration of the cloud growth that they're going to benefit from. And I see a 15% plus top line growth for the next couple of years.
Yeah, I see what you're saying. And Max, what do you think? I mean, are there more headwinds or tailwinds when it comes to Microsoft? John made a point about some of the other things that, cloud and Azure. I mean, when we thought of Microsoft, it was always Microsoft Office and 365, but really it has expanded in all the things that it brings to the table. What's your outlook here, Max, for Microsoft?
Hi, Nicole. It's good to see you. We have a large position. It's one of our top 5 holdings in Microsoft. That being said, we're a little cautious right now because it's facing, I would say, tough comps. Azure is coming off a 47% quarterly over quarter growth, and we could see tough comps if it starts to decline a little bit. We still like it long term, but this is a company that's trading roughly around 32, 33 times earnings. And with a 5-year average of 27, we think in a rising interest rate environment, you could see this thing pull back a little bit. Long term, we really like it, and we actually like the Activision acquisition because gaming, besides the cloud, could be very strong for them. Gaming could end up being 10% of their revenue in the next 5 years with the acquisition of Activision. But everything was mentioned. We like it. We just think it's rich here. And while we have a large investment in it, we would be more cautious in entering into it at this price. Would you pick up more if it sold off some? And if so, where, Max? Sure. we would be picking up more. We like it more in the 270 to 290 range. We would be big buyers of that, just because we think the long term it should be, you know, a 390 stock, maybe 400. This stock is so incredible with a wide moat and everything it's going into it, and augmented reality, virtual reality.
Right.
It's hitting on all cylinders, but it's coming off very strong comps, and it's priced for perfection. So we think at a rising interest rate, the investor would be prudent to be a little cautious here, add a little bit under 300, but maybe get more aggressive. We would be more aggressive buyers in the high 270s.
Right, right. You know, and here's the other thing, and I was glad you brought up gaming, because that was my next question as I was going through John's CFRA note, where he was looking at AR and VR here and upside potential with that. But since we touched on that already, I want to bring in any other elements, you know, that, John, we may have left out. I mean, I know the Xbox 360 is the best thing ever, you know, since it's read, according to some of the teenagers. They'll tell you that. But, you know, what else are we missing as far as competition or growth? John, what else did you want to touch on?
So I like the gaming part of it too. In fact, I see it synergistic with the cloud. Because if they are able to, move a lot of the, you know, Xbox Live, obviously that's already, you know, running in their data centers, but a lot of the Activision stuff, and really sort of build their own, for lack of a better term, I don't like the term metaverse, but, you know, like a interactive 3D sort of environment and platform. There are both entertainment related and non-entertainment related opportunities there. Yeah, I don't know if they come to fruition in the next, you know, couple of quarters, but they are absolutely very real in the long term. And I think Microsoft, you know, when people get to realize that, it'll get more fully valued, more credit for it.
Yeah, I like that you both have 390, 400 as the outlook here. Good for folks who have 401ks and IRAs. Max, final thought here as we, you know, expand it out to tech overall. Are you loving tech overall, or is it really a case-by-case looking at Microsoft?
Well, we're dividend investors to begin with, so we like the larger dividend growth stock. And we think, to be candid, this market's very rich in technology, and it's been big winners, so we would wait. To go back to your previous question of a revenue stream, you know, Microsoft has about $15 billion in security sales, which is up about 45% over the year. And as more problems with security on the internet, on the cloud, that's another big area for Microsoft as people upgrade their services with Azure, which would be very helpful in the long term. So I think another area is security for Microsoft.
Right, yeah. And, you know, as we look at cloud and we think of all the other names, John, I'm sure you cover a lot of names. Any others that seem to be winners because they're in the right place?
Yeah, you know, okay, so I really like ServiceNow. I like Atlassian. But one I'll give you that I'm really excited about. It's a smaller, perhaps a mid-cap name, is Manhattan Associates. They're the sort of one of the leaders in supply chain management applications that are just now moving to the cloud. And Manhattan Associates, their cloud offering is getting rave reviews from both industry analysts and end customers. And, you know, it's growing at a 50% plus clip and is now over 20% of total revenue. That's, I think, a very interesting one that may be underappreciated.
Somebody else picked Manhattan Associates this week, too. It's not a name we talk that much about, and here it is on our radar twice in a couple of days. Nice to see you both, John and Max. Excellent. Thank you. John Freeman, CFRA, Max Wasserman, Miramar Capital. Great conversation there on Microsoft. Thank you, friends, for being with me here. 11 a.m., Trading 360, 2 p.m. I'll see you for the watch list. I'm Nicole Petalides, live from the New York Stock Exchange. Keep it right here. Fast Market is next.
Let's walk through how to analyze a company's financials on Thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade network.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade network.
Let's walk through charts, one of the most commonly used features on Thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Good afternoon, traders, and welcome to Fast Market. I'm Tom White, and we've got a great show lineup for you today, including discussions and example trades in Microsoft, which is falling with the overall market, and Uber on expanding its super app ecosystem. And like Folio, we'll break down consumer sentiment data on Constellation Brands ahead of their earnings tomorrow morning. Now, 2.5 hours into the trading day, stocks are extending yesterday's slide as rates soared to 3-year highs as investors bet the Federal Reserve is about to aggressively tighten policy to fight inflation and, in turn, slow the economy. Investors are preparing for minutes from the Fed's most recent meeting slated for release at 2 p.m. Eastern Time today, which could impact investors' outlook and offer new clues to the Fed's plan to reduce its balance sheet. Now let's take a look at the 4 major indices today, which are all deep in the red, led by the NASDAQ 100, which is down over 2%. The S&P 500, the benchmark, down 1.1%. Dow Jones Industrial Average down 0.6%. As I mentioned, that NASDAQ 100, the tech-heavy NASDAQ 100, down 2.25%. And the Russell 2000, the small caps, down 1.43% on the session. But to help me break down this market action, we're going to bring in my co-host Kevin Hinks in a minute. But let's go to Nick Theodorakis, Managing Director of Financial Risk Management at TD Ameritrade, to give us his take on the markets. Nick, we've got a rising interest rate environment. We've got Fed speakers that are coming out that are typically pretty dovish, coming out on the hawkish side. It started with Brainerd yesterday. We had Patrick Harker on this morning. Fed Governor Daly yesterday after the close, kind of pounding the table and setting us up for maybe some interest rate hike spikes that a lot of the market wasn't expecting as early as Monday.
Yeah, that clearly to me, Tom, is the driver here. You know, we were talking yesterday, I think I was talking with Oliver about it. You know, there's just this sort of, the markets are working, right? Like when rates go up, sort of things happen. We still have 5 sectors in the positive today, right? You look at the S&P sectors, out of 11 sectors, 5 are in the green, even though the NASDAQ is down, over 2%. So just a pretty amazing, sector rotation. And I think this is, to your point, just squarely driven by rates and by that hawkish tone and the level of which that hawkishness has kind of crept into the entire, group of Fed presidents. I think it's pretty amazing to see that now. And everyone is saying, hey, we're on board with this. That's fine. My personal take, I'm always a little bit of a contrarian, I guess, but I'm a little concerned that they're going to tighten so much. They're going to let the balance sheet run off. They're going to, all these things that are going to equal, quantitative tightening in the face of the fact that inflation is really being driven by a supply problem. So it's like, we're going to tighten monetary policy. We're going to curb the amount of liquidity out there in the world. And then you have things like, additional sanctions on Russia, specifically, I think in the energy space. Coal now is on the table. And as energy gets tighter and tighter, all it's doing is driving up the price. If you drive up the price and you have tightening, I think there is a potential for this real kind of seesaw of volatility, and we're seeing that today. VIX back above 23. So there's some uncertainty here in the markets, and I think it's going to be fascinating to see can a liquidity supply tightening stem a energy supply problem. And I'm not sure those two things relate. So how this lands softly, very up in the air. The good news is, like I said, that the sectors are acting like we think they should, right? They're kind of moving in conjunction with the fact that this is an interest rate and energy driven market. So, things are working. It's just not in a beautiful way right now.
Right. And let's bring in my co-host Kevin Hinks next. Kevin, we had comments from Brainerd yesterday that kind of roiled the markets here. And now today, Fed Governor Harker comes out and he's stating that he's acutely concerned about inflationary pressures, sees a series of deliberate, methodical hikes into the year. Hey, man, where were these guys? And I said this yesterday. Where were they 3 or 4 months ago when every economist on the street was saying the same thing, and they ignored all this stuff, and now you're starting to get that shock into the equity markets?
Yeah, I read that comment this morning. I'm like, well, thank you, Captain Obvious. I mean, what? Yeah, well, of course. Thank you for chiming in at this late hour on that. So here's the thing. I thought this market had a really good day on Monday. I thought this market was trading a few minutes into the trading day about 47. About 47.88. I think was the high. 40. Yeah. Or 45.78, right? And then Lael Brainerd's comments came out. We're about 1,200 points, or we're about 120 points lower on the S&P since she said that. So that's pretty significant in terms of percentages down. Now we're bracing for 1 o'clock Chicago time, 2 o'clock Central, because everyone thinks this is already going to be a high-intensity release of the Fed minutes, right? You raised a 1/4 point, and you still had one of the Fed members dissent during that. So probably the minutes are going to be a little bit explosive. But, guys, is there going to be the only real question left for today is, once the Fed minutes are released, is there a relief rally? Does it firm up, or does it continue on the downside? That's the thought that traders are bracing for here at 2 o'clock Eastern. What will the effect of those release of the minutes do to the market, or have they already discounted basically the release of the Fed minutes, guys?
Yeah, and Kevin, to that point, with the minutes coming out, I think it's going to, you're going to have probably Fed Chair Powell and his commentary during the meetings probably state his dovish stance and kind of appease the markets a little bit. And I think Bullard's going to be back smoking a cigar saying, I told you so, because everybody's playing catch up with his comments from 2 months ago, month and a half ago, that roiled the market. So maybe that's the expectation that the market has, is maybe, selling off a little bit ahead of those. But we did have a nice run for 2 weeks prior to the last 2 sessions selling off here, Nick. But I think if you look at the positives here, Nick, you've got a pretty good jobs market here in the U.S. Economy is still relatively strong. Consumers are still spending. But then you look at the uncertainties, and you mentioned the VIX up near 24 level. This thing was under 19 just 2 days ago on Monday. Is the fact that the uncertainty, interest rates are going up, the cost for things are rising across the board. Inflation's here to stay, at least for the time being, at least another quarter or two. When you look at that and the uncertainties, is that what investors are getting right by selling off the last couple of days, is that there's too much uncertainty right now, and then you throw in Ukraine and Russia?
It's such a tough, dance to perform here, right? Like, people you talk to are out there, traveling and going to restaurants, and ISM services this morning was really strong. And snapped, I think, a 3-month downtrend there. So you're still seeing expansionary, measures in the economy. So it's not like all the sky is falling, the consumer is not there. I think it's almost the problem the other way, where the consumer's like, hey, right now, going into spring and summer. So I think you hit like the couple of quarters piece, right? We're going to live our lives, right? We're going to go out and do what we're going to do. We're going to travel. We're going to go out to eat. We're going to, go to the theater, pick things that you want that you've been wanting to do for a couple of years. Like, demand is there, right? The measurements of that are showing that the services sector is really, really strong. Well, that's not going to help inflation, right? And then you take kind of the jobs market, like you said, and yes, it's a very strong job market, but I think that's something that they're watching very closely. And Secretary Yellen was on this morning and kind of alluded to some of that too. They're watching it really closely because a ton of job openings, a ton of hiring, great, but it's very, very expensive, and all those jobs aren't getting filled. And you bring all that stuff together, to your point on the backdrop of Ukraine again, like, this is just it's a really tough needle to thread because the demand is strong domestically. Is that going to last for the next 6, 9, 12 months if prices keep going up? Like, that's what they're trying to, I think, thread. And if ultimately they suck all this money out of the economy in doing this, and then demand dries up on top of it, we're gonna look pretty bleak this time next year. I think we got to be really. I think that's what people are trying to prepare for. If we're really hiking rates, how quickly, would they ever unwind that if the growth really slows? Yeah. And they obviously don't know that. That's the balance they're trying to strike, though, and that's why there's so much volatility, because nobody knows how it's going to shake out. Right,
that's true, Kevin, and we've mentioned that on the show over the last couple of months, is that the Fed hiking in a rising interest rate environment where we haven't had inflation for 40 years, we've got it, and we've got it good, but at the same time, this is that uncertainty that you're looking at in a rising interest rate environment where inflation's so rampant. And one of the areas that's getting hit, and we saw it with mortgage applications, down another 6% again today in the refinance market. Why would you refinance now when you could have done it 12 months ago? And it was 2 basis points lower than it is now. So is this the cause for concern and uncertainty that you're looking at in the market? And this choppiness that we've seen over the last month or two is warranted at this point?
Well, the housing market and the reaction from mortgage rates today, mortgage applications, wasn't real surprising, right? Mm-hmm. Second week in a row, pretty big numbers, double digits on refinances. That's not real surprising. But you guys are right. Even the most positive person in the world has to realize that there's uncertainty throughout this market. And guys, I'll add one more uncertainty. You ready? Yep. How long? How long is Vladimir Putin, are they going to allow him to do this to Ukraine? How long before something more significant happens there? I don't know how long that'll happen, but man, I mean, some of the videos now and pictures coming out of Ukraine, there's about to be a tipping point there of some escalation. So that could be another bit of uncertainty into these markets. So you've got uncertainty of economic data. You've got uncertainty coming up with first quarter earnings. You've still got geopolitical uncertainty. So yeah, there's plenty to be concerned about if you're watching these markets, guys. Yeah, definitely some humanitarian concerns getting raised over the last couple days. Hearts go out to that country. How long do they let him do this? Yeah, that's the truth, Kevin. And Yellen even made that in her comments today. She said the economic impact that's going to happen and is happening right now
is going to get stretched, and they're very concerned about that as, the NATO and some of the other countries start to ramp up even more sanctions here that'll be released. So that's going to also be closely watched, and I think it puts inflationary pressures in the crosshairs. But one little bit of a reprieve is that we've got oil prices down under $100 a barrel today after hitting 104 earlier in the session. But Nick, one of the areas I kind of wanted to hit on today that maybe has not done too well and kind of taken a back burner, because it seems like in mid to late 2021, all we did was hear about GM and Ford and Tesla and EVs, and the auto sector was hitting multi-year highs on these stocks. But now they've pulled back. Is this the canary in the coal mine that, hey, consumers are pulling back because, one, they don't want to drive, and two, the price of used and new cars, if you can get them, are just astronomical?
Yeah, we're testing. Use GM as the example, Tom. We're testing the lows that we hit when the war started. So that sort of bout of volatility, really, kind of shocked a lot of these stocks. They're down about 35% real time off of the highs. GM trading 40. The low is 39.75 over the last year. So I mean, they're right back down there. There was that sort of pop back, and when kind of the war was digested a little bit. But I agree with you. I think these stocks are, if not the canary in the coal mine, I think just potentially a tipping point for what investors are willing to spend, right? And it's a big ticket item, right? Houses and cars, right, are the two most expensive things we tend to buy. So, if you don't spend 20% over a sticker for your car, you have a lot of extra money to go and do other things with, right? So I think people are sort of taking a step back on these durable goods that they're purchasing themselves. And interest rates are so much higher. You're not seeing those 0% financing deals anymore. So that again, just like we were talking a few minutes ago, goes right to the rising rate environment and its effect on demand. And that's really, really difficult to measure. But I do think that if we see these companies continue to hike prices, I should say, and then you see the used car market doing that, what it's been doing, it's awfully tough to think it's sustainable. And these stocks, I think, are reflecting the fact that it's really not. It's not going to last forever. So. Right. A little bit concerning for sure, but 35% off all-time highs. If you're a value investor, you've got to be thinking, right? There's still the electrification piece that's happening. There's still a lot of positives out there from a manufacturing standpoint. So you can view it both ways, but I think the short-term concern here definitely is just the astronomical cost of a new or a used car.
Yeah. Hey, Kev. MSRP on a car used to be a starting point where you start some negotiations. I heard this yesterday. Now it's the baseline. That's where you start, and you only go higher from there. And it seems like almost people have forgotten about the supply chain issues and getting cars on the lots. You've mentioned this before on the show. You've got a buddy that sells cars, and they just can't get enough inventory on the lots. But with these inflationary pressures, is this kind of reflective where you see GM down 32% so far since the start of the year? All these analysts were raising price targets in November and December for the auto sector. All the money that Ford and GM are implementing into EVs, which we need more now than ever. But your thoughts here on this particular sector, and it's taken a big brunt of the downturn here over the last 3.5 months.
Yeah, my friend in the car business that has 2 GM dealerships and a Ford dealership, he's basically saying he's getting right around 25% of the cars that he's ordering. And so they're hanging on for dear life, trying to make money in service, trying to make money in used cars, and there's just no inventory. You drive by these lots and there's very little inventory in some of these places. So, I think GM is struggling because people are starting to realize that GM isn't putting out any electric cars for quite a while yet. It could be 2024 before any real significant electric cars come out from GM. And that's starting to affect the prices. Remember, the Volte stopped because of fires. So GM, even though they're investing and they claim to be one of the leaders, at some point you're going to have cars coming out. Tesla is getting so far ahead of these other EV makers now, Ford and GM, that you're seeing it starts to take its toll on both these stocks. Prices are getting hit pretty hard as they're just not coming up with the output, and semiconductor shortage is making it even worse, guys.
Yeah. Hey, Kev, I want to go back to you real quick before we get into a discussion about Microsoft. Just real quick, your take on this Spirit Airlines, JetBlue, Frontier Airlines debacle that we're going through right now. I tweeted this out after the news came out after the close yesterday. I said, I don't see how regulators approve this deal. MKM Partners came out with a note today saying this is going to face hurdles across the board because airline prices are at 5-year highs or even more at this point, adjusted for inflation, where people just can't afford to fly anymore if there's capacity at this point. How does this get through, if it does at all?
Yeah, my first knee-jerk reaction when I heard about this merger and that now is my first thought was, where are these airlines getting this money to do these kind of mergers? And
from you and I.
If you're a U.S. Yeah, apparently. So apparently they're talking about an all-cash deal. I don't know where these airlines are getting this free cash flow to do this from. Coming out of COVID, you would think they would be saving their money and doing other things, but here we are. But I think, Tom, the biggest problem is regulators. Yeah. I think you're exactly right. They seem to have the money, so the next hurdle is to get over regulators. I think they're going to have a big problem there.
Well, yeah, the bailouts help from the government, but then also if I'm paying $1,200 for a flight down to Tampa, Florida, that was $350, $400 in 2019, started 2020. So that's where they're getting a lot of their money right there, Kevin. But I just don't see it going through. We'll have to wait and see on that. It doesn't look like it. If you look at the stock prices, they don't agree with it either going through. But let's turn over to Microsoft. One of the stalwarts of the rally that we saw in 2020 and 2021. Stocks down over 10% so far this year. Those all-time highs of nearly $350 are in the rearview mirror from last November, Nick. Your take here on Microsoft, because I've been hearing a lot of that over the last couple days as the market's downturned. You just got to start looking for, companies with healthy balance sheets that are still in, margin expansion, and they're healthy companies, and they've got great cash flow and great balance sheets. Your thoughts here on Microsoft?
I hate to jump back because it's a great intro, but just last thing on the JetBlue, go to when you're in Thinkorswim, put in the symbol SAVE or JetBlue and look at the article that was published 9/19 this morning. Some great commentary from analysts in there about the low-cost provider and exactly what Kev said about regulatory concerns and how much the flight cost differential is there. It's a pretty good read, but gives you an insight into some of those airline regulations. So pretty good, timely comment there, Kev. Microsoft is what is there to say, right? They've found a way time and again to reinvent themselves, and similar to the Amazon story with AWS, right? The cloud kind of tailwind that they caught was just phenomenal, right? So they've really been able to provide so much revenue for their overall business and into R&D because of their huge presence in the cloud and cloud storage and cloud computing, and it's pretty amazing. You're seeing more and more companies across the size spectrum, right? From obviously, if you're a startup and you're running books and records, you're going to one of sort of the three big cloud providers, and there's some others too. I don't mean to discount anybody, but you're looking at Google, Microsoft, or Amazon. If you're a large company, you probably are only looking at those top three, companies, right? It's hard to think that smaller companies are able to meet that scale. So they've got this sort of big company. The hooks in all the big companies, right, from an office kind of perspective, and then you've got startups now flocking to these big companies for stability of their cloud offerings, and that just funnels revenue into this sort of innovation machine. And I think it does allow them to continue to reinvent themselves, and it's a pretty impressive long-term story. So I say this every time we talk about one of these companies in this environment, but clearly they have the balance sheet to make it through this cycle. The question is, how does their business change and evolve, as rates go up, as what's the real impact, right? Are they a casualty of a rising rate environment along with everything else because they're in the tech sector, or do they ultimately shine because they find some other way to to come out of this? And history says these mega cap techs have found a way to use these trying times to strengthen their balance sheets.
Yeah.
It's clearly not going to happen on into perpetuity for every one of these companies, but I think you have to have that lens of like, they're not all tech is the same, right? And there's such a big established revenue stream. Earnings coming up in a couple of weeks. Right. $49 billion in revenue is expected. Like, just they're massive. So right. I think you have to look at it, from an investing perspective a little separately.
Right, and Kevin, if you look at what they're involved in, Azure, their cloud-based business, Windows 11's going to come out. They've gotten good feedback on that. Cybersecurity, automation, gaming, data analytics, metaverse. I mean, they're in everything that is in the growth area, but the pullback that we've seen from those all-time highs near $350, if you take a 3-year chart, Kev, if you want to put that up, I mean, this stock's up nearly 150% from April of 2019. That's a pretty good run. So, is this pullback even matter at this point, because it's just been massive?
When you look at Microsoft, it's worth, its market cap is about 2.3 trillion. You got to think of this like it's a country, not a company. It's got companies within this company that if they were on their own, they'd be massive companies. You just mentioned Azure. How about LinkedIn? How about Xbox? They just acquired Activision Blizzard, or they're in the process of it. But before that, their Xbox, their revenue was $5.4 billion. That's 10% of Microsoft, but it would be like 83% of EA, just the size of that company. So the companies within these companies are massive. And so this is something you really have to look at like it's a much bigger entity than you look at. Look at a flow chart of Microsoft's companies. It's amazing how many companies they own. It's this is really now, I think, the bellwether for the U.S. as an economy, guys.
Yeah. And Nick, let's get to an example trade here in Microsoft. We've got volatility that's elevated in the near term due to the slide that we've seen over the last couple of days. You mentioned that they've got earnings coming up during that week of April 29th weekly option series, but set up this double diagonal that you've got real quick here on Microsoft to take advantage of that higher implied volatility, and volatility maybe remaining firm in the options that you're buying.
Yeah, Kevin and I were talking on Monday about calendar spreads, and I said you could turn that into a double calendar or double diagonal. So this is kind of if you happen to watch that show, this is kind of an add-on to that. But it's basically just doing 2 calendar spreads at different strikes. So what I'm doing is selling the front month strangle, right? So selling the 305 calls and the 297.5 puts. So you have a little bit of a vertical component to that. So a wider range of the front month. And then going out the week past the earnings. So the weekly is not listed yet for the earnings week. Going the week past that and buying the 305 straddle. So you can look at it as two calendar spreads. You can look at it as a straddle, strangle, swap, however you want. But ultimately, you're buying volatility that theoretically will hold up because it's post earnings. Now you have to manage this, right? You have to manage this week because the options we're selling have just 2 days left, and then you're going to potentially roll that forward, which obviously has costs associated with it in terms of transaction costs of continuing to trade options around it. But it allows you to take a long straddle position in the back month, post earnings, so leading up to those earnings, and then if there's a big move on those earnings, right, it could benefit from that, and it allows you to continue to adjust your front month or front week, I should say, that you're selling around that to take advantage of where the stock goes between now and several weeks out. So you get three rolls basically out of this, and end up in a situation where you can manage that earnings risk, and obviously you could close the whole thing out prior to earnings if you didn't want that vol crush to happen.
Right, and you mentioned you're actually buying the weekly cycle that earnings are within, so that April 29th If you pay roughly about a $1,590 debit for that, that's going to be your risk. $1,590 on that. And the biggest risk you have is if it goes above 325. Before then, you mentioned the ability to adjust and sell or buy back your short options in the April 8th weeklies and then roll those to another weekly cycle, collecting credits, increasing potential profitability. But Kevin, when I look at this risk profile, it doesn't look that great, but at the same time, you've got to realize you're buying the option series that volatility should remain firm, and that's why it's flattened out a little bit. You do have that ability to increase the profitability on this risk profile if you can adjust this trade a week to week until earnings and maybe close it ahead of time if there's liquidity. But your take here on this double diagonal that doesn't look as good as it could be.
In terms of teaching options, right? What Nick has done, he's bought his long options, the 305, in the week of the earnings, which we don't guarantee, but you can make a case that there's a good chance or a probability that that volatility may at bare minimum hold into that earnings event. Then you're selling implied volatility against that in the weekly, thus chipping away at that net debit, knowing that you're going to have a big credit when you actually trade into the earnings event. So if this is, and again, there's no guarantees on this happening, but if implied volatility via this double calendar were to uptick in the long month, in your long month, that would be a benefit here. You've got about 36 Vega per one double calendar. So if implied volatility in the back month would go up, that would be even better for this name, and it's got a nice level of daily theta, guys.
Right, break-evens around 293 to the downside and about 307.5 to the upside on that. That can change as volatility levels do change, but basically a 3-week trade here in this particular example here for Microsoft. All right, great stuff as always. That's Nick Theodorakis, Managing Director of Financial Risk Management at TD Ameritrade. But coming up after the break, Kevin and I will be joined by Harrison Sweeney from Lightfolio for discussion on Constellation Brands, which reports earnings tomorrow morning. Fast Market will be right back in 2 minutes.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watch list, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Fast Market on the TD Ameritrade Network. I'm Tom White, joined by my co-host Kevin Hinks, but let's bring in our next guest for our cash tag segment, and that's Harrison Sweeney, a research analyst at Likefolio. Thanks for being here, Harrison.
Thanks for having me, guys.
All right, so we're talking booze. You live down in Kentucky. You've got booze everywhere down there, but Constellation Brands, this is more of a beer and wine-based beverage company. Shares are down about 8% this year. They're off their all-time highs. What kind of data are you seeing going into this report? Goldman Sachs came out with something positive this morning, but it seems like Modelo is driving this company.
Yeah, it's interesting that you mentioned Modelo because that has been one of the major brands we've seen driving demand growth for this company, as well as maintaining its super high consumer happiness rating. So compared to other major distilleries, other companies in this industry, that really has been the Constellation Brands' main source of advantage, is that it's got the highest consumer happiness score out of all the names. And it's still maintaining that, but purchase intent mentions have been drifting lower over the past year. So that's sort of an industry-wide concern that we're seeing right now, is that although Constellation Brands does, as you can see on the chart on the screen, 80% consumer happiness is great for any company. Very few unhappy consumers, and that is a reflection of Modelo and Corona Extra, their two top beer brands, are really that's sort of the bedrock of their company. Makes up 77% of their sales, and it's actually a similar amount of their mention volume as well. So those brands, people love them, but we've been seeing a gradual decline in the actual purchase intent mentions over time, and that's contributing to what's actually become a neutral earnings score. So you can see here on this outlier grid chart, it is in the top half there. It's showing strength against all of those other companies like Anheuser-Busch and Molson Coors, but it is lagging in terms of year-over-year purchase intent growth. And although that could generate a negative earnings score if this had been a recent downturn, Constellation Brands purchase intent has been drifting lower for over a year now. So this decline is expected by our model, which is why the score that we're looking at is actually +6, which is still a very neutral score, but it's on the positive side. So the happiness is able to offset the ongoing demand decline here. And it's really the weakness from the company's perspective is in its wine and spirits. That's been the biggest weight on its sales growth. The beer segment, which, as I said, is the larger aspect, has been showing significant, well, it's decent growth, but not anything mind-blowing, which sort of lines up with what we're seeing here with just the stagnant purchase intent.
Gotcha.
You know, the numbers I'm reading say that Modelo Especial up about 9.7% in sales. Corona Extra up about 15.6% in sales. Those seem like pretty good numbers. Goldman's note out this morning that, you know, they have a consensus estimate around $2.09. Goldman thinks they're going to be $2.21 or above. So, you know, some of your numbers are relatively calm or mild, but yet, you know, in terms of, you know, positive numbers, it's up near the top of the page. What is holding this back? You mentioned wine possibly holding it back. Now, they've got some pretty high-profile brands, not only in beer, but in wine as well. I see Ruffino on there. I see a lot of big names in terms of wine that they have. And personally, for the record, I see Modelo and Corona. My favorite's Pacifico. They're their third most favorite brand. So what's holding this company back if beer is doing so well? Is it just wine not doing as well?
So what's really interesting is we're seeing a general decline in consumers' interest in cocktails, alcoholic beverages. There's a trend that we track that shows mentions of non-alcoholic drinks. And specifically, those are drinks that would otherwise be alcoholic that people are opting to remove the alcohol. So things like a mocktail, for instance. And we're seeing a large increase in these mentions. They're on pace to be at an all-time high in the current period, up over 40% year over year. So this is also mirroring some outside statistics. Nielsen showed a decline in the amount of American adults reporting consuming alcoholic beverages from 2019 to the current year. So this is a broader trend. And as you mentioned, wine and spirit brands, it's interesting. People do not have the same level of brand loyalty that you'll see with things like Modelo, Pacifico, Corona. All of those make up the vast majority of this company's total mentions. And although it does have a diverse portfolio of wine brands, and even I think Svedka is their largest spirits.
Yes, that's their vodka.
Yes, but all of those only make up maybe a combined 20% of the total mention volume. So it's hard to gauge the impact that those are having as far as the drawdown that we're seeing. Now, as far as earnings go, they have struggled a bit with their meeting estimates in terms of profitability, and that's not something that we can necessarily tap into. We are more revenue focused, as you guys know, and this is a company that typically meets their revenue estimates, and I would not be surprised to see them continue to deliver on the top line. Bottom line, there's a lot more question marks. Obviously, they're still facing supply chain headwinds. There's still elevated costs, the inflationary pressures. There's all this stuff is potentially going against them.
Right.
And that's not even mentioning what has been a disastrous investment in Canopy Growth Company. Those shares are down almost 75% year over year, I think. And, you know, the legalization talks they've come back to life a little bit in the past month, but they're going to need to see a significant rally if they want that significant investment that they made to actually stop being just a dead weight on their balance sheet.
Right, and I don't think that's ever coming back, Harrison. It's just like when Philip Morris or Altria bought Juul. They're never getting that value back based on what they paid. Too much competition at this point. But one of the things I wanted to look at the happiness thing real quick here. Sam Adams, down at the bottom, I get it. Their Truly brand is just getting hammered, and it's caused a lot of pain for the stock. But when you have this wide array of different products, just like Constellation does, is that what you're seeing the drag down and why you're only neutral on this stock going into earnings is because, hey, while Modelo and Corona are doing really well, hey, the drag down by some of the wine brands might be the culprit here, because we've seen some of these stocks do pretty decent on earnings and then just fall based on guidance.
So I actually had to look into this before the show because I was also curious about that gap between even Budweiser and Sam Adams. And the culprit is surprisingly the Angry Orchard brand. It's a combination of that legitimate happiness being low, but also within the brand, there is a word that signifies negative sentiment, angry. So those mentions are being overinflated, I would say. So it's not quite as low as it would appear there on the comparison chart, but it is still below where even Budweiser is in terms. And you mentioned that Truly brand. A lot of the seltzer brands are a bit more divisive in terms of happiness. I think it's because it's a new thing and people like to debate about them and put out their hot take about seltzers. So that definitely does detract from their happiness, with Truly being such a massive part of that company.
Right. And I'd be angry if I had to drink Angry Orchard hard cider anyway. So I get that point of it. All right. Great stuff, Harrison. Appreciate it. Have a great day.
You too. Thanks.
All right. That's Harrison Sweeney, research analyst at likefolio.com, breaking down STZ and the data. They're relatively neutral here, Kevin. +8, but we all know, according to Likefolio's data, it's relatively neutral on this. How do you want to look at this for an earnings example trade?
Well, I have two looks, Tom. One a little more aggressive and one more passive. They're both in the calendar spread family. One's the diagonal, one's the calendar spread. First, we'll look at the diagonal because that gives you a little more delta. Look at the 21 delta if we do the April 14th. It's only a 1 week. Actually, it's 6 days. It's not even 1 week, Tom. It's the April 14th, like you mentioned yesterday's show. It's Thursday expiration a week from now. So you've got the April 14th, April 8th, 230, 240 diagonal. That's trading about 470. But if you didn't want that delta exposure or that debit, you could just go with the 240. Remember, the expected move is about 10 bucks. You could go with the 240 calendar spread. And that one is more reasonably priced at only 63 cents. Now, that's interesting because if you look at where it's trading about $8.70 higher than that. The move is about $8, but based on some of the implied volatilities of that front expiration, it's actually giving you a short delta, very small. Now that'll go away quickly if it moves more into that range. So I wouldn't be concerned about it, but this is one that targets that 240 range, more passive. Pretty much a flat delta here on the calendar spread, but if you wanted a little more exposure in terms of delta, the diagonal gives you about 22 deltas, Tom. So just a little trade-off. It costs more money, but you get a little more exposure directionally. Both, although, Tom, are two things. They're both bullish in posture, and they're both, the risk on these trade is 463 on the diagonal and 65 cents on the calendar spread, Tom.
Right. Yeah, let's break down the diagonal real quick here first, Kevin. If you pay 460, that's going to be your risk, 460 bucks per spread. Apex of profitability at that 240 strike. So you're outlaying more capital for this. You have more risk to the downside, and because your debit that you pay is your risk, you're going to have more risk on that particular spread. Now, the less capital-intensive way to get into that same apex of profitability near the 240 strike, buying the 1 week wide 240 call calendar, that's trading roughly about a 70-cent debit. That's going to be your risk, $70 per spread on that with the expectations. The anticipated market maker move, plus or minus $8 on this, so that's right near the upper end of that if the stock does do that one standard deviation move to the upside on that. But break even on the diagonal, about 230. Your break evens, Kevin, I looked on the calendar on that one. Your break evens are going to probably be around 230 and 250. It might have a little wider on the risk profile, but remember, you got a range in there. You're paying less for the calendar spread, 1 week wide versus the 1 week wide call diagonal. All right, great look at a couple example trades there in STZ going in earnings tomorrow. But coming up after the break, we're going to take a look at Uber, which is attempting to become a super app. Fast Market will be right back after this short break.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our Investing Webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now. Ben Lichtenstein here with your TD Ameritrade Network Futures Market Update. Stocks and stock index futures products continue to hold at or near session lows. The Nasdaq's down over 2.5% as investors raise concerns related to higher rates. A hawkish Fed, elevated commodity prices, the ongoing war in Ukraine, and the impact it will all have on growth here in the U.S. and globally. This morning, Treasury Secretary Janet Yellen told lawmakers the goal from the onset in terms of sanctions has been to impose maximum pain on Russia while, to the best of our ability, shielding the United States and our partners from undue economic harm. Keep an eye on rates and the U.S. dollar on the rise into the Fed minutes this afternoon, due out at 2 p.m. Eastern. The TNX at 2.6, the greenback fractionally higher, hanging out just above the 99.50 level. And while the WTI crude is back below 100 this morning after the EIA, they reported the first build in inventories in 3 weeks. They said weekly crude oil inventories increased by 2.4 million barrels. Expectations were for a draw of about the same. Gasoline inventories declined as production increased. Crude back to 99. Futures are down just over 3%. AAA is reporting the national average for a gallon of gas, while down slightly from last week. It's still up over $1.30 from this time last year. Natural gas above $6 this week, up 3.5%, around $6.25. This has been your TD Ameritrade Network Futures Market Update. Now back to Fast Market with Tom White and Kevin Hinks.
Welcome back to Fast Market. I'm your host, Tom White, along with my co-host, Kevin Hinks. Kevin, we're going to switch it up to Uber. Shares are down over 21% so far this year, off nearly 50% from all-time highs that we saw above 64 in February 2021. I never understood that, Kevin. Uber hit all-time highs when we're in the middle of a pandemic. They couldn't get drivers. They lose money on Uber Eats delivery. I just did not get that. Everybody likes this, or, people talk about this company because it is, the starter in this particular group, the ride-sharing business, right? It's on the tip of everybody's tongue when they're using, a ride-sharing service. They've got a competitor in Lyft here. Your thoughts here on Uber? Because there was a report out of the Financial Times coming out today that, hey, you're going to be able to book flights and maybe potentially hotels. Super app coming for Uber?
Why wouldn't they expand this app and try to become more relevant? Because, frankly, though this company started out as the ultimate disruptor, right? What they did to taxis and what they did to ride sharing in general and how people moving from one place to another, it was revolutionary, but they haven't been able to figure out a way to become profitable, right? They've had short stints of good news in terms of profits, but they've never really gotten there. Last month, they added New York City taxi cabs onto their Uber app in New York, and they hope to do it all around the world. That's another significant advancement for them. It makes the stock slightly more attractive. Hasn't shown up in the price of the stock yet, only slightly. But why wouldn't they? If it turns out the diamond in the rough of this company is the app, why wouldn't they continue to expand it and try to earn money via that way? Because frankly, everything else they've tried hasn't worked up until now to become profitable. Delivering food, delivering humans, none of it's profitable yet. And so they've got major hurdles to get there. So why not keep expanding your footprint and bringing in more things, Tom?
Yeah, I mean, think about it. The travel apps, Booking and Expedia, have got to be a little bit nervous here, too. I mean, think about it. You get into a town. I took an Uber this past weekend to and from the airport. And it makes sense, I guess, in that ecosystem. There's reports out today. An analyst came out earlier in the session saying, hey, there might be a partnership brewing, or there should be, speculation only, that Lyft and DoorDash should join forces here, because Lyft #2 in ride sharing, DoorDash #1 in delivery, and DoorDash not profitable, just like Uber Eats on that side of Uber's business. But significant pullback. We did see Mizuho came out with a note earlier this week saying they're positive, keeping a $72 price target. So there's some positive stuff out there. I think it's part of everybody's traveling ecosystem now, especially us living in and around a major city here, Kevin. But I looked at implied volatility, elevated, but not at the highest end that we've seen over the last 52 weeks. They've got earnings coming up in early May, but I just looked at something that you can use to take advantage of. Maybe if you think it's going to go higher, if you think it's going to go lower, you can do that also. But if you think it's going to rally, instead of buying the shares, what type of option strategy can I use to take a bullish stance, right? That's what you have to assess. If you think you're bullish on this name, do you buy the shares? Doesn't pay a dividend, right? So I looked at going out in duration to take advantage of maybe some time in a particular example trade here, Kev, where I'm going to buy the June 32.5 strike call that's slightly in the money at this point, and then selling the June 40 strike call against it, creating a $7.50 wide bullish call vertical. Now, your risk on it is going to be what you pay on this particular trade. Yep. $2.50 roughly, $250 per spread in risk, with the potential, Kevin, to gain another $5 if it's above 40 at expiration. Risk reward setup's good as far as what you pay versus what you could potentially make at expiration. You've got into June expiration, you've got 72 days till expiration, so over 2 months you'll capture an earnings event. Kevin, your take here on this call vertical?
I think that's the key, Tom, what you just said. You've got 72 days, and you basically bought a call for $3.60 and sold a call for a little over $1, and you get your $2.53 net debit with a chance to turn $2.50 into $7.50, right, if this goes to full value. So you've got a relatively low-risk way of tripling your money in Uber if you get a move at or near or above $40, Tom. So the risk is simply what you paid for the spread. This is, after a covered call, this is basically a covered call using options out to June. And so this is a very low debit way to put on a bullish trade with a chance to triple your money, Tom.
Right, Kev, I think if you, on your risk profile, if you hide positions or anything, examples that you might have.
Oh, wait,
there,
hold on. Yeah, sorry.
No,
sorry.
no worries. No worries.
There we
We're
go.
going to make
Sorry
sure.
about that.
Yeah, let's get that back up there, the risk profile, because I think it gives a good visual of this example trade, where if you pay $2.50 on this call vertical, your break even is going to be $35 to the upside. Now, if you look at the price of Uber, it's $32.85 at this point, so less than $2.50 above the current share price, while giving yourself 72 days till expiration on that particular trade. So you only need a few percent to get above that break even. Buying verticals also allows you to close or adjust this trade prior to expiration if the market's open. And that might be a factor that where if Uber goes back up to 35 or 36 and this price expands, maybe you can adjust or close portions of it if the market's open at that point. But good look at an example trade here on a bullish Uber trade on that report of the super app coming down the line. All right, Kev, that's going to do it for us today here on Fast Market. But stick around on the TD Ameritrade Network as Next Gen Investing is coming up with Alex Coffey and Jenny Horn hosting. Have a great day.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network. The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
Let's walk through charts, one of the most commonly used features on Thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select Time Frame to adjust time intervals or to favorite a time frame. Select Style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Good afternoon, happy Wednesday. Welcome to Next Gen Investing. Alex Coffey alongside Jenny Horn. Jenny, a little bit of red for, I believe, what's been the most part of this week. Certainly at least 2 consecutive days here. Another day with the tech sector and NASDAQ leading to the downside. So our market that was at tension may have given way to the downside here a little bit.
Yes, and I think there's a lot of mixed expectations for these FOMC minutes, which are due today at 1, so just in about an hour here Central Time. So I have seen some analysts say that the risk assets could get hit when we get those minutes, but of course we have to wait and see until we actually get them, Alex.
Yeah, no doubt about that, and we may already see a little bit of this weakness, maybe preempting what might be expected by the market. So only time will tell. We got that coming out in about an hour. We got a jam-packed show, though. Tons of stocks on the move today.
Yes, a lot of movers, and not all to the downside, despite the fact that we are seeing a lot of red today. So we will get right to our upvote and downvotes. Then we will chart and trade our upvotes. Our FOMO discussion is no surprise. We are talking Spirit Airlines and JetBlue, that $3.6 billion bid from JetBlue to buy Spirit. We're seeing some mixed reactions from the analyst community, but we will get more into that coming up later. Then we will dive into energy stocks as one analyst sees 45% upside for Occidental. More on that also coming up next. And last but not least, we will talk Conagra Brands ahead of their third quarter report, which is due tomorrow morning.
Yeah, a lot of different style companies, a good mix of different stories here. So, Jenny, without further ado, let's get into upvote, downvote, of course, not endorsements or recommendations.
Yes, we will start things off on a positive note. We are looking at GoGo, which is a stock we have discussed, I believe, on our Under 30 segment previously, but it is an in-flight connectivity provider, so a lot of that Wi-Fi you get while you're on a plane, but also a pretty big deal for a lot of these airlines in terms of connectivity. Now, this stock is up over 8% today. It was actually pacing for its highest close since June of 2015, but it has since given up some of those earlier gains. It does sit about 37.7% off of its all-time high, which was made back in December of 2013, but up 106% over the last 52 weeks from its low of about $10 a share. So we saw news today will replace the XBX flow in the S&P Small Cap 600 index before the opening bell on Friday. Now, what we've seen from this company over the last several months has been pretty amazing, honestly. They reported in fourth quarter 19% revenue growth, with service revenue rising 22%. The CEO has highlighted the demand for connectivity in business aviation and the performance of their advanced platform, which has driven record sales, he said. So they remain on track for their 5G ATG network in the second half of this year and continuing their strength so far year to date, up over 50%.
Huge move this morning. It's faded as the day has gone on, though. It peaked out at 22.27. It's already $1.50 off that intraday high. It's added to this index, and kind of the theory would be, now that it's in this index, funds that are passively attempting to track those things, those particular funds or those particular indices, then would have to buy this name. So there is some thought behind it. That being said, I couldn't tell you the symbol for this particular index. I couldn't tell you a fund that tracks it. It's just not one of the major ones that's being followed. Nonetheless, though, the market likes the news, and it is still up, even with the pullback, over 8% today. Going to say downvote, though.
A downvote. I do know that logo because I've used it while connecting to different, Wi-Fis on flights, but that's pretty much all I do know about it. But our next name today is a firm seeing totally different price action. Couldn't be more opposite, down over 10%, and year-to-date chart, again, very different than GoGo's, down 60% year-to-date. And I swear, Alex, Affirm is a name that doesn't ever just make like a 2 or 1% move lower, it falls. We got two pieces of analyst noise today. Piper Sandler maintained Affirm at neutral while lowering the price target to 58 from 65. But MoffettNathanson actually issued, I thought, was a more interesting report with a neutral rating and a $50 price target. And part of his note was also Toast. And this analyst thinks these two fintech disruptors, whose long-term growth trajectories are likely to disappoint compared to what's implied in their current valuations. He said headwinds include potential higher financing costs and deterioration in the U.S. credit market, and noted that Affirm is a leader in this buy now, pay later space in the United States, but this is a niche value proposition with services rapidly compressing due to their growth runway. So pretty negative on this company, but I do have to say that of the 15 analysts that cover it, things are leaning a little bit more bullish, which actually surprised me. We see 4 bullish analysts, 5 somewhat bullish, 5 indifferent, and 1 somewhat bearish, but no outright bearish analysts on this name, despite the fact that I would say this was a pretty negative report on Affirm.
Yeah, I think we have to take into account its tremendous sell-off that it's had. But I think if we go back in time, this ultimately ends up being a time in financial markets, Jenny, that is a little bit more tumultuous, and maybe we're in some sort of bear market, we'll find. I think a repackaged digital version of layaway, basically tripling in terms of stock price in like a month, might have been one of those signs that things got a little ahead of themselves to the upside, but only time will tell. Nonetheless, though, it's come down from $176 to below 40. It's a different conversation now. For that reason, I'll say upvote.
I agree. And I think part of it, I was saying forever that this service has existed well beyond when we saw this irrational exuberance flood into this name. This is a company that competes with Afterpay, PayPal's Pay in 4. This shows that I shop too much online and I use too many of these services, Alex, but this has existed for quite some time now. It wasn't necessarily a new phenomenon when everyone was talking about buy now, pay later. So an upvote for today. But our next name now is Bank of America, pacing for its longest losing streak since the beginning of 2021. Now it's down 10 of the last 11 sessions and lower for 8 consecutive sessions. And keep in mind, this is one of Warren Buffett's favorite stocks, or it's one of Berkshire Hathaway's top holdings. So it does gain a lot of attention, but they did announce today they are launching the Bank of America Institute with the release of their inaugural publication called the Consumer Checkpoint, which will provide real-time views of U.S. consumer spending as well as their financial health. And they did report something that I thought was interesting, that in the month of March, the credit and debit card spending was up 11% year over year, which shows that consumers really have high momentum in this economy. Now, I'm wondering how this looks going forward, because interesting to track what's behind you, but we are in a forward-looking market, Alex, and I'd like to know more on what we could expect from consumer spending going forward, but an interesting point nonetheless. Now, this is a name that's fallen pretty sizably below its 50 and 200-day moving average as of late. So if you believe that the banks are any barometer for the broader economy, this might be a more bearish sign.
Yeah, and I would also say when it comes to some of that spending data, it's probably not inflation adjusted. So you have to keep in mind that prices have increased pretty substantially throughout that time frame as well, might influence the greater notional value in terms of what's being spent. But I don't think this story is necessarily that important in terms of a real stock mover. So I'm going to say downvote for that reason, but I do tend to agree with you in terms of the barometer that these big banks can be in terms of their visibility into the overall economy. But you hear rates higher, that's usually good for banks, but the yield curve's gotten squashed. That's not particularly good for banks as they borrow on the short end and they lend on the long end. And all this chatter about economic slowdown, possibly stagflation or recession, they're very cyclical companies as well. Not great for them either. So certainly a part of the financial market story that is important. I'm sure we'll come back to it many times in the coming months, but I'm going to say downvote today.
I agree, and I would say what's moving Bank of America is less their news today, more of the broader economy, sort of what you just said, Alex. But our last name today is Peloton. Now, Peloton down 31% year to date, seeing some weakness this week, down 7%. Bank of America reiterated Peloton, though, as a buy and says gross subscribers will be consensus for the third quarter, and said Peloton subscriber and content base are strong assets in the space with advantages compared to their peers to transform the business model under the new CEO. This analyst also thinks very highly of the CEO, mentioning his track record at subscription companies. But Peloton, as we know, we've discussed very thoroughly on this show, down 6% today, has been a bit of a disappointment, to say the absolute very least, for investors this year.
Yeah, I'm going to say upvote. We haven't talked Peloton in a while. It was a star for this market, and it's kind of a dud now. But with all of that, it's sort of been, off to the side. I haven't heard much chatter about Peloton over the last few months, so I'm excited to bring it back to the conversation.
I almost think no noise is good in Peloton, because that means that they don't have any headline risk, because we do know that the headlines around Peloton were not great for some time. So maybe some quiet action is what was needed for Peloton. But we'll move on with both of our upvotes today, those being Affirm as well as Peloton. So to tell us more on these two names is Ben Lichtenstein, the host of Futures. Ben, we will start things off with Affirm. Now, both of these companies, in full disclosure, are ones that I think I spend too much money on, perhaps. But Affirm operates in this buy now, pay later space, which a lot of enthusiasm has fallen off around that. I mean, just to put it lightly.
Yeah, and you can see that in terms of the chart activity. Affirm actually has been trending lower basically since the beginning of the year. Jenny, Alex, I'm really excited about these two examples. Affirm more so than Peloton in many ways, but as a trader, I've learned over the years that trading's more about being able to identify current trends and find favorable price locations to try and participate in those trends or fade them if that's your approach, rather than trying to predict the future. It's very difficult to do the latter ultimately. And this is a perfect example of a market that's trending lower, one that the shorts have been kind of patiently waiting for that favorable trade location. And there's a good possibility that we just reached that point, kind of rolling over right now. So setting up for an interesting next couple days here, possibly, again, in a market that's been trending lower. So we'll continue to watch this. I look forward to talking about it and showing some charts.
We're looking forward to it as well. Ben, give us a quick thought on Peloton as well. Obviously, both these names, high growth names, high beta names. You see the NASDAQ lower, you see volatility spiking. Usually a recipe for these stocks to be in the red, and we see that today.
Yeah, interestingly enough, oftentimes you associate this with the broader market. The NASDAQ, for example, these tech names, they've been coming under pressure. Peloton, no different. Since the beginning of August last summer, we're talking about 128, recently down to 20. We saw a spike to begin the month of February, if you remember, in reaction to earnings. But, with the NASDAQ taking out the March highs, or the Feb highs in March, limited in terms of following through in April, it's interesting to see Peloton was unable to take out those Feb highs in March. So lagging based on the broader market. We'll take a look at some of the technicals, but another market, again, that's been trending lower and coming under pressure, another stock, I should say.
I mean, Ben, you pointed out those recent highs. I'm looking at a 3-year chart. Its high was $171 a share, and now it's fallen below $25. So what a move lower it has been for Peloton. But an interesting name to watch, as it's been on our radar for now several months. So we'll dive more into the technicals on both Affirm and Peloton coming up next. Ben will be sticking around. Alex and myself will also be right back with Next Gen Investing.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The platform demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the watch list at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
All right, welcome back to Next Gen Investing. I'm Alex Coffey alongside Jenny Horn, and joining us here on this Wednesday is Ben Lichtenstein, who's been filling in for Rick Ducat throughout the week, the host of Futures. Always a pleasure to get his perspective. We're going to walk through a couple upvotes here, Jenny. We got Affirm and Peloton. Two names that, man, talk about a dichotomy, this binary aspect in terms of investor sentiment. Neither company could do any wrong, and now it's as if anything they do is wrong.
That is so true, and they both operate in very different spaces. You could say that Affirm, being a fintech player, would benefit from any tech strength. Peloton is more of that at-home fitness. I guess you could make the argument they're both in some ways a tech company, but very, very different in the way they operate in that field. But Ben, both names have been just in a steady grind lower. I mean, Affirm down 5% today. I said earlier, I just feel like Affirm doesn't even make small moves. They either go up irrationally or they go down irrationally. And we saw some analyst coverage today, although the analyst community still seems fairly positive. So what in the world is going on with Affirm? Because what we do know is they're down 60% year to date.
Well, let's dive into the charts here, Jenny. And I want to just begin by saying I think when we talk about price activity, it's important to be very time frame specific. And a pretty good example here, you mentioned how Affirm's been coming under pressure. Before the break, I mentioned since the beginning of the year, we've been trending lower. But, you know, you, during the break, mentioned one of your friends who owns this stock. And I think it's time frame specific and important to understand. If you were to go home today and talk to your friend about having looked at this chart, you'd be like, hey, Affirm's been rallying. I've seen it's been on the move higher. And, well, it has been. But look what's starting to happen. It's rolling over here at a key level. And I'll show you exactly why I think it's a key level and why this could be setting up for a good short opportunity for the bears at this point. And the bulls have to just wait for a breakout at this point, but we're coming off a key area. Now, again, in terms of the rally that we've seen, I want to point out that if you take a step back and look at the hourly time frame, you're going to see that we've reached this kind of key area of resistance, the upper extreme of a range that we've been in after selling off basically since the beginning of February. You've got the upper extreme of 50 down to this 25 area. Now, I want to point out again that if you are looking for a short opportunity, you know, before the break we talked about how trading's not as much about predicting the future, rather identifying current trends, looking for favorable trade locations. Well, favorable trade locations in a trend environment to the downside, as mentioned, this stock has been since the beginning of the year. It comes at upper extreme tests of balances that form or breakouts below a high conviction move out of a range of balance that's forming. And I want to take another step back from the hourly time frame and just take a look here at some of the ranges, the areas of value that we've seen that have been forming at a lower and a lower level. So again, we were just looking at the run up that we saw from 25 up to this 50 level, and I mentioned how we're kind of testing this key upper extreme. Well, you can see again that we're now starting to roll over. So momentum through the middle of this range opens up a door for a retest of the lower extreme, and in a trend environment to the downside, eventually you're looking for a breakout below that lower extreme, again at 25 at this point. So here you can just see some of these areas of value that have been forming at lower and lower levels. And, you know, to the point here, again, as mentioned, when you see these areas of value, if you're looking to participate in the trend of the downside and, again, get on board in terms of some of the price activity, you're either looking to short the upper extreme in a failed test, which it does look like is starting to happen, or a breakout below. Now, if you do get a breakout below this balance area number 3, the working assumption here is that value's moving lower. Well, you'd be looking for an area, in this instance, hypothetical, but an area, for example, number 4 at a lower level. So we're seeing a trend environment to the downside. We're coming off a key area that we just tested, around 50, possibly failing. This is creating an interesting opportunity here, to say the least.
You know, Ben, I don't think my friend who owns this would like to see that chart. It's a pretty clear stair stepper down, just taking out more and more newer lows, lower lows actually, and seeing a pretty sizable move lower today, no doubt. But Alex, say that you want to trade this name more short term. You're not looking to necessarily outright buy the shares. You just want to look at some of the recent price activity. You see the stock down 10.3% today, and you say, hey, maybe we can get any sort of lift here.
I think that it's not even just any lift. I think not just a firm, but in the overall market, what we've seen over the last few weeks is that even if this is a kind of bear market rally, it's been vicious, and the magnitude of the rally has been huge. So if you see that continue, even if this is just a short hiccup these last few days, you could really see some significant upside in the short term in a name like a firm, even if the general downtrend stays intact. And so what I was looking at here is there's a lot of volatility in this particular name, but I wanted to give ourselves a little bit of duration and then pick a spot to the upside that maybe if you see a little bit of a base form, maybe a bounce take place, we could stand to benefit from some sort of recovery rally only to, you know, the 55 level. We're not even asking for a tremendous move in the stock price. Obviously, on a percentage basis, that would be quite large, but in the sense of the grand scheme of the move, it wouldn't be that much. Although it would be, you know, somewhere close to about a 37% or so rally to get back to $55. When I was looking at though the 55 call calendar, we know what this risk profile looks like. Much like a mountain that peaks out right at our strike. 90-cent debit, though, is the key here, Jenny and Ben, as we're looking at a strategy in a name that trades with tremendous volatility, over 100% implied volatility, very expensive options, even with this stock selling off. Getting this down to 90 cents, I think, makes it a little bit more accessible, and we would still perform well potentially with this strategy if it does move higher. It is the May monthly we're selling and buying the June monthly, so we have a lot of duration here. This will be a slower moving trade in the meantime, with the best case scenario being a move to 55 during that, of course, time frame. But I'm going to flip over to the chart here. And so this is the full lifetime of a firm over the last year or so of its trading. This dashed line represents 55. So you can see there's been a lot of activity around that level. If you do see some sort of rally get staged, maybe that's where we could run out of steam.
And you could see it tried to test that $55 level. It's just slightly missed, but as we know that this is a name that's trading so much lower today, it could be tied to the broader market. So really any sort of strength in the market could, you know, in turn, then we could see things reverse here possibly. Obviously, that is always an unknown, but something to consider when looking at a bullish trade with a firm. But now our next name is Peloton. And Ben, I'd like to think that you could give me something positive here, but based off of the chart, 3-year I'm looking at right now, it doesn't look too good.
No, it sure doesn't, guys. Another stock that's been coming off, trending lower, and maybe not in as orderly of fashion in terms of that staircase type pattern to the downside that we looked at as far as a firm. But take a look at the hourly time frame. You'll see a pretty well-defined top left corner to bottom right corner. We have seen some intraday volatility tied to earnings that spike up. But notice also on the 60-minute time frame how the spikes that we've seen have been very short-lived and kind of like a firm most recently since those March lows that we saw on the run-up. We're kind of rolling over here. So again, just exhibiting a little bit of weakness, basically struggling to continue to see follow through the upside. A series of lower highs coming into play as well as lower lows as we work our way throughout. Now, I also just wanted to point out here as we take a look at Peloton in terms of, actually, let's look at this chart for the daily, because this gives us a pretty good look at where things stand in terms of the 50-day moving average. That's that blue dotted line. We're recently retesting it, much like we saw in the beginning of February, potentially another failed attempt to get up above it. Look at RSI. It's kind of rolling over, struggling to get anything going to the upside here and kind of working its way through the middle of the range, potentially opening up the door and leading the way lower at this point. Something to watch. Volume's been kind of coming off, tapering off on this most recent run up. And just quickly take a look at the weekly time frame. Peloton up only 6 weeks since that run up that we saw as we've come off the highs here. We're talking back in June and, well, right back to pre-pandemic levels. So under pressure, to say the least. PTON still is yet to recover, still is yet to reject these lows.
And you can see, I mean, that's a pretty, as much as that was a strong run up, you can see a pretty brutal red candle there, and we have not been able to even rebound any sort of strength. Peloton has been very, very difficult to pick the lows. I mean, that has been something I think that many people have tried, and it has not yet really been so successful. But as always, Ben, thank you so much for your insight, the host of Futures. Now, Alex, when we're looking at Peloton, you know, I am the eternal optimist. I tend to say that they have a very loyal, consumer. Also, there is some stickiness because if you subscribe to Peloton, you're paying that monthly fee, whether you're riding the bike or not. So yes, obviously we can see from that chart that growth got ahead of itself, but perhaps now at these levels, things have started to normalize.
Yeah, and I think you describe a loyal consumer base that is hyper, excited about the product. Some of their greatest ambassadors are just their consumers. But we may have also hit a brick wall in terms of how many new people are they bringing into their universe. So growth might be in question, but maybe somewhere along the way there's a floor in the subscriber base that they have built, the people who have those bikes and other exercise equipments. And so maybe you find this is a more fair price for a name like Peloton. And so I've noticed over the past few weeks and months as it's fallen out of the news headlines, the stock price really hasn't done much. It's kind of bounced around this area, kind of oscillated. If that were to continue, we can take an optimistic approach in the sense that we'll take downside risk for this trade illustration, Jenny. But what we're really going to do here is just kind of bet that it doesn't go substantially lower. And so what we're looking at is going out to May, and we're selling the 19 cash secured put. So we're taking a lot more risk than we typically would. It's going to be the 19 put for $1 credit, which means our break even is $18 at that expiration. That's about $6.75 lower than where we're currently trading in the stock, which on a percentage basis, of course, is quite large, over 20% below where we're currently trading. But that means we have $1,800 in risk. How can we lose that $1,800? Well, once it breaches our strike at expiration, we could potentially become shareholders. The assignment risk will increase. And of course, we have penny for penny risk as if we were a shareholder below that level. And so all the way down to zero is where that $1,800 max loss occurs. So as long as you don't believe Peloton will be out of business, cease to exist in the next 44, 45 days or so until May 20th, that max loss is largely off the table. That would be your worst case scenario, though. And so if you consider for $1 in credit, you can make $100. So that's the other trade-off, is we have a pretty high probability trade as it's over 20% below where we're currently trading, but we can only make $100 on this trade for that full $1,800 we're setting aside. So for some, that might not be enough to move the envelope, but for those who like high probability strategic trades, this could be a way to consider accumulating shares at a lower price. If we flip over to the chart, this dashed line represents our break even, and you can see there's only like a 1 or 2 day stretch in the entire history of Peloton as a publicly traded company that it's breached our break even. So we have that as well on our side.
Yeah, and that's a really good point, because another thing is you would just look at that risk and say $1,800, but perhaps you'd be putting this trade on if you are comfortable owning Peloton, because that is also something I think a lot of people would say, hey, worst case scenario, I end up being a Peloton shareholder, and you have to assess if you're comfortable, of course, with that assignment risk. But that chart, Alex, it's just been difficult to watch, but maybe perhaps things have started to normalize again. I'm always hopeful, but I am the eternal optimist. But that does it for this segment. Now, coming up next, we will shift gears. We will talk JetBlue as well as Spirit Airlines and a potential deal between the two. We'll dive more into what the analyst community thinks coming up next.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Welcome back to Next Gen Investing. I'm Alex Coffey alongside Jenny Horn. It's time for FOMO, and today we're talking a little bit of a possible merger acquisition Wednesday. A lot of times we hear this news coming out over weekends, takes place on Monday mornings, but JetBlue and Spirit, didn't we just talk Spirit getting taken over, or does my memory not serving me correctly?
Yes, by Frontier. That's the other potential bidder, I believe. So we saw this news broke yesterday right before the closing bell, and we actually saw Spirit halted on upside volatility before then resuming trading, closing up 22% on the day. It was more of a hypothetical when the news first broke, or more speculative, I guess, is that JetBlue had actually made a bid, a $3.6 billion bid for Spirit, but they have since confirmed this potential offering. So although we do not know if it'll go through, we do know that JetBlue has made this offer. And what we also know is that the price was pricing Spirit at about $33 a share, which implies a 50% premium to its closing price on Monday prior to this news. And what I've gathered, Alex, is that this was a pretty big surprise. The analyst community scrambled to sort of assess what this deal really means. And what we've gotten so far is that we know this proposed merger would position JetBlue as what they said was the most compelling national low-fare challenger to the four most dominant U.S. airlines by expanding Spirit's growth. Now, regulatory hurdles, I think, are front of mind for a lot of investors, because we know that they could either really stop this deal from completely going through, but JetBlue is prepared to offer a breakup fee if the deal is ditched due to antitrust reasons. Now, The analyst community is less enthused over this speculative deal. Now, JetBlue is trading significantly lower today. Spirit a little bit better, but both names lower. And we saw BofA Securities maintain their buy rating actually on JetBlue, but says the biggest rationale to this surprising news seems to be scale. But they struggle to find the additional benefits for JetBlue, adding this would eliminate one of the lowest fare and fastest growing airlines in the United States. They said that in 2019, Spirit's all-in passenger revenue per flight was roughly $111 a share, which actually seems high because I fly Spirit and I have flown to Florida for $20 from Chicago, which is a steal. But this is compared to JetBlue's average of $182 fare, which would make it difficult, they said, to capture that Spirit customer. Because if you're flying Spirit, again, speaking from experience, because I often do, you are looking for no bells and whistles. You are looking for the lowest possible cost. And this deal could potentially dampen that sentiment. Raymond James also cut their rating to market perform from outperform on JetBlue. And the analyst removed her price target and said, while there may be long-term merit for this deal, execution risk is greater than that was proposed with the Spirit Frontier merger. She said she sees two scenarios: either Spirit goes with JetBlue, taking the highest offer, or or Frontier ends up countering that offer. So it will be really interesting to see if we get any news back from Frontier, who is very much, I would say, on par with the Spirit. They are both the lowest end airline operators, at least from a price standpoint. But, you know, there's a lot of people I've seen today, Alex, that are maybe a little bit critical of Spirit Air, saying they would never fly Spirit. This will hurt JetBlue's image. I fly Spirit all the time. I think it's great. I've never had a canceled flight, and you get a very low cost. So my concern is just the cost. Will the cost go up here? Will this deal actually go through too?
Yeah, I think it just depends on what you're looking for. There's a lot more of these style airlines in markets like Western Europe, where the flights are quite short, and so it makes sense for some of those type of flights. Usually the longer flights, you'll get kind of a bigger airline. But so it's kind of interesting. I see it as two possible choices for a company like Spirit. As you said, they could go for maybe a more optimal synergized approach with something like Frontier that's essentially executing the same style business that they are, and then just build up within that space and try to use some of that scale to reduce some of the internal costs. And then JetBlue comes in and basically gives Spirit a better deal in the sense that they could make more money in the process. But they're probably, based off of what you've said, going to revamp this and just use this as a chance to build JetBlue. So it won't be Spirit anymore. It'll be JetBlue just has a bigger market outside of just the East Coast, which I believe is its primary market at the current moment. I've never actually flown JetBlue, so that was going to be one of my questions to you, was going to be where does this fall on kind of the value spectrum? Where does this fall on the quality spectrum? At $182 a ticket, this sounds like it's much more of a, in the Southwest, American Airlines, Delta Airlines camp than it is a Spirit Frontier camp, and therefore this is more of just an infrastructure, buying the planes, buying the people, buying the spots at the airports, buying the different flight paths. In the sense that it would be trying to just maintain Spirit's brand. But this is just my assessment of this. As for the actual market's assessment of this, and some things that we can look at as far as how the market's interpreting this, well, you mentioned this $33 a share buyout price, Jenny. Well, the stock's trading at $26.34. So there's a tremendous deal premium being priced in here. So be that the regulatory risk you talk about, be that the time that it's maybe going to take for this to actually happen. We know interest rates are rising, so it's going to make that time more expensive. And it may also be saying that, they're still weighing these options. They haven't decided one way or another on which one they're going to do, and that's why you see that risk premium being priced in for this deal. We talk about it quite often, that deal premium, trying to capture that. It's typically an institutional game. Oftentimes when you hear names being bought or merged, kind of takes that off the board. Liquidity dries up, options particularly. And so we're going to focus on JetBlue as the possible acquirer. It's going to exist likely, at least in the near term, regardless if it buys Spirit or not. And so stock's down 8% today, building on a pretty steep down move yesterday, Jenny. Not surprising for a name who's potentially acquiring something to see their stock come down, is they're going to be spending either capital they have or diluting their shares through issuance of additional shares. I know this is primarily a cash deal, so it's just going to be spending money they have. But you can see the trade up here. We're just simply buying a call. It's a cheaper stock, makes the choices for strategies open up a little bit. It's FOMO, so if you're feeling this is going to be great for JetBlue, you want to be involved, we're going out to May, buying the 10 call in the money, spend about $3. So the majority of that money spent is intrinsic real value in that option, as it's fully in the money there. And then a little bit of time premium to overcome with a break even at 13. Key here is no upside definition. We can make infinite amount of money if this were to rally to infinity.
And the upside here is that if we actually get this deal going through and say it passes regulatory hurdles, we could see much different price activity than we're seeing today. I think a lot of the negativity is baked into the fact that maybe this won't go through, and then say Spirit went with JetBlue and they left Frontier out to dry, and then things will look a little bit of a mess for Spirit. But a very interesting story, and I'm passionate about it because I love the low-cost airlines, as that is the way to go with everything being so expensive. But that does it for this FOMO segment. Coming up next, we will talk all things energy, sort of ties into the airlines, but specifically the oil giants and their recent price activity.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I'm going to take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position?
You two are all set.
Choose the app that fits your investing style.
Welcome back to Next Gen Investing. I'm Alex Coffey alongside Jenny Horn. Jenny, we're talking some energy. Let's start with crude oil. Down today, actually, almost $4 a barrel. So interesting, as it's been a very volatile asset as of late. The commodity in many ways driving the action across the board. But after kind of the upside risk of crude oil sort of being what seemed as seen as a risk factor for the market, to see it lower today, yet the market lower, is a little bit of a change of pace from lately, but still very elevated on a recent historical basis at over $98 a barrel for the active crude oil future. So fascinating conversation.
It is. This is almost a FOMO conversation because there is just so much speculation poured into right now the energy market, crude oil, a lot of the other different oil movers, but also the stock movers that have exposure to the energy market, some of those being Chevron, Exxon, Occidental, Schlumberger, and just to name a few that are all actually higher today, which is interesting that we are seeing crude lower, Alex. But I was looking at Occidental specifically. It's up 95% year to date, and it's the best performing stock in the S&P 500 so far this year. I mean, with a return like that, it's hard to deny that that is one of the best performers we're seeing in the market. It's been on an absolute tear this year alongside the rising cost of oil. And Stifel actually issued a very interesting note on Occidental saying this rally could continue, seeing a 45% upside from Tuesday's close with an $84 price target, saying this energy company offers investors attractive valuations and an emerging direct air capture business that will make the company a low carbon leader, which he said is largely underappreciated in these current markets. He said they have the best in cash 2022 free cash flow yield of 26% and believe the pace of the offset market expansion could actually surprise investors to the upside. Another fun fact about Occidental, if you've been paying attention at all to this stock this year, is that Warren Buffett has placed a pretty big bet on this company, which has been pretty unusual for Warren Buffett Buffett, as he's usually more discreet about his purchases, but this has been one that was headlines everywhere because people oftentimes follow Warren Buffett very closely. Now, we also have news that executives from the largest oil and gas companies are testifying today at the House to really discuss their role in setting gas prices at the pump. The hearing is actually called, to quote, "Gouged at the gas station, big oil and America's pain at the pump," which if you filled up your tank anytime recently, you know that pain. But these companies have come under fire for a lot of their profits they've made. And I have to say, in their defense, that in the last 2 years, pretty much any major corporation was extremely profitable. We were in a bull market. We saw things be very, I would say, exuberant to the upside. So it's not just these energy companies that have profited, but unfortunately now, with things shifting, they are continuing to profit.
Couple things. So first off, I know we have this idea that we just have like this magic, on-off switch where it's like, turn the pumps on, start the drills. It's not that easy.
Right.
We haven't updated the infrastructure in years and decades in terms of the refineries here in the U.S. because it's not politically, popular. Let's just be honest with it. The ESG movement has in many ways, kneecapped the crude oil market and the oil drilling market and the refining market. And regardless of where you fall on the spectrum, that's just objective fact. And you look at how much these companies have struggled over the last few, really the last decade, let's say. We saw a kind of commodity boom that went, that kind of went bust post 2008. And it's really been slowly building back up until it kind of crescendos now in some of these crude oil products and other commodities. And who knows if this is the end or not in terms of the price levels we're going to see. But what I can tell you, Jenny, at least for crude oil and what the futures markets tell me, is I have on our platform pulled up a futures market curve. And so what this does is it plots all the different futures contracts out month to month to month to month for whatever product I put in here. In this case, I have the crude oil, light sweet crude, WTI, the primary crude that we get here in North America. And if you remember, over the last, let's say, 4 or 5 years, kind of an average price, let's say, is 40, 50 bucks a barrel. It's kind of where it's been, kind of chopping around. Well, going out to December of 24, which is December of 2024, we have about $80 crude still. So undoubtedly, the market right now anticipates maybe crude oil eases back from this $100 mark, but it's not going back to 40. At least that's what the market's telling us right now. That's where the positions from the professional traders are. That's where the hedges are placed. And with that, that's more expenses for us as an economy, but it also, in a way, could incentivize some more investment into some of these industries that have been very, very neglected from an investment standpoint, not from the individual retail investor or institutional investor. I'm saying from the companies themselves. They haven't put a lot of money back into these particular refineries or drilling or any of the extraction methods because they don't have a lot of confidence in their future with all the kind of political blowback that they get.
Yeah, and that's a really good point. I completely agree. And I mean, who could have foreseen some of the geopolitical tensions that have risen, that have weighed, or I guess benefited some of these companies, unfortunately. But it's also important to look at that long-term crude chart because then you can see really that maybe things aren't as dire as perhaps that you'd see on the news, that you see people unable to fill up their cars. I feel like a lot of times this is almost like a media-driven frenzy, Alex, because look at the historical trends in crude. And I mean, I'm not saying that gas prices aren't high. It's just I do think look at the bigger picture here.
Yeah, I mean, I hear what you're saying. I would also say if you look at history and massive rises in commodities, typically preempt recessions. So you spend more on things than you don't typically. You're going to have less money to spend elsewhere. It means companies are going to make less money. It's kind of this, almost guaranteed cycle. Nonetheless, to go buy shoes at the store, they had to get shipped there. You order it straight to your house, they had to get shipped there. It factors into everything. So we can't stress enough, and crude oil is just one part of the equation. Look at natural gas, look at everything. It's going to be a very interesting next few months and years. It's a completely different marketplace than it was as little as 12, 18 months ago.
It is, and I'd say the energy market has been one that has been key to watch because it does sort of act, as much as the banks we often say act as that barometer, as I said earlier, the energy market is almost more foretelling of what is going on in the broader picture, as energy, like you said, plays a hand into everything. We just talked Spirit and JetBlue. We also, oftentimes look at, different energy prices, and these companies are massive, and they have a massive impact on the market, but also just your utility bills. My utility bill has gone up massively, so all of these things, I think that a lot of investors in the street agrees with you that this is an interesting time, to say the very least.
Yeah, no, I completely agree. Kind of final thoughts here before we take our final break of the show is that, of course, if you want direct exposure to something like crude oil or natural gas or these energy products, going directly to them is going to be your cleanest and easiest way to get those exposure. We talked a lot about the big oil companies. Of course, this is a major part of their business, but they aren't their product. And so that's important to note as well. They're going to have their own individual idiosyncratic issues and costs that they deal with. And of course, that's going to weigh on their stock price performance as well. So you could see crude oil higher. That doesn't necessarily always mean that the big oil companies are going to do well as well. But we're going to take a short break. When we get back, it's time for Under 30. We're going to talk some more commodities as well as we're going to talk some ConAgra Foods ahead of its earnings release. Food prices, energy prices, very much on the conversation of the times right now. We're going to talk a little bit of ConAgra Brands with Ken Rose. Stick around. We'll be right back.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watchlists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
I'm Maria Schrader. Here are a few stories to watch this hour. Cowen downgraded Bluebird Bio to market perform from outperform without a price target, citing concerns about its commercial outlook after Bluebird announced a restructuring plan yesterday where it laid out plans to cut about 30% of its workforce. The analyst adds that Bluebird needs more visibility around its commercial viability. A Morgan Stanley analyst assumed coverage of AbbVie with an overweight rating and a $192 price target, saying AbbVie can succeed with its diversification strategy and deliver mid-single-digit revenue and EPS growth. He adds that investors should be selective in U.S. pharma stocks because of ending patents. And Baird lifted DocuSign's price target to $105 from $182, the neutral rating, setting its positive annual customer showcase. Overall, the analyst likes DocuSign's ongoing digital transformation, product leadership, and profitability. However, he is concerned about recent management changes. This has been your TD Ameritrade Network Market Update. Now back to Next Gen Investing with Alex Coffey and Jenny Horn.
Welcome back to Next Gen Investing. I am Jenny Horn alongside Alex Coffey, and we are joined now by Jeff Pierce, TD Ameritrade Network contributor, to help us preview Conagra Brands ahead of their report, which is due tomorrow morning. Now, this is a company that has a wide variety of brands. I won't even go through them all, but definitely recognizable names at the grocery store, and they're expected to benefit this quarter from people staying at home, still cooking meals, while their food service business is also expected to improve. But Jeff, we cannot ignore the elephant in the room, and that is that everything at the grocery store is so expensive. I've really noticed it in the last few weeks that I don't even know how my bill gets rung up so high.
That's exactly right, and I think that's what investors are going to want to hear more about. The inflation concerns, the cost. We know that a lot of these companies, you think about their competitors like Campbell's, General Mills, have been raising prices. Conagra's been doing the same to try to combat some of these pricing issues that are out there, but they've also had to spend more money. You talked about the demand earlier. They've been having to spend money on overtime, on shipping, all of that to try to meet this demand issue that they've seen over the last quarters. I think that's important too, is looking historically, right? If we look back at Q2, we know that they missed slightly on earnings per share. They did beat on sales. Well, we saw their gross margins decrease 500 points, operating margins decrease 500 points. The CEO even came out and said, looking ahead, they expect continued cost pressures above original expectations, but they did point to consumer demand and cost mitigation to kind of help them overcome those near-term challenges. This quarter, expectations are about 58 cents a share. That would be down a little over 5% year over year. Revenue coming in at about $2.84 billion on the expectation side. That would be up about 2.5% year over year.
Fun fact for you guys both. I started, born and raised Omaha, Nebraska, now live here in Chicago, Illinois. Conagra Foods used to be headquartered in Omaha, Nebraska. Now it's headquartered here in Chicago. So I don't know if I'm following Conagra or it's following me, but I've always thought that was kind of funny. One, it's a consumer staple. So say we do move into some sort of recessionary activity or economic slowdown, we know we got to buy food. And so we have that as possibly a positive reason for investment. But you talked about the cost and the margin pressures. That's particularly where we're seeing the brunt of the inflation, is both in energy and, of course, in food prices, which is their core business. Also, because it's a consumer staple, it relies so much on the scalability of its business. So those margin pressures are really, really important in terms of its ability to pass on the cost. So Jeff, what are some things to consider and other things you may be able to add? Is on one hand, it's consumer staple. We hear that's defensive, but on the other hand, this is like ground zero, the epicenter of where inflation's taking place.
Well, and that's the difficult part with some of these companies that we've watched, right? To your point, people have to buy food. We know that these cost pressures are adding to these companies. When we look at last quarter, certainly part of the outlook, part of the earnings had to do with the Omicron variant, and that heightened demand might have helped out a little bit on the company side, but it did add to the labor and supply chain issues, added to the shortages that we saw out there. On top of that, you've got inflation costs, you've got them spending more money to try to meet the demand that had been out there. That largely, they said that those issues, they were able to resolve in the short term. A lot of that had to do with the holiday season. But they're now saying inflation could be worse than originally anticipated. This company said last time that they looked at gross inflation, that core inflation number being about 14% for 2022. I think what's really important right now, and investors have seen this across a lot of earnings reports in different sectors, different industries, is going to be the outlook, right? If we look at some of the competition, Campbell's is a good example. They had earnings about a month ago, missed on sales, fell in line on earnings per share. Perhaps most importantly, gross margins decreased, and then they reiterated their guidance for 2022. You look at General Mills, you have a very different looking chart there. They're up about 12% or so. They beat on earnings per share, missed slightly on sales, also saw gross margins contract, but they raised their full year organic net revenue growth expectations from 4 to 5%. So those expectations going forward, how companies are going to mitigate some of these costs, the inflation pressure, everything that's out there, has really been important for investors, especially as they start to prepare for if there is any sort of recession or sort of pullback in the market, and they have to start, kind of moving over into those type of companies. They're going to be looking for ones that are showing a better outlook.
Jeff, I'm curious how this name does compete with, say, a General Mills, these other staples, because when you go to the grocery store, I mean, you have your brand favorite, sure, but basically what you're saying is that a lot of these headwinds will weigh on all companies, so does there end up being a winner, really?
Well, and that's another important part of it, right? So certainly these companies distinguish themselves with the products they have. But right now, all of these companies, for the most part, have been raising prices, and they've been leaving the door open to raise prices more. I mean, you talk about prices for ConAgra, they said in the second quarter were already up 3 to 10% compared to a year ago. You look at Campbell's, them talking about prices being up in the low double digits in terms of core inflation for the full year. So now you've got consumers out there going to the grocery store and perhaps changing the way that they buy, right? Looking for the lowest prices available. And that could really start to equal out for some of these companies where raising your prices investors like, but consumers may not like as much.
That's a really, really good point. I think there's a good chance, too, that there's a market read-through from this earnings event as well. Thanks to Jeff Pierce, TD Ameritrade Network contributor, for breaking that down for us. For Jenny and myself, thanks for tuning in. We'll see you tomorrow. The watch list is coming up next.
Just getting started. TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our Active Trading Webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
Welcome to the Watch List. I'm Nicole Petalides, live in New York City. Thanks for being with us. It's 2 p.m. Eastern Time, and we're coming to you live from the New York Stock Exchange. Quick look here at the markets. We've seen selling in red all day long. We are off the earlier lows, but still down in a decent way here for the downside. You can see the Dow's down 208 points, 34,432. The S&P down 48 at 4476. The NASDAQ losing more than 2% today, down 300 points at 14,499, and the Russell is down 1.3%.
In today's top story, the U.S. has announced a new round of sanctions on Russia. President Biden will sign an executive order prohibiting any American from making investments into Russia, whether they are living in the U.S. or living abroad. The sanctions are in response to evidence suggesting Russian troops have committed war crimes in Ukraine. The White House also announced sanctions against individuals, including Vladimir Putin's daughters. I'd like to take a closer look at the big picture here. Ben Lichtenstein is with us, host of Futures here on the TD Ameritrade Network. So we're getting all kinds of headlines, right? The minutes, the FOMC minutes, watching for that. I'm waiting to see any reaction on that. Obviously, the big news on tougher sanctions on Russia. What are you watching?
Yeah, we're watching minutes, sanctions, as you mentioned, and really, Nicole, how this market just continues to be headline driven. I'm actually looking at the NASDAQ right now, which continues to hold down around 2%. It's off the extreme lows that we saw earlier this morning, which we saw down to that 14,420. But we're getting some comments coming across the wire right now. Looks like the Fed's agreeing on about 95 billion in terms of running off the balance sheet, 60 billion in treasuries, 35 billion in mortgages. So again, we're hearing about they're expecting to run this balance sheet off and to phase out some of the caps over a 3-month period. So it does seem like, again, what we've been expecting to hear is kind of this hawkish tone. Take a look at the ES, the NASDAQ, the Dow, the Russell. You can see all 4 majors have been and continue to be, again, in negative territory. Now, it looks like Fed officials are saying that they're comfortable with the monthly caps or no monthly caps. So again, it's interesting to watch here. It'll be key to see as the market digests some of this information. We're actually getting a little bit of recovery here. You can see the NASDAQ's trying to trim some of the losses down by about 1.5% right now. So, you know, one of the things that the Fed's been, it seems like practicing, Nicole, has been kind of walking back some of those concerns. I just want to move away from the 1-minute time frame here, though. Take a look at the 60, because you can see how we just recently rolled over to key area of resistance. We were talking about how in the month of March we were able to take out the Feb highs. But again, you can see that follow-through has been somewhat limited. Here's the Feb high, again, up around this 15,100 level. We got up to 15,200 or just above it and have come off since. Now, I do want to point out the NASDAQ's holding above the 50-day moving average, but again, currently holding, well, below the 200-day moving average. So again, a pretty good reflection of what we've seen this week in terms of rates to the upside and, again, the impact that has on some of the tech shares' growth expectations in general.
Yeah, I think it's fascinating how the market is moving on the heels of the minutes. I mean, you'd think they would know and already have heard a lot of this. This has already been translated to us, much of it. But, you know, maybe it's just that several members are saying one thing, several members are saying another, and this brings, I guess, at least some clarity. And so we are seeing the markets come off the lows. I think the NASDAQ was the most fascinating because it was down over 2%, and here it is down less than 1.5%. So a 0.5% move there, recovery off the lows that we'd seen just moments ago. Also watching bond yields. I mean, we've been talking about mortgage rates on the rise, bond yields that have run up. Tell me a little bit as you take a look here at the Treasury market.
Well, we have been watching yields, Treasury futures for the most part to the downside. Again, yields to the upside and continuation of the pattern, the trend that we have been seeing basically since the beginning of the year. And, you know, it's a hawkish tone, it's geopolitical tensions, commodities on the rise. But when you see rates on the move to the extent we've seen this week, well, you can expect to see the indices start to take notice, and they have. We just looked at the NASDAQ coming off and back down below 15,000. And while we're off the lows from the session, here's what's been really weighing on sentiment, and it's a reflection of the expectations that the Fed, again, is going to have to act a little bit more aggressively than initially expected. Treasury futures to the downside, so this is the bonds, the longer dated, all the way down to 144 this week. Nicole, take a look here, though, as we just bring all 4 of the products into view here. You've got the bonds in the top left corner, the 10-year in the top right. The bottom half of the screen is the shorter dated issuances, so the 5 and the 2-year. And again, you can see here how they've been trending lower. Now, one thing we've been talking about here is that shorter end of the curve. In this instance, we're looking at the 5-year now. So Treasury futures to the downside, as we were just looking at, means rates are to the upside. Look at this. The 5-year spiked today to 2.76. You've got the 10-year in the middle at 2.64, the high today, just off that at 2.57 right now. And the 30-year on the left here, again, a longer dated actually did start to participate this week. It's up above 2.6. And then lastly, I just wanted to point out here, we've been talking a lot about the yield curve And we'll look at that in just a second, the 5 versus the 30. But I did want to point out the dollar's really been strengthening up here as well. I have it in the purple line in this instance. It's trying to break out with rates on the rise. It's been a while since we've seen the dollar and yields on the move higher. Take a quick look at that yield curve inversion we've been talking about. A lot of people focus on the 210. I like to watch the 530, but yeah, it does sound like the Fed held off on a 50 basis point rate hike back in March because of the Ukraine invasion. And again, they are agreeing to reducing the balance sheet. It looks like $60 billion in treasuries, $35 billion in treasuries, and again, to phase in some caps over the next 3-month period. So a lot going on here, lots of news hitting the wire, and the market's reacting to it.
Yeah, excellent, excellent. $60 billion in treasuries, $35 billion in mortgages, and you know, agreeing on the $95 billion for a monthly runoff. And I think it's interesting how the Nasdaq started to come back here. I double-checked to see some of the areas where we were seeing leadership, same as before: utilities, real estate, staples, and healthcare. I mean, what does that say? Safety, 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 and safety. Thank you so much, Ben. Nice to see you. Ben Lichtenstein, host of Futures here on the TD Ameritrade Network. Thanks. Let's take a look at the bigger picture. Mike Skillman is with us, CEO of Faith Investor Services. Mike, thank you so much for being with us. So, anybody you talking to worried about a recession, or are they looking for opportunities?
Nicole, thanks for having me on today. I think a lot of people are worried about everything you've just been discussing with interest rate policy. It's really been driven by the persistent level of inflation and the change in interest rate policy, which is the first time we've seen it in a while. And of course, the geopolitical risk that has added volatility to the market is also a factor. We don't see the most likely case as a scenario right now. So certainly the risk is elevated from where we were even just a month, 2 months ago. But there's still an awful lot good that's going on. So we still think for the next 12 months, there is a play to be made with corporate earnings still being in a good position, the lagging effects of monetary policy still actually working through the system as the economy continues to open from being shut down from COVID.
What do you think about the Fed moving, saying they want to move more expeditiously?
I think actually that's one of the reasons you see the market trading up since the announcement just hit the wire, because I think a lot of people were fearful that inflation was out of hand and there's an unwillingness to really tackle the problem. So I think it's actually a positive for the market if we can get inflation back under control. And of course, some of that's going to happen just from the supply chain working itself out, inventories correcting themselves as a result. So I think the move up in rates is a positive.
Mm-hmm. And I saw in your notes how you talked about consumer net worth being at high levels, and if people feel employed and they've had some wage growth, but on the downside, inflation really hitting folks. And the wonder here is if you have high inflation, even if it's not at the highest point, we're still seeing elevated levels for gas, for example. People have to spend more, and then maybe they might spend less, and then the economy could slow down, and then what does that mean?
Right. Well, to stick with the first point, the consumer net worth is elevated largely because the housing market has been so phenomenal. And I think that's likely to continue. Of course, mortgage rates touching on 5% is going to put a damper on some of that demand. But one of the reasons I still am optimistic about housing is just the shortage of supply. And that's going to take a while to work itself out. Of course, their stock portfolios from a long-term perspective are still elevated. A lot of people saved money during the pandemic, and as you said, employment is still very robust. So no question, people are paying more across the board, not just to fill up their gas tank, they're paying more at the supermarket. Of course, this hits the people hardest that are the least likely to afford it. They, of course, have the highest propensity to spend as well. So that's definitely a headwind. But I think in terms of if you dollar weight that, the folks with the higher end of the economic spectrum are spending money. Perhaps that's shifting less from goods now more to travel, leisure, and other services. So I think there's still net a lot of good news that people are discounting and fearful of right now.
I do want to get to some areas of interest that you think could be more of an overweight in a portfolio. But before I get to that, just the big picture thought here on the geopolitical uncertainty, because the Fed said here in the minutes that they didn't do 50 basis points because of what was the war in Ukraine. And so, I guess they really had thought about 50 basis points, made it 25 basis points. What's interesting is, I think today I heard it's the 7th week It very well could be very much a similar picture on the next meeting. Are they going to do 25 again? I mean, would you be fine with what would you like to see?
Well, I wish my crystal ball were that shiny, Nicole, but I think it's likely they'll move 50 basis points. I think when you looked at the last meeting, this situation in Ukraine was just unfolding, you know, the first ground war in Europe since World War II. I think a lot of people fearful when you have a nuclear power like Russia. With those events, the unknowns, therefore they held off, is my guess. But I think, you know, when you balance that, and I think you read that in the commentary today, with the persistent threat of inflation, I think they're much more likely to move the full 50 basis points. So, look, the unknowns about geopolitical are just that, so hard to fully factor that in. But I think based on the inflation numbers we've seen, they really want to get ahead of that.
Absolutely. I also think it's interesting that they want the balance sheet to be primarily comprised of treasuries, right? And a lot of people are asking why they have so many mortgages in the first place. So it makes sense to me when I hear that happening. Tell me about industrials, materials, and technology. What place do they have in an investor's portfolio?
So if you look at our premise that the economic environment for the next 12 months, certainly not as robust as it's been the last 12 months, but we're just saying we don't think we're going into recession. You know, a lot has been made, and I heard your last guest talk about the yield curve inversion, whether folks look at, you know, long bonds, less, you know, the 2-year, the 5-year, but the old New York Fed model is still the most reliable predictor of recessions, and that's looking at the 10-year minus the 3-month. So that is still significantly positive. And so if you have that viewpoint that the economy is still in a good position, then looking at more economically sensitive stocks makes sense. Hence, you know, our view that industrials ought to be a significant piece of the portfolio. Material stocks, you look at companies like Mosaic in the fertilizer space, look attractive. You know, companies like FedEx look to do well. Of course, the stock down this year, but we still see good opportunity in that. And then technology stocks, it's just such an important piece of the market. You know, when interest rates started to move, you know, high growth stocks got, you know, hammered this year, especially, you know, if you look even outside of technology in areas like biotech companies that have no earnings. But still, there's an awful lot of technology that's going to do very well in this economy. It's a big part of corporate capital spending, technology stocks. So that's the reason why those are 3 key areas. I think because of the uncertainty, it makes sense to have a balanced portfolio. So we don't have big sector overweights in any one particular area. Our investors are, you know, largely faith oriented. That's why healthcare is probably more underweight than some other sectors. But, you know, I definitely acknowledge there are risks in the market. I just think that a lot of people are focused on the bearish argument right now, and we see a little more balanced view, hence our more cyclically orientation of the portfolio.
Mike, thanks so much. Great to have you on with us today, particularly when we have the breaking news of the Fed minutes and all the headlines coming out. So it was a good day to have a chat on all this. Mike Skillman, thank you, CEO, Faith
Thank you, Nicole. Good to see you.
Thanks, Mike. Nice to see
Bye-bye.
you as well. So we're going to continue to follow the minutes, anything that the Fed has put out and what kind of moves they may or may not make going forward. And Andrew Brenner will be joining us to discuss that. Also, Eli Lilly is on our radar and discuss why Morgan Stanley named it a top pick. And our panel is ready to take a look at the energy market. This as the CEOs are there in Washington talking about your gas prices. But up next, David Dietz. He'll be talking about FedEx, D.R. Horton, and some other names that he's watching closely. Coming up.
Let's walk through charts, one of the most commonly used features on Thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
It's a 13-hour flight. That's not a weekend trip.
15 minutes to
Oh,
wait
yeah, I
board.
gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see ya. Ah, they're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make Thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Welcome back. Thank you so much for being with us. This is the watch list. We are live on the floor of the New York Stock Exchange. I think it's worth noting before I get to the big movers, I do want to know what's happening in the market right now. We did see markets start to come off the lows, but now a quick change here as we got each one of the headlines from the Fed minutes. Now we are seeing the selling happening. In fact, we are now at session lows. And it's very important to note that as Treasury yields are moving higher and the NASDAQ 100 is now down 2.8%. The S&P is down 1.5%. After the Fed minutes, we'll continue to talk about this breaking news story. Of course, we have Andrew Brenner coming up for that, and David Dietz is next, so keep it right here. Now I do want to get to some of the movers in the market right now. Talk about Spirit Airlines saying it will consider a $3.6 billion all-cash takeover from JetBlue. Spirit had agreed to be bought by Frontier for $2.9 billion back in February, you remember. Now, Evercore ISI also downgrading Spirit to inline from outperform this morning. Tilray is jumping after swinging to a profit on its non-operating income. It did get a boost from that. Now, the Canadian cannabis producer reporting his third quarter sales increased 23% from the previous quarter and rose nearly $30 million from a year ago. Tilray also provided updated target cost synergies from its Afria deal and reaffirmed its view for $4 billion in revenue by fiscal 2024. Stifel initiating coverage on Occidental Petroleum with a buy rating and an $84 price target. It's at $55 now. The analyst said that the stock remains attractively priced despite doubling due to its largely low carbon business. Norwegian Cruise Lines announcing it is launching the industry's first NFT collection. The company plans to auction off 6 NFTs next week to celebrate the launch of its Prima class of new ships. The first of the NFTs will be auctioned starting at $2,500. Let's check in on Bitcoin. I'm interested to see what's going on here. So it actually sold off further than where it was this morning. So it's at 43,515 for those of you following it closely. It's down 5.7%. Get right to our next guest. David Dietz, Managing Principal and Senior Portfolio Strategist with PPAC Private Wealth Management. David, nice to have you on. We're getting a lot of headlines from the Fed. I have a lot of big picture things I want to talk with you about. But first and foremost, anything from the Fed minutes breaking here that is very interesting to you? This as the markets now come to session lows.
Yeah, absolutely, Nicole. I think these Fed minutes validated what our suspicions were, particularly following Lyle Brainerd's comments yesterday. Basically, that the plans are afoot to start reducing that balance sheet. That's something they should have done, a long time ago. It never should have gotten close to $9 trillion. But, I am looking at the rate here. They're talking about, 95 million, a billion, rather, a month. And I'm thinking that's still 7 to 8 years to wind it all the way down. Now, mind you, they're not going to take it all the way down, but it still seems like a very slow, disciplined rate. Of course, that has not started yet. They have not said exactly when it might start, and that could be changed at any time. So there's flexibility. The other thing I thought was interesting is they talked about 50 basis points last month. They only did 25 because of the Ukraine crisis. And that, to me, suggests the Fed's still on our side. So if something comes up, all bets are off as to what they want to do with monetary policy. What would happen if the war spread to Western Europe? Would they say no rate hikes? So it's going to be interesting, but I'm still we're still trying to grapple with all that.
Very interesting. That's fascinating because we really heard, as we heard from Lyle Brainard, and really that growth could be sacrificed here in the States just to get inflation intact, but and that the Fed doesn't worry about what the markets are doing. But to your point, maybe because it was just so fresh. I wonder if it were to expand or something. I like the idea that the Fed could be on our side. I mean, I guess for people who are along the market, but I think that's an interesting point. I never really thought about it that way. Let's get to some of your other stories here that you're looking at. How are you going about what you're picking in portfolios right now?
Sure, absolutely. So, the biggest concern right now, of course, is the United States economy ultimately going into recession? And we've had one bank, Deutsche Bank, recently said that within the next 24 months we will. I think Goldman Sachs has already made some noises there. But I'm looking at certain sectors of the economy. I think they've already priced in a recession. So to me, that's when you want to start rolling up your sleeves and start doing your research because, as they say, the stock market has priced in 10 of the last 5 recessions. So it's already priced in. It may or may not happen. We don't know what the Fed is going to do. I just pointed out that a year ago, Lyle Brainard said nothing when everyone said inflation is going to be transitory. Now, all of a sudden, she's very, very hawkish. What will she do a year from now? No one really knows. So we're looking for areas that have been already smacked down and have very good valuations, and the odds are skewed towards a rebound if things are just a little bit better than the most dire forecasts.
Okay, now I'm interested in why your bank stock pick is Wells Fargo, because yesterday we had a great bank panel, and they both seem to be staying away. In fact, one said to stay away from Wells Fargo. Both of the guests picked Citi. One picked J.P. Morgan, the other picked First Republic. But a warning on stay away from Wells Fargo. Why are you the contrarian here and saying, I'm getting in there?
Yeah, absolutely. So Wells Fargo is probably your premier domestic bank, along with Bank of America, is not focused overseas where a lot of the turmoil is. Of course, that's where the fighting is and so forth in the Chinese lockdowns. And they're also focused very much on middle market. They're not so exposed to IPOs, to investment banking, to bond trading, and therefore some of the weakness I think some of the banks are going to report in that sector of the market, they can sidestep. They're still, of course, handicapped because they have that asset cap in place. I think that may well be lifted, probably not before the midterm, but shortly after that. The stock, of course, is down 25%. That's where all the banks are down pretty much. But remember, we were told at the start of the year banks were the place to be because higher interest rates allow them to lift the rates on their standard product, which is loans. So I think people are kind of missing the boat there. There's been some concern, of course, over the inversion. But of course, if in fact inflation gets worse and people start seeing it as a longer term thing, I think you're going to see that 10-year and the longer duration bonds start to rise faster than the shorter duration ones, re-expand, a margin there. And I think that's going to be good for banks.
Okay, and how about let's move to housing. You have D.R. Horton. This is mortgage rates have really shot up. I saw them over 4.5%. Tell me about your thoughts. Are we worried about, people are talking about there going to be more supply because more people are going to want to sell as the spring season comes.
I'm worried about everything, but right now the big problem is there's no inventory. All these people want to buy a home, get out of the city, get off their parents' sofa and so forth. There's nothing to buy. So there's still a big shortage. And that trend to have your own home, that's not going away here. Of course, people are worried that, mortgage rates are going up. Okay, they're over 5%. This shows my age, but I can remember when people were paying 10 to 12% for mortgages. So 5% still strikes me as cheap. And of course, if in fact inflation's knocking on the door of 7%, that's still a negative real rate of a mortgage and so forth. So that strikes me as good. Of course, D.R. Horton is the class act. They have great offerings in the entry-level sphere. And, the fact of the matter is a $70 stock, they should earn close to $16 this year. That's about a PE of 5. The overall market is 20. So a lot of the concerns and cyclicality of the home builders, I feel, is priced in. This is the time to take advantage of that 40% discount and step up to the plate.
And last but not least, you still have Pfizer and FedEx. I only have time for one. I went to FedEx twice in as many weeks. I've been keeping FedEx in business since my son went to college, pretty much. But you tell me, FedEx, Pfizer, these are names you like as well. Talk about one of them.
Let me go with FedEx. I think the one theme that no matter what happens with interest rates or Ukraine or whatever is we're going to be buying more stuff online. That e-commerce boom is getting bigger and bigger, and it's spreading out beyond just Amazon. You got companies like Shopify helping all retailers get involved. But at the end of the day, you got to get the package from point A to point B. We basically domestically have just two ways to do that. That's UPS and FedEx. FedEx is trading, well, they should make $20 a share this year. It's about a $200 stock. You're down by about a third, and you just can't replicate the type of network they have to integrate their air fleet, their last mile and on the ground service. So I think there's a lot to like in FedEx, and you got a great discount to step up to the plate and make some money over the next 12 to 18 months.
Hi, David Dietz. Always wonderful to see you. So glad you always make it on the show. We appreciate it. David Dietz, PPAC Private Wealth Management. Thank you.
Thank you.
Coming up, we continue to watch the reaction of the markets to the Fed minutes, and yields are rising higher for the fourth day. In fact, now at the highest levels in 3 years. We have much to discuss. We'll take a closer look at all of this right after the break.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to the Watch List. I'm Nicole Petalides. Thanks for being with us. We're coming to you live from the New York Stock Exchange. We were eagerly awaiting the FOMC's March meeting minutes, and we've gotten that, and we've really gained some insight into the Fed's plans for the balance sheet and some moves they may make. And Andrew Brenner is with us, head of international fixed income securities at Nat Alliance Securities. Thank you so much for being with us. So tell me, what are your first reaction here when you see everything that they're saying? I know you're very into what they have on the balance sheet, what they're getting rid of, and they really want to move primarily and comprise more of treasuries. Most folks I've spoken to would agree with that.
Nicole, I think they're a little bit more aggressive. First of all, thanks for having me on again. I think the Fed was a little more aggressive here. The $95 billion a month, which they're going to get to over the next 3 months, I think is a little higher than some expected. That's going to give you about $1.1 trillion a year. As far as the mortgage treasury breakdown, the Fed is going to be restricted by how many mortgages roll off. They don't want to sell mortgages right away. So I don't think there's going to be a huge, as much as a mortgage, a reversal as many think, and which is why we started to see mortgage spreads tighten a little bit as I walked into this interview. So that's no surprise. Yeah, I think that this Fed is going to be, these are some very aggressive numbers. I don't think the market's properly pricing in the reduction in the Fed balance sheet, and especially the fact that they're going to let coupons run off first and only go to bills if there are not enough coupons. So I think they're really trying everything they can to steepen the yield curve, to make longer rates much more restrictive. And that is what my early read on these headlines are.
Right, and these other moves, right? We have rate hikes, which are very evident. We understand 25 basis points. They didn't do 50 because the Ukraine war had just begun, and they'll probably do 50 in the next one. But other tools, such as running off the balance sheet in this way, can also be equal to a rate hike, right?
Absolutely. You know, a lot of people have run models of which we don't put a lot of credibility in, but what we're thinking is that about 50. Let's see, 1 trillion is equal to somewhere between 50 and 75 basis points. So that would be 2 to 3 less hikes that the Fed would do based on the runoff of the balance sheet. And which is why my numbers, whereas you see the Goldman's and the Bank of America's 8, 9, 10 hikes, I tend to think it's going to be more like 5, maybe 6. I think the Fed goes 50 in May, and I think between June and July, they go another 75. So you end up with 125 from where you are right now. Then I think the Fed has to wait and see how the markets are going to react. You know, the biggest mistake the Fed has made, and Bill Dudley said this morning in an op-ed, is the Fed is used to fighting demand-side inflation. This is supply-side inflation. This is very different. You know, you don't have to send the economy down to zero. You don't have to send it into recession. You need to solve the supply chain aspects of things. And that's something the Fed can't do. So I think a lot of it is going to be resolved on its own. Of course, you're not going to resolve the Russian/Ukrainian situation of wheat and oil, whatever, anytime soon. But I think a lot of the trucking issues, a lot of the stuff and the chip issues in the United States and elsewhere, I think are going to be resolved. And I think inflation is going to come down 3 or 4 percentage points from that. So I don't think the Fed needs to be as aggressive as they're portraying. Nonetheless, they are way behind the curve.
And they are portraying quite the aggressive stance. I mean, we're talking about hawkish. In your notes, you talked about Lael Brainerd, who really, you said, was one of the last of the doves turning hawkish, because saying, look, we're gonna speed up the unwinding of the balance sheet, and we're gonna have these rate hikes going forward, you know, and do this so methodically. But, you know, this rapid runoff of the balance sheet. So really evident that they want to get inflation under control. But at what cost? At what cost? And how good or bad could that be for consumers, for investors?
Well, first let me say, I've been doing this a long time. And as far as listening to the Fed and watching what they do and watching what they say, you need to watch what they do. You know, so far, it took all the way to March of 2022 for them to raise once, you know, and they kept easing, even, you know, quantitative easing until the second week of March. That's absurd. So the Fed can talk all they want, but the question is, how quickly will they actually act? Now, I think the balance sheet thing is real. I think it's going to be automatic, and I think it's going to have much more of an impact on markets than people believe, and on financial conditions than people believe. And I think it's going to hurt stocks, but it's not going to hurt, well, I don't think it will hurt stocks. And I think, you know, the old adage, sell in May and come back in the fall, is probably going to be somewhat of a precursor of what we're going to see. As far as, is it going to hurt people? Absolutely. No question about it. You know, a lot of people want to go against the anti-wealth effect, but I think it's going to be more than that. And the last thing Powell wants to do, they just spent 2 years getting employment back to where they want it. The last thing they want to do is reverse that. So I think the Fed will be less aggressive than they're portraying. And yes, Brainerd was by far and away extremely hawkish yesterday. But I'm still not 100% under that impression that they will do that.
Understood. And you know, the truth is, if they do over $1 trillion a year, as you said, that could count as another 50 basis points. So
yeah, maybe
we'll have
even
much
75.
to discuss this summer. Yeah. So, right. So, I mean, that's a big deal. Wonderful to speak with you. Thank you so much. Andrew Brenner, Head of International Fixed Income Securities at Alliance Securities. Thanks for joining us on the show. Breaking news today.
Thank you, Nicole.
Second half of our show, how about we take a look at Eli Lilly and why Morgan Stanley named Eli Lilly a top pick. Then we'll discuss what sectors investors should consider for retirement planning. Keep it right here. Winners and losers in the S&P 500 for you.
Trading isn't just a hobby, it's your future. so you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Welcome back to the Watch List. I'm Nicole Penelides, live on the floor of the New York Stock Exchange. Today is a breaking news day in that we just moments ago got the Fed minutes and we saw markets really moving quickly. I'll tell you where we stand right now because we are off the session lows, but we did have some volatility where the NASDAQ, for example, was down 2.7%. It started to recuperate, then it sold off. It was down 2.7. Now you can see it's down 2%. 14,523, losing almost 300 points. The Dow is down 200 points, 34,440. S&P is down 48 at 4478, and the Russell is down 1.3%. We also saw bond yields moving higher, in fact, to the highest levels in 3 years, as we get more and more on the Fed spinning off the balance sheet and raising rates. I'd like to take a look here at Eli Lilly. It is trading higher, getting a boost from Morgan Stanley. And to give us all the details, Michael Keeley is with us, contributor for the TD Ameritrade Network, to tell us why Morgan Stanley is looking at Eli Lilly, and some good news here.
They're really appreciating the potential for growth at the firm is the basis for this upgrade here in terms of price target. And it lifted quite notably, Nicole, from the 265 area where they had it formerly all the way up to 364. So that's an enormous shift. And on this very visible day of a risk-off sentiment where investors are selling virtually everything out there, save a few dividend aristocrats and utilities, Eli Lilly is really pouncing on this particular report and showing some strength. And so Morgan Stanley's analysts, there's a handful of them out there, really headed up by Terrence Flynn, who said, top pick here of ours in the pharmaceutical realm. We know it is. And the backdrop, Nicole, is, the growth prospects for substantial improvement on the business metrics on a go-forward basis that revolve around some of the biggest end markets that you can shake a stick at in the pharmaceutical world. Those include obesity, diabetes, Alzheimer's, cancer drugs. These are all thought to be areas where the firm has some very strong potential. And we're not talking about potential into the next 12 to 18 months as much as the potential on a much longer term basis, based upon the drugs that are, in the pipeline right now. So to that point, Nicole, the operating margins are expected to expand in this bull case scenario from 32% at present up to 41% in 2025, putting the firm on pace to deliver a possible $21 in EPS by, wait for it, 2030, relative to the $16 that's anticipated out into 2025. And so when we take a look at the way that analysts have had a beat on Eli Lilly's earnings in the past, they've had a very accurate forecast in the sense that we've had negligible surprises out of the firm in the last 4 quarters. The analysts are very on top of and in tune with what the firm will deliver. But this particular bull case, it's not universal. We've got other firms like notably CFRA that feels as if this is not one of the best prospects out there in terms of the way that they evaluate things. So it's always good as a personal investor to take a look at more than just one analyst's report. But this is catching a lot of attention, obviously, from investors as the stock is making some very strong strides on this trading session where most of the market is down.
Right, and just the fact also that it's more of a long-term play. I think sometimes people like that. They like to set it in and forget it and not have to deal with this on a day-by-day basis. Thank you so much. Michael Keeley, good to see you, contributor at TD Ameritrade Network, taking a good look there at Eli Lilly, a top pick at Morgan Stanley. Thanks. Let's get right to our next guest. Randy Sevchek is with us, President, Elite Group Retirement Services, to give us some, as I mentioned, long-term. This is your wheelhouse as you're talking with a lot of the clients. I mean, they certainly must have had a lot of concerns with what's happened in the first quarter, but you must have set them up with, you know, hedging for some downside risk, right? Tell us.
Right. Well, thanks for having me on, Nicole. It's interesting listening with your last guest there. Is we're in an environment right now where in the next 7 years, when you talk in terms of the long play, is in 2030 is going to be a confluence of really two generations, the boomers and Gen X. And at that point, we will cross over and have 50% of our population at the age of or already into retirement. And so when I look in terms of the different market sectors that are out there, the best way I approach it is through the prism of each individual retirement timeline. So you have to build it from the bottom up, and you have to look at each one of those sectors individually based on two separate sources. So the sources being your vehicle for growth income. So currently in 2030, we will have approximately 2 contributors for Social Security for each person collecting benefits. Back in 1936, that number was 16. And so what that means is that while Social Security, as most retirees have expected it, is going to change in some way. So you're not going to be able to have, if you have more coming out and less going in, something has to change.
Right.
And so with that said, I think that the way that you build your income structure and the way that you look at the market sectors has to come through that prism of each individual timeline.
Yeah, without a doubt, because whether it depends on your age, right? So that being said now, I mean, we're hearing a lot from the Fed, and it's very evident to us the Fed's going to be on track here for raising rates, spinning off the balance sheet, which could equate even at least 1 or 2 more, you know, rate hikes theoretically by doing that kind of move on the side with another tool. So what do you tell investors that really have a very long-term horizon versus those that have a short-term horizon? How about that? Someone who maybe want to be more risk-on and versus somebody who maybe want a little less risk.
Right. That's a great question. And as you mentioned earlier, that goes according to each person's timeline. So you have certain sectors like the materials sector where investors are thinking forest and trees and metal and mining, and right now that's going to seem like a very volatile investment. So what we're telling people is if your timeline is the next 36 months, those are things that you're going to want to avoid, and you're going to want to go into some of the sectors that are either going to show growth or that are going to consistently grow. For instance, a lot of people right now would be scared of the financial sector. They think banks, they think mortgages and consumer finance. But we have to remember that within the financial sector is the insurance industry. And last year alone, with 10,000 people retiring every single day for the next 8 years, people believe that they have underfunded because of extended life plans, their retirement timelines. And so $1 trillion has moved in assets into fixed index annuities with income sources for retirement.
Right.
That in itself alone has taken the financial sector as something to be optimistic about when looking in terms of an 8 or a 9 year play.
So it sounds like for the shorter term, you like in the financial sector, you like insurance, and maybe for a longer term play, metals, mining, things like that seem a little more volatile at this moment. Final quick thought?
I'd also add healthcare into that with Walgreens and CVS announcing that they're going to start creating walk-in physician-attended clinics. And as the population ages, as I mentioned, we have 150 million people that'll be at retirement age in the next 8 years. Walgreens and CVS having that added benefit as a service aspect. Healthcare is also something to look deeply into.
Yeah. Randy, thank you so much for that. A great conversation. I appreciate it. Randy Sevchak.
Thanks for having me, Nicole.
Group Retirement Services. Thanks. Have a great day. Still ahead, I want to discuss what's going on in the oil industry. Lots of moves happening. You have the IEA announcing oil reserve release. You have the executives in Washington denying that they're price gouging. So we have pros ready to discuss all things oil coming up.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com to all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
I'm Jenny Horn. Here's a few more intraday movers to keep on your radar. Bank of America reiterated Peloton as buy, predicting that gross subscriber numbers will beat estimates in the third quarter. The firm said Peloton's subscriber and content base are strong assets with advantages relative to its peers to transform its business model. They also highlighted Peloton's new CEO and his strong track record at subscription companies. Aflac is holding on to its intraday gains after Piper Sandler raised its price target to $72 a share from $70, while reiterating an overweight rating. Of the 5 analysts that cover Aflac, 4 are somewhat bullish and 1 is indifferent. And the average price target among the analysts has increased by almost 3% over the past month. And Barclays lowered its price target on Citigroup to $67 a share from $73 with an equal weight rating. Ahead of the big bank's earnings, which are due next Thursday, the analysts cut their EPS estimate by 65 cents to $1.73 a share, which remains above consensus. Barclays said this reflects lower investment banking fees and higher expenses, as well as any potential changes tied to geopolitical headwinds. This has been your TD Ameritrade Network Market Update. Now back to the watch list with Nicole Petalides.
Thank you, Jenny Horn, for that report. Welcome back to the watch list. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. We're getting ready for the last hour of trading. Traders obviously have a lot of market on close orders. Take a look also at the major market averages after we got some quick reaction to what we heard from the Fed as they will continue to unwind the balance sheet aggressively, reduce $60 billion in treasuries, $35 billion in mortgages. That'll be about $95 billion on a monthly runoff, as well as that they were going to do 50 basis points, but did 25 basis points on the last meeting because of Ukraine and the concerns there. Now, here's a look at the Dow right now. It's down 156 points, and I will say that the NASDAQ has been selling off. It just really, tech has been under some pressure. I'd like to turn our attention to oil now, though, because we've had so many headlines. I'd like to bring in our guests, Ellen Wald, PhD, author of Saudi Inc., president, Transversal Consulting, and Rohan Reddy, research analyst at Global X ETF. So thank you both for being here. What I was just looking at here was I really wanted to see, because as I saw oil at 96 and change, the first thing I thought to myself was, is this the real low that I haven't seen? And that's why I was reaching over, and that's true. I see the low of 95 and 73. So we are really at the lowest levels that we've been in some time. Ellen, what do you make of it? I mean, there's been so much going on.
I think that it's really reflecting the current volatility in the market, because there is just so much going on with the market. Today we had the announcement that the IEA is going to have member countries release another 60 million barrels of oil to complement the U.S., which announced it's doing a 60 million barrel release as well. And so it's very likely that this is affecting prices today, and tomorrow we may see the reverse. We may see prices go back up, just like we saw Monday. Prices were fluctuating a lot based on these announcements, and so it's just we keep getting more news, and the market doesn't necessarily know how to react in the long term, so it's reacting very much on a day-to-day basis. And I think that continued volatility is just what we can expect in the long term.
And as we have oil up 30% this year, we have gasoline prices up probably $1.20 year over year. I say that sort of loosely, but that's roughly what we're seeing. Rohan, what do you think?
Yeah, I would agree. I think there's going to be, some change in course that comes along the way, partially because if, supply levels start moving, particularly in the U.S., where there could be a little bit more shale production. That's where you could start to see prices, I think, be a little bit more volatile and start swinging around quite a bit. But again, a lot of this is very fluid based on the Russia and Ukraine war and some of the ramifications that come about through that. So we do think that playing the price of oil right now is going to be a little bit more volatile. So you should look as an investor to potentially position wise in other areas.
Yeah, and I'm going to want to ask you about some of those pipeline stocks that you brought to us. Ellen, as we see, I saw the AAA stat. In fact, it's up gasoline is up 46% year over year. Is this strategic petroleum reserves, right? So you have the IEA announcing that. The U.S. is doing much of the same. Are these the right steps? Are they just Band-Aids? Does oil continue higher? We're about $100, which is still an elevated level. Which way are we headed?
Well, I think that the releases from the Strategic Petroleum Reserve are really only going to have much of an effect in the short term, because the Strategic Petroleum Reserves really aren't designed as mechanisms to affect prices. And it's been shown that they don't really have effects on prices in the long term, because they are, it's really like a one-time release. And also we know that those barrels of oil have to be replenished at some point. So it's not like we're actually seeing an increase in global production from this. And I do think that, the way that it's been engineered to try to create a price drop through basically the November elections, but I'm not sure it will actually follow through in the way that the White House is hoping for. And this could potentially be a problem, especially as we come into the summer and the summer driving season. And all indications are that despite prices, people are really interested in getting out and traveling and going places. So we're looking to see very strong demand for gasoline and other oil products into the summer.
Look, we had the executives of Exxon and Chevron. They appeared by video before the committee, the House Energy and Commerce Committee, to talk about prices that Americans are paying and saying, look, they actually denied any price gouging at all. So I know it's an ongoing story, but it hits people's wallets. In fact, someone just messaged me as I'm sitting here how much they paid at the pump. So it's a thing. But if you're an investor, the pipeline stocks, you say, Rohan, look most attractive. What names does that mean exactly? And why the pipeline stocks?
Yeah, it's a good point, and part of it is because of the discussion that we've had earlier about prices and where they could potentially move from here, even though they're a little bit volatile right now. And I think if you look at pipeline stocks, I mean, they benefit a lot from volumes. And so if U.S. shale production does increase from here, which it certainly could, both politically with some of the pressure that we're seeing, but also because prices are relatively high, so that'll help the business models of these companies. That'll just generally make pipeline stocks a lot more attractive to investors. Especially in like a low, yielding environment when rates are starting to move up a little bit further. So I think this is a positioning area for some investors, but also makes sense as an energy investment. Now, in terms of particular stocks that we like right now, I think a diversified ETF approach makes sense. Ticker MLPA, ticker MLPX, those are ETFs out there. But Kinder Morgan, Enterprise Product Partners, these are really good businesses to be invested in.
Yeah. Wonderful to see you both. Thank you so very much, Ellen and Rohan. Always great to talk oil with you. Such a hot topic. Thank you both, Rohan Reddy and Ellen Wald. Thank you, friends, for joining me here for the Watch List every single weekday at 2 p.m. Eastern Time. I see you at 11 a.m. and 2 p.m. live from the New York Stock Exchange. I'm Nicole Petalides. I appreciate that you join me each day, but keep it right here because Market on Close is next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo Webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the Watch List at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
Let's walk through charts, one of the most commonly used features on Thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select Time Frame to adjust time intervals or to favorite a time frame. Select Style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
afternoon. It's 3 p.m. here in New York. I'm Caroline Woods filling in for Oliver Rennick, and this is Market on Close. With 1 hour left of trading, let's check in on the markets. We are still seeing red arrows, but the Dow is inching closer to the unchanged line, down to only about 0.2% right now. We're seeing strength in healthcare, consumer non-cyclicals, energy, limiting losses there. S&P 500 down about 0.6%. NASDAQ still the worst performer of the day, down 1.5%, but cut earlier, losses basically in half. And the Russell down 0.9%. In terms of volatility, we're seeing VIX below 24 now, was as high as 25 just a bit ago, but Bitcoin selling off in a big way. It's down about 5% today, below the 44,000 level. Now it's time to welcome in Kevin Hanks, the co-host of Fast Market. Hey there, Kevin. Glad you can be here with us. Want to start with the Fed. The FOMC minutes were released just about an hour ago. The market's bouncing all over the place, trying to basically digest what the Fed had to say. What stood out to you? What did we learn? Not sure. I think Kevin might have an audio issue, so while we try to solve that, let's take another look at the markets, because as I said, they are just bouncing all over the place. Dow is clearly the outperformer today, inching closer to that unchanged line. Let's see if it can get there. S&P down 0.6%, NASDAQ down about 1.4%, Russell down about 0.8%. In terms of biggest gainers on the Dow today, as I said, healthcare, consumer non-cyclicals, we're seeing Amgen up 2.5%, United Health Group up 2.4%, Walgreens Boots up 2.4%. So not all red arrows helping lead the Dow higher. But while we get those audio issues fixed with Kev, let's take a quick break, and we'll be right back with some key takeaways of the FOMC minutes.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Let's walk through charts, one of the most commonly used features on Thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
All right, now it's time to welcome in Kevin Hinks, the co-host of Fast Market. Kev, since we were waiting to connect with you, the market actually has paired even more of its losses. It's still red arrows, but do want to ask you about the key takeaways from the FOMC minutes, because it seems like the market's taking some time to digest those. What stood out to you?
Hi, Caroline. Glad you can hear me finally. You know, we knew this was going to be a big event, what the Fed had gone through. A lot of the participants were calling for a 50 basis point hike. It looks like in the minutes they didn't because of the Ukraine invasion, but this is clearly, Caroline, a shift into the more hawkish camp by the entire Fed. The only real different measurement is how hawkish each member of the Fed is. They seem like they're all in on inflation, on attacking inflation, Caroline, and reducing the size of the balance sheet, even as far as to consider selling mortgage assets to get there. So they want to get this to a more neutral policy as quickly as possible, get inflation under control. This is a Fed that is in line in their thoughts about fighting inflation, Caroline. These Fed minutes were everything that we thought they would be, and the anticipation. You are, however, though, seeing kind of a relief rally, a little bit of comeback in stocks after consuming and digesting the Fed minutes, Caroline.
Possibly because we already knew the Fed was all in on combating inflation. We've been talking about how this market's pricing in a more aggressive Fed, and then yesterday it seems like maybe that wasn't the case. But let's talk about a few more movers today. Tesla is down 3.5% off its lows, but those COVID lockdowns in Shanghai continue. Implications there, Kev?
Yeah, you know, the COVID lockdown has got Shanghai in its grasps, and Tesla closed down their Shanghai factory March 28th, and now they've extended the closing till Thursday of this week. So it continues. That situation there is still very fluid, and Tesla stock not liking the news about that. You know, remember, Shanghai, such a vital part of Tesla's overall production numbers and growth in China. So yeah, every day that's closed is a pretty big deal for Tesla. Not good news today, Caroline.
It's also a down day for the Dow transports, and I know we can look at those as a leading indicator for the equity market. So does that flash a warning signal to you, if you will, that we're seeing this continuous weakness in the transports?
Yeah, you know, down over 3%, that's a pretty big move for the Dow transports. And when people are looking at this discussion you and I are having, they're like, what exactly is in the Dow transports? Well, it's mainly every airline, every rail, FedEx, UPS, everything that might move some either person or package from one place to another. So if you think about supply chains and things like that, every way that you might move either a person or a package is reflected in the Dow Jones Transportation Index. And yeah, that weakness is something that every trader should take notice of, Caroline.
Yeah, down about 11.5% so far year to date. So definitely some weakness there. Kev, thanks so much for your insights. Always appreciate it.
Thanks, Caroline.
Have a great night. Now it's time to bring in our next guest. Wayne Wicker is Chief Investment Officer of Mission Square Retirement. Wayne, so good to have you. Thanks for being here.
Thanks, Caroline.
So Wayne, we're seeing a bit of a whipsaw back and forth in the markets today, but also over the past really, few weeks. So much uncertainty in the markets right now, so many risks. How are you approaching the stock market right now?
Well, certainly there are a lot of risks. Kevin talked about a couple of those with you just now, and I think that the last quarter we started out being really concerned about the interest rates and where the Fed was going. We transitioned to geopolitical risks in the middle of the quarter, and we boomeranged back now to inflation and where the Fed is going to be taking us here in the next couple of months. So there are a lot of risks there. I think one of the things that's important to think about, though, is are you a trader or a long-term investor? We tend to take a long-term approach, and so we look at the market not day by day, but more in terms of the year or 2 or 3 years ahead. So for us, I think that some of these are certainly opportunities to reposition portfolios. And I think that as you are thinking about where you're going to be, some of this uncertainty works to your advantage.
So repositioning some of your portfolios with a longer term outlook. So what does that mean? How are you doing that? Is now the time to be conservative given all of the risks, or are equities still the best place to be?
Well, I guess you could have thought that a couple months ago would have been the time to be conservative because we started out the year and it seems to have just gone down since. But I would tell you that at this juncture, if I'm looking at where the Fed is going to go, and I think everybody has a consensus view that the Fed is going to be hiking for at least the next 2 or 3 meetings, and some believe that there will be hikes all the way through the year. That doesn't bode well for you as a bond investor, and I think bonds have already started to take that into account. The question is, have they overreacted, or is this a rational move? And we think that at this point, you're wise to stay in shorter duration fixed income securities. On the equity side, we see that there's probably balanced opportunities between growth and value stocks. Growth has driven this market for the last 2 or 3 years, but as we all know, with higher interest rates coming, it bodes not so well for those high duration portfolios that have no earnings. So we think that having a higher quality opportunity in large to mid-cap stocks where the balance sheets are a little bit stronger probably would bode well for investors in the current market environment.
So you would be using a down day like today as a buying opportunity?
Well, I think you can be selective. I think investors have to have their targets there, and if they haven't rebalanced over the last year or so, I would anticipate that they're probably already, despite the fact that the markets were down 5% in the first quarter, they're probably already have a pretty strong allocation to equities. But I think selectively, for those companies that still appear to have strong earnings opportunities that have been hit extraordinarily hard in the first quarter, and you have a long time to hold those stocks, it could be a good opportunity.
So we're getting some more details about not only how much the Fed will hike rates, but how they're going to really shrink their balance sheet. And the big question is, will the Fed be able to achieve this soft landing, right? So in terms of recession probabilities, is that in your forecast? And how are you, preparing for it, if so?
Yeah, I think it's really hard to navigate a soft landing. We're in a unique situation where inflation is running high. Interest rates are extraordinarily low. Employment is really strong. And so I don't think investors have really seen this combination before. So to suggest a soft landing would be nice. I guess we'll have to wait and see. However, I think that investors, probably are preparing for much slower growth going forward. And we would anticipate that Europe is probably already on the verge of hitting a recessionary environment. It wouldn't be surprising if at some point that is contagious and moves to North America.
We have to leave it there. Wayne Wicker, Chief Investment Officer, Mission Square Retirement. Thanks so much. Coming up, have you ordered anything online lately? Notice any delays in delivery? Well, we're going to examine the U.S. supply chain and figure out why those delays might be showing signs of improvement. Stay right here on the TD Ameritrade Network. Market on Close. We'll be right back.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network. Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management Webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I'm going to take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position?
You two are all set.
Choose the app that fits your investing style.
Welcome back to Market on Close. I'm Caroline Woods in for Oliver Rennick. It's time to discuss the state of the U.S. supply chain. For that, we welcome in Adam Lampe, CEO and co-founder of Mint Wealth Management, to the show. Hi there, Adam. Good to have you here. Want to start with a note that I saw. Obviously, pandemic-related work stoppages have really impacted every aspect of the supply chain. But now that we're 2 years in, I saw a note that you have that you say supply chain relief may be in sight. Where do you draw your optimism from?
Yes, it's gradual. In the last 6 months, we're seeing improvements at the ports. And I think it's a gradual improvement that's boosted energy, food, and raw materials. But I still believe investors should take a cautious approach to investing and look at high-quality, profitable companies and stay away from the ones that are struggling to generate earnings. The interesting part for me is 40% of companies right now are in correction territory or bear market territory, but yet 75% of the top 500 companies are beating earnings expectations. So that gets me excited.
Yeah, especially as we head into an earnings season next week, beginning with the banks. But in terms of investment ideas, I know you came with a few picks, and we were just talking about the Dow Transports at the top of the show and some of the weakness we had been seeing there in terms of what that could indicate, because it could be a leading indicator for where equities are heading. But you like two of them. First up, Union Pacific. Tell us why you like that one.
Well, they're one of the largest railroad companies in the country, and I think a lot of companies are ready to get back to normal, and we're seeing a lot of the supply chains start to gradually improve. I also like some trucking companies. Old Dominion Freight Line is another one. And then, I think there's going to be a bigger trend with 50% of companies looking at hybrid work at home models. Everybody wants to fix up their homes, and other companies that will be impacted by the supply chains, I think like Home Depot, Costco, semiconductors are another area that's really interesting.
So in terms of Union Pacific, it's down about 3.7% today. Old Dominion, the other one you mentioned, that's down about 2.6% today, but pretty different year-to-date charts. Union Pacific just barely negative because of its losses today for the year, whereas Old Dominion down 27% year-to-date. So you'd be comfortable buying both of those at these levels?
Definitely, especially when the one that's, if it's down a lot, I like it even more.
Any other companies that you see will be long-term winners as the supply chain specifically rebounds?
I mentioned Home Depot. I think another one that I really like is Lowe's. I think there's a real trend. I don't know about you, but everybody wants to work from home. And, we are in an employee world. There's more jobs available than people are taking them. In fact, companies have hired, it's been the sharpest increase since April of 2020. Why we're having all these supply disruptions and the Omicron is starting to fade away. I mean, we certainly have other issues, the Russian invasion. That's a risk that we have to be keenly aware of.
We also have a higher rate environment that's only going to go higher. We know the Fed is committed to being aggressive to lower inflation levels. So how are you factoring that into your investment strategy?
Well, the bottom line is investors should be attracted to stocks with healthy balance sheets and use earnings as a guide in a rising rate environment. I think that is really key. There's a lot of folks out there that will buy high flyers. I had a gentleman the other day say, my portfolio with your firm's down 5%, but the stuff that I'm managing, it's down 35%. So you have to be much more selective. And I always tell folks, diversification is undefeated. But I also will add, if we're properly diversified, I'm always going to have to say sorry, because there's going to be certain areas like bonds. We're very negative about bonds. We're also negative about Europe.
So if you're negative about bonds, is that whole 60-40 portfolio idea dead in your mind? What should the correct ratio be for the average investor?
I certainly think you should be underweighted to corporate bonds. They've actually hurt portfolios. I think I like high yield. I like emerging market debt. In some instances, treasuries can make sense in a market that we're in currently with high volatility. But we've actually returned back to normal volatility. We've had a 12% correction in recent weeks or months, but it's very normal for us to have a 10% correction, and we were due for one. So quite candidly, we have to embrace stocks. We have to embrace bonds as well, but I would certainly be underweighted with corporate bonds. I like high yield a little bit better, but at the same time, you should be broadly diversified against, I like value stocks over growth stocks. Certainly there's a lot of good companies out there that are paying their dividend. And you always look at the dividend coverage rate. You don't want any companies that are borrowing to pay their dividends.
All right, we appreciate all of those picks. Adam Lampe, CEO and co-founder of Mint Wealth Management. Thanks so much. Up next, it's time to head to the options corner. Tom White has some big trades he's found in today's action. We'll find out which stocks have drawn a lot of interest today. That's next on the TD Ameritrade Network. Stay tuned.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then watch list. When the default list appears, select the name box, then create watch list. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select enter. Continue adding all the symbols you want in your watch list, then select save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
Welcome back to Market on Close. I'm Caroline Woods in for Oliver Rennick. It's time for Options Corner. Tom White joins us from the Chicago newsroom. Hey there, Tom. You have 3 bullish trades for us, I hear. And let's start with Marvell. Tell us about the trade.
Yeah, so the shares are down about, 24% so far this year, below its 50 and 200-day moving average, which might become an area of resistance at this point. But this is one of those stocks that's considered, the mini NVIDIA. So, they're in multiple different realms within the chip space. Data centers on fire. The CEO stated that. 5G starting to pick up. Cloud computing continues to be an area where they see growth. But at the same time, you're seeing supply chain issues continue to constrain this particular stock and the semis in general. So that's a concern. That's why you're seeing, the weakness here, not only in Marvell and a lot of those tech chip names. But that being said, somebody may be trying to expect a little jump here over the next 8 days because trader was in there buying the April 68 strike calls. They bought 20,000 of those for an average debit of about $1.30. That break even of $69.30 to the upside, about 2.5% above the current share price in there. Over 31,000 have now traded on that strike throughout the session. And call volume in Marvell, even on this slide in the NASDAQ today, about 5 times normal daily average volume that we see over the last 5 trading sessions. So a lot of interest in here with the expectation that, hey, maybe this 2-day sell-off is going to end soon. We're going to reverse higher. You only need about a 2.5% move above the current share price, as I said, to get above that break even. But short-term positioning here in Marvell into April expiration.
All right, moving from Marvell to Lyft, another one that's down over 2% today, actually closer to 3%. What's the trade you're seeing there?
Yeah, down about 15% so far this year. It's down about 43% from year ago levels. So we've seen a slide in the ride-sharing business, including not only Lyft, but Uber also. But there was a note published today by New Street analyst Pierre Ferrago, who's been on the network multiple times. He's arguing the synergies maybe between Lyft and DoorDash might make a good combination. and that way they could compete more with Uber. Lyft is the number 2 in the ride-sharing business, but then again, they don't have all those money-losing businesses like DoorDash, like Uber Eats. So twofold here as the ride-sharing business is starting to pick back up. You can see there from the chart, it's just been a falling knife. Fits and starts for this one, but near 52-week lows here. But really short-term buyers in here based on, I think, that report and the fact that Uber is trying to become a super app, adding in-flight items to their app over in the UK to start out with, so exploring those details. Somebody in there buying April 8 weekly calls, 15,000 of the 38 strike calls for an average debit of only 22 cents. Now, you've only got 2 days till expiration. That's why they're not paying that much for these calls that are out of the market to the, or out of the money to the upside. That break even of 38.22 to the upside is about 5% above current share price of Lyft in here. Call volume about 8 times normal daily average volume. So they were in there pretty early on in the session when this news broke from the New Street analyst. 66,000 calls have traded in Lyft today overall, and only 7,000 puts. So now you're seeing that skew where the call volume is about 8 times normal daily average that we've seen in there over the last week.
All right, and finally, Wells Fargo, which we know reports earnings next week, it's down only about 0.7% today, and just barely below the unchanged line for the year, only down about 0.4% at this point because of today's losses.
Yeah, we saw a little outperformance in the banks to start the year. Wells Fargo and many other the other money center banks rallied into the beginning of February, but have since fallen rather sharply, despite the fact that we're seeing interest rates kind of go higher. It's off 20% from 4-year highs that we saw in February of over $60 a share. You can see that on the chart there. Morgan Stanley, in a note, said that war changes everything, that maybe rising interest rate, rising inflation might actually put pressure on the consumer. Wells Fargo relies a lot on lending, right? 30% of the mortgages created here in the U.S. are Wells Fargo. Now that number's dropped precipitously as we've seen competition come into space from Rocket Mortgage, among others. But that being said, somebody probably taking a longer-term view. You mentioned that they have earnings next Thursday before the open, which may be a catalyst for this company. But they were in there buying the June 55 strike call, so pretty far out of the money to the upside. Bought 20,000 of those for an average debit of about 76 cents. That break even of 55.76 for this position over the next 72 days, about 16% above the current share price. So you need a pretty significant move. I think one of the key things in this position is they're giving themselves duration, right? You're capturing an earnings event and you've got 2.5 months until expiration. They were also in there buying some May calls in the 57.5 strike positioning there also. So if we continue to see rise in interest rates, maybe get that yield curve to start to expand instead of contract on the 210, maybe that's positive for banks moving forward. But I think the economy is going to dictate what's going on. But this trader is setting up for a big pop here in Wells Fargo over the next 2.5 months.
Well, we'll have to see what happens after those earnings. Tom White, thanks so much.
Thanks.
Coming up, we'll turn our attention to the 10-year yield on the dollar. Dan Deming is waiting to provide his commentary on the Fed and more. Stay right here on the TD Ameritrade Network. Market on Close. We'll be right back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our Active Trading Webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act. those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
I'm Maria Schrader. Here are a few stories to watch this hour. Dave & Buster's slumped in today's trading after it announced it would buy Main Event Entertainment for $835 million. Main Event has about 50 locations across the U.S. and offers bowling and laser tag, among other options. Dave & Buster's says the acquisition will drive earnings growth. Boeing is down on the day after the chairman of the House Transportation and Infrastructure Committee said he opposes giving the company more time to certify the 737 MAX 10. The FAA previously warned that Boeing might not meet its new safety standard deadline for the craft. Redesigning the flight control system could cost Boeing millions. MasterCard's March spending pulse reported that U.S. retail sales were up 8.4%. MasterCard says consumers have resumed spending on passion areas like travel, live entertainment, and other in-person activities. Airline spending was up 44.8%, restaurants were up about 19%, and lodging was up 46.4%. This has been your TD Ameritrade Network Market Update. Now back to Market on Close with Caroline Woods.
Welcome back to Market on Close. Let's bring in Dan Deming, Managing Director of KKM Financial. Hi there, Dan. Good to have you with us.
Hi, Caroline.
So, Dan, I want to ask you, obviously, we just got those Fed minutes about an hour and a half ago. The 10-year yield spiked ahead of the release of those. What has caught your eye since the release?
Well, just the general reaction in the market, Carolyn. I think, when you look at the fact that initially now the taper as far as the $95 billion that they capped of the wind down of the liquidity provisions was a little lower, I think, than what the market had anticipated. So initially did see a positive reaction in the equity markets, but then we did probe the lower end of the range before finding, again, some upside here as we move towards the last hour of trading. So the market's really, there's a lot of cross currents. There's a lot of confluence of events that are unfolding here that the market's having a difficult time evaluating. And the one thing I can tell you is when you look at the different price actions in various asset classes, the dollar going to new highs here on the heels of this announcement. And we are seeing crude coming under a little selling pressure as well.
So let's talk about the dollar and crude in just a second. But in terms of what's priced in terms of the equity markets, we've been talking about a more aggressive Fed for what seems like forever at this point, but at least so far for the first few months of the year. What is priced in, do you think, at this point? Or how much more does it have to adjust to accommodate for a Fed that ultimately is going to be tapering, tightening, trimming?
Right. A lot of it has been priced in now over the course of the last couple of weeks, as we are seeing yields going to multi-year highs. And the other interesting thing here, Carolyn, is the fact that we are seeing the back end of the curve selling off more so the last few days. Therefore, steepening of the curve is taking place. As we did see the 2-year, 10-year or the curve, I guess, come out of inversion. So now we're seeing the 10-year yield higher than the 2-year yield. So the market is kind of adjusting now for the prospects of the duration of what the potential could be for some of the narratives that we are seeing coming into the market and the adjustments the Fed is making. Excuse me. So, I think that's one of the things that I think is very interesting, and that's why you're seeing the equity markets kind of moving, and you're seeing a rotation taking place, as we are seeing healthcare benefiting from the current trends, which is interesting, but also consumer staples to be expected, more defensive type of posturing. And, the banks are struggling here a little bit. But if we do see that yield curve continue to steepen, as long as economic activity doesn't slow to a point where it has a serious headwind for the banking sector, I would expect that the banks would actually benefit from this longer term, even if in the short term we are seeing under some selling pressure due to the fact that I think there's expectations that could see a slowdown in activity, particularly in mortgage applications and things of that nature.
And also, as Tom White pointed out, what a slowdown in the economy could mean for the consumer as well. You mentioned the stronger dollar. It hit a yearly high today. What does a strong or a higher U.S. dollar mean for the equity market?
Well, it just depends on where you're positioned, I suppose. Some sectors it's beneficial, others not so much so. So I think the market's still trying to sort this out. And also, I think we're going to see a bit of a reaction in other central banks that could stem some of this upside that the U.S. dollar has gained recently, as they probably shift their tact on their accommodations as far as interest rates and monetary policy. So, right now the dollar is benefiting from the uncertainty surrounding the war in Ukraine, benefiting from the uncertainties surrounding, the volatility in certain asset classes. And also now with the announcement today coming on the heels of several hawkish talking points by Fed governors the last couple of days, has benefited the dollar. But I think ultimately we'll probably see a little bit of equalization here, which could lead to seeing some of these areas in the market that have been under some pressure, particularly when you look at the tech area and things of